Okay, good morning, ladies and gentlemen. Welcome. My name is Steve Torsa. I'm the founder and managing director of Wholesale Investor. So welcome to our Venture and Capital Singapore. Very excited to have everyone here. And also, from our perspective, we've been coming here now to Singapore for 9 years, and every single year, it's fascinating to see all the different changes. And for me, of all the different places we go to as a company, whether it be Australia, Singapore, Hong Kong, Malaysia, etc., nothing moves as fast as here when it comes to innovation. And today, you see, we've brought an incredible range of companies that have come to participate in the event. And we've got an incredible day lined up for you. And of course, we make sure we finish the day with networking and drinks, because that's obviously the best way to celebrate a good day of conferencing. Now, for us as a company, I said everything that we think about is how to empower innovation, capital, and ambition. So the structure of today's event is exactly aligned with that. So as a first step, we're very proud to have Campbell Newman, who is the former Premier of Queensland, as one of the keynote speakers for the event, and also is going to be presenting one of the opportunity in relation to Arcana, which he's the actual founder of. And then we've also got Pete Ward from Humanity, who's got he's basically been doing incredible work in Europe, and has got some amazing shareholders, partners, and his story itself is something that's pretty inspiring for both investors and also founders. So got some great keynote speakers. And then more than that, what we've made sure to do with the actual panel sessions is to cover the areas that are relevant to our ecosystem. So firstly, the venture investment trends. The lineup on that session, I said, the people, whether it be HH, whether it be HH from SG Innovate, whether it be Jeff from iGlobe, I said, very proud to have them involved in the conference. And then, of course, we've got the likes of Weimang. I said for us, I put an email out a couple of days ago where I talked about the stories behind how I knew everybody associated and how it all become connected. I've been incredibly lucky in coming to Singapore. As an Australian that's come here, we've always been very welcomed by your ecosystem. And more than that, we've always been passed on more and more referrals to other networks to be introduced to. And that's how we've effectively built it. So starting off with the venture investment trends, then the digital asset investment trends, and I'll give you my thesis behind that when I go through my talk, and then the alternative investments area. And of course, this is really, these are the three key areas that are the prime areas for us. And we want to make sure that by the end of this day, you walk away with either a confirmation of your own investment thesis or new layers to add on top of it. And that's really why we do everything we do. And of course, we've got 29 presentations from some incredible companies across a range of areas. And I'll give you a bit of a summary of those companies shortly. In fact, that shortly is right now. So what I love to do at the start of this, because I know that some people, you may be in and out here today, you may be having conversations, you may be inviting people to come to meetings here. All those sort of things typically take place, right? So when we're actually hosting this event, I always love to give a rundown of some of the companies that are actually presenting. And it seems like my actual outline has disappeared. All right, so effectively, I'll go through it off the screen. So companies like Geniux, who is building the next layer of infrastructure for renewable energy tech. This has to be one of the biggest investment opportunities over the next sort of decade, just for the fact that we know that this is coming and this is the opportunity. AgLive, working with some of the largest beef producers in Australia, to basically provide a blockchain solution to provide traceability, for all the different herds involved with it. PYC Therapeutics, they're an ASX-listed life science company. We've been working with them since 2009. It is absolutely incredible, the progress that they've had. The company now sits at a 200 mil market cap. It was at high as 600 mil in 2021. And so what they're doing is completely unique. And of course, someone's trying to call me right now. And and then Biosignals, late last year, the area of the heart, is important to all of us, right? And I'm sure all of us have either got a family member or we've experienced something personally ourselves with issues with the heart. For me, I had, in November last year, my 14-month-old son got diagnosed with a heart issue. And when I come across Biosignals and found and really understood what they were doing, one of the hardest parts is when you do have a heart issue, the only time you can actually go and find out really what's happening is when you're going and seeing a doctor. Well, they're giving that sort of technology to you in your fingertips that goes directly to your doctor. Companies like Limestone Coast Brewing, you know, who would have, they blend the two most favored sectors of Singapore together, technology and alcohol. So basically, to be able to create brewery as a service, phenomenal level. So make sure you have a chat to the Limestone Coast Brewing team. Stronghold Investor said that over the last, we worked with them 10 years ago when they were launching. Now they've built several $100 millions of funds under management, own some great assets right across Queensland, and they're obviously here today to talk about their opportunity. PowerCap Un Limited said, obviously, the area of energy storage is one of the 5 key platform technologies. And, you know, if you, I'm not going to do it disservice, but effectively I said, go and have a chat with the PowerCap team and ask them how their energy storage device differs and how the improved performance compared to something like a Tesla Powerwall. It's absolutely mind-blowing. The background of the team behind that, incredible intelligence behind it. Griffin as well, as I mentioned, we've got 3 different property groups here today. Said all have got strong track records, have been involved for over a decade, you know, all produce, you know, consistent returns for their investors. So we're we're very, very pleased to have them come with us. And we know that Australian real estate has been a strong staple for Singaporean investors. Companies like Pivotree and Sequester said, every time when you come to Singapore and you look out when you're coming into Singapore, you see how many oil and gas tankers are sitting off the coast. You know, they've got quite a unique innovation in the oil and gas sector to actually help the exploration part to reduce the cost. I can't remember the percentage, but somewhere between sort of 30 to 50% of how much less cost, just because the amount of less requirements what they've done. So anyone involved in the oil and gas space, quick conversation with these guys and you'll understand how innovative their technology is that they've been able to build. And then the likes of Cannaponics, right? Obviously, with the recent legislation changes in Thailand, obviously it creeps on. You know, obviously, we all know where it's sort of going globally in regards to medicinal cannabis. These guys have built up an end-to-end sustainable system where they can, obviously using renewable energy to grow their own culture. Their entire crops, which they will grow, is already effectively, the offtakes for that is already it's already been purchased. So credible team, they've already raised, you know, they've already had, you know, 20+ million invested into the company already. So it's an incredible, not just a land, you know, just a land opportunity in Australia, but obviously then the business model on top of that as well. Imugene, what a company. You know, I worked with Imugene when they were a 20 to 30 mil market cap company back in 2017. They went as high as $2 billion in 2021. Right, during the boom. So to have Leslie Chong come over here and participate in this event, I'm super proud to have her here. She's an incredible, if you go Google her name, you'll see how well respected she is in the Australian life science community. Misio, you know, in the few days that I've been here, obviously the area of ESG and then decarbonisation has become a popular one. One of the hard part is people don't really know how to report this stuff. They don't know. They're building a solution so that companies can do it within minutes and basically have as a software and AI-driven solution that can actually take their data and then provide the reports that they actually want. Now, of course, this is the kind of data which would have been charged tens and hundreds of thousands of dollars from consultants. They're doing it via software, which is really impressive. Profsee, incredible financial services technology out of New Zealand. When I first come across them, their company is an entire end-to-end solution in the financial planning and wealth management space in New Zealand. So they've basically built a vertically integrated business across that. They've got Alooba, and then finally I mentioned at the bottom Arcana Capital. You know, and Arcana Capital is Campbell Newman's company. It's their commercial real estate investment firm. So I've done my best to explain them literally off the top of my head from my conversations with them. If I've missed any companies, I apologize, but I always love to do that just to give some context as to who's presenting at the event. So the biggest thing I always say with this, you know, and actually I'll get onto that. Now, to access all the companies, I recommend, we've built software for this purpose, right? Now, obviously we do in-person events, but we actually build software to facilitate the engagement between you guys as investors and obviously the companies that are participating at the event. The first step for all of you to do is to go to app.crisp.io. You would have seen the link for it in the actual email. The entire event sits inside that app, right? So there'll be no paper provided by us today. The entire event sits inside that app. All of you also will sit inside that app so you can network with each other. We are absolutely about bringing ecosystems together, and we're all about making sure that you get connections that basically can lead to 2, 3, 5, 10 years of opportunities between you. So the nicest part about it is there's a beautiful investor networking zone in there as well, where you can see what everyone's looking to do. I said everything we're trying to do is create relevance. And likewise, you can see all the companies that are participating today in there as well. They've got all their deal rooms in there, high-level information, videos, and so forth. We have done our best to make it absolutely seamless for you to find what you want. From the platform side, we provide AI-driven recommendations in there. We've streamlined the process for you getting access to execution milestones, news feed, deal information as far as pitch decks, financial, all the stuff related to the company sit inside the app, and also your frequently asked questions. So one of our premises for what we've built is that we basically encourage companies to basically have the frequently asked questions in there so that they answer your questions before they ask them. So it's really not just about the pitch deck, it's also about all the execution milestones, all the questions that other people ask. We've tried to make everything seamless for you. And then also you can message directly. Make sure you just message and let them know you're at the event and then you'd love to have a catch up with them, or just obviously visit them at their trade table. Quite simply, the software is designed to help you see the most relevant deals for you, and then obviously the companies to see the most relevant investors for them as well. Now in that, obviously we've also integrated the conference software. As I mentioned, there's a live agenda in there. So that agenda is up to date, so you can see exactly where we are at each stage of the day. I appreciate some of you may have got meetings here, or you may have calls that you need to do, or all that sort of stuff, or you may be for the first session and all that sort of stuff. I appreciate. There is a live agenda sitting inside the Crisp app as part of the actual event, and then also the virtual booths for the conference. The biggest communication I have to everyone is that whilst this is just one day, and I know there's lots of different events that take place in Singapore, one of the big things I'm about is one conversation can change the entire trajectory of an investment or of a company. And the other part is that every single one of you will have 10 to 15 people in your networks that could be relevant to one of the companies. So for example, if you're going around having a chat with one of the companies presenting at the booth, make sure you think about who could be relevant to this company, also in your own networks as well. Every single one of the companies that are participating today have flown to be here, whether it be from Australia, from the UK, etc., from surrounding countries. So please take that time to actually learn about what they do, and then also provide introductions. As I said, the more time you spend with the companies, the more time you spend with the CEOs, the more you realize that how substantial the businesses are. Like, these aren't the normal companies where they've just had an idea and then sort of come in. Most of the companies have actually had millions invested into them already and are moving into either that commercialization or growth stage of their trajectory. Now, for us, everything we're about is we're trying to revolutionize the whole capital raising area, because the reality is capital raising is painful, right? And so that's when we started building our own software to facilitate this, because we know that there's a massive private market opportunity coming up. So there's going to be two parts to my presentation where I talk about what I see as the opportunity and innovation in private markets, and then also opportunities that you guys may want to engage with us with going forward. So some of the key things that you may not know about Wholesale Investor. Out of curiosity, who's this their first event for Wholesale Investor? Okay, probably about half. Okay, so effectively Wholesale Investor's been around for 14 years. We initially started as a magazine, and then we moved to a sort of online to in-person model. And then obviously then we started building software around sort of 2019. For us, we've obviously got a recognized brand across Australia, Singapore, and the UK. And we've got a 14-year track record, and we've had 10 of the companies that we've worked with achieve unicorn status, and we've seen 70 of our clients go through exits, right? So we've had a strong track record in this space. Our vision is about creating opportunities for tomorrow. What I love about what we do is every conversation we have, every bit of code we write, every event that we host, every email we send is about creating something out of thin air. And it's one of the hardest things to do, especially in this space, but it's also something we're incredibly passionate about. said everything that we stand for from a mission perspective is about empowering innovation, capital, and ambition. And off the back of that, all we're aiming to do is try to make it seamless with utilizing technology platform partners to bring together companies and investors. And then as the second stage to that is that enabling of cross-border collaboration. We're so strong on, I just realized I was mostly talking without a mic. Did anyone hear me up the back? So the cross-border collaboration is very important to us. And as you see, there's different countries that are represented to here. And then also we try and bring the different ecosystems together. The question we're always asking ourselves is, how do you scale capital raising and how do you remove friction from the process? My hope for you and your experience in looking at the company's feature today is that you'll realize all the different things we've done to make it easier for you to get access to the information you want. And when in the actual design of our business and the design of our software, all the elements we've put together sit inside that, because effectively it's a very fragmented area. And there's actually a lot of gray frustration that people just don't really talk about. They just deal with it, right? Well, as we've invested millions in solving that as a problem for ourselves. And just so you know where we come from, our 3 fundamental principles to what we've built is to, number 1, build software that lets the ecosystem do what it naturally does, right? So we want you to be naturally looking at opportunities, connecting it with other people, asking questions, downloading information, looking for what you need to. The second part, which I'll talk about at the end, is we want to empower you to actually monetize what we've built, right? And then the third part is obviously the removing of friction from the process. The unique thing that we've done as a company is that we've looked to productize capital raising and investor engagement. And in that, we've built a world-class solution to actually achieve that. We've built a database of over 33,000 investors across Australia, Singapore, and the UK. We've also done an API integration with Crunchbase, which added over 200,000 investors into the software, for whether it be family offices, VCs, angels, etc. We've also injected, as I said, two-way AI ML matchmaking into the software. In fact, the easiest way to describe what we've done inside the software for companies is, imagine walking into an investment bank and asking, can I one, access your investor clients? Can you two, filter them for me so that they're relevant for my business? And 3, can you let me contact them directly? How well do you think that would be received? Obviously not very, but that's effectively what we've done with software with our own investor network. And then obviously this whole space is driven by conferences, demo days, and so forth, which is why it's important for us to integrate conference software into it. And then the intelligent deal rooms. For us in our space, data is not enough, right? Yes, it is at a higher PE level at the sort of top market deals. For our space, it's really about engagement. It's about relationships. It's about getting to know how someone executes on something. And if you go have a look in the deal rooms throughout today, you'll see that that's well and truly exemplified in the way in which the deal rooms software is actually structured. Now, one of the things we've just done recently in Australia, and we're also going to be bringing this opportunity to here, we've created a channel partner licensing opportunity where if you're an investor that's looking to assist your portfolio companies with capital raising, or if you're a business owner that's already servicing private companies and that they keep on asking for funding, or if you're a professional service provider, whether it be accounting, lawyer, consultant, etc. Effectively, what we're looking to help you do is to add capital raising solutions to your stack as far as what you can actually provide by all the things I just highlighted above. And effectively, what we've done is that we've created the structure now so that you can actually leverage off the infrastructure we've built. As I said, we've invested millions into building our ecosystem and also to building our software. And effectively, these elements now, you can get access to whether you're an investor, your own sort of entrepreneur, or you're a professional service provider. And we make that part of the solution as to what we actually provide. So, and then the last part is obviously we do conferences, and that's, to me, the face-to-face and the in-person part is a part of it. We have got international networks. And the last part is the media production. I'm sure you may have seen 1 or 2 videos that we put on our LinkedIn over time, or you may see it from the emails we sent out. But all this stuff is important because this whole space is about engagement, it's about relationships, and it's about understanding how companies execute over time. So we want to help channel partners in Singapore and ASEAN unlock what they can do via our IP that we've built. So we're basically providing access to our business systems and processes. We're helping groups actually learn how we've actually built our own investor network, how we've curated the companies that we've come across today, and also how to actually be super efficient at it as well. So for us, this is the opportunity that we're bringing to Singapore, because as I said, everything we do now is about bringing ecosystems together. And effectively, we've already started this in Australia, Singapore's next, and then after that, the UK as well. So there's two approaches that people could be considering. It could be the direct sort of product offering, or it could be how you can actually complement it to your existing services and what you do. For us, people do know us for the venture space. You will note that if you go onto our website, we do have a range of different opportunities right across the private market space, whether it be venture, angel, private equity, yield-based opportunity, digital assets, credit, debt-related opportunities. Every type of fund we have as a client at the moment. We will, in the next few months, we'll be looking at the business sales area for companies looking to exit. And then obviously you'll see today property as well. So we cover the whole range of different opportunities. I said, whilst today is mostly focused around the venture area and property, just know and venture, property and funds, I should say, just note we cover all those different areas. And then obviously for most of you would know, what we really want to help channel partners do is not just build a business around this area, but then also create for other financial opportunities for themselves, whether it be around transaction fees, syndicates, etc. As I said, the whole purpose of us doing this is to empower the ecosystem to actually collaborate, engage, and provide investor access. For too long, this entire space is mate who knows mate introduces to other mate, right? And as one of my shareholders said quite eloquently, you can either do it the human way or you can do it the technology-enabled way. And I think we all know what has greater scalability. So for me, so that's on the opportunity side. Here's why I'm excited about the next 5 years. This is my thesis, and this is why, if you think about the way in which we're architecting WI, it's because of this. The first one is the role that AI, software, and platform technologies can play is infinite, in the sense that the next conference we're actually going to name it the Era of Abundance. And the reason is all of us, how many of us are already using generative AI? I'm sure most of us, right? Who's not, out of curiosity? Wow. One person. It's always good when a shareholder's not using AI. For me, it's been one of the greatest implementations into our business. What I love about software and what I love about AI is it expands human potential. It expands human productivity. It helps us tap into things that we didn't know we were capable of. And it simplifies things that were previously too hard, right? And I give the example of when I understood the power of ChatGPT was when it was actually when in November, it was 2 days after it was released, I was doing one of the first things I got it to do for me is I got it to do a press release for our Emergence Conference, which is the biggest thing we do each year in Sydney. And in that press release, I asked it to write I put in the details about the conference, and then I asked it to write it. And I couldn't believe it that within seconds, it wrote almost a perfect press release, and that was on the first version. And then what was so important for me was because the year beforehand, I had 2 staff work on that across a week and a half, and I still had to spend 4 hours changing it. So it was at that point, I knew what the potential looks like going forward. And the reality is it has the potential to expedite what we do by 300 to 500%. So what does that mean for companies going forward? What does that mean for the future profitability of companies? Because even though venture has been down for the last sort of 18 months, this takes everything to a whole nother level. To scale companies to the size they did before, you don't need to hire the massive amounts of people you did beforehand, and the best part is it's getting exponentially better. The next part, the Bitcoin halving next year, aimed to take place at the end of April and early May. We all know what typically takes place after the halving, right? So for me, I'm doing everything possible to position ourselves to take advantage of that as an opportunity, right? We've seen it for the last 3 cycles. So it's highly probable to come again. So we may as well take advantage of it. So if you combine AI and its exponential potential, then the Bitcoin halving. And the funniest thing is, I know last year, in 2021 and 2022, we're talking about Web3. Has everyone else started hearing about Web4 already? Right, where people are talking about the merging of obviously crypto and also AI. That's interesting. Next one, the S-curve technology adoption. All the platform technologies that I'm talking about that are actually featured in today, whether it be energy storage, whether it be electric vehicles, whether it be genomics, they're all hitting their S-curve technology adoption. We're hearing that early adopters and that early majority stage, which is where most of the money gets made. They are all hitting that phase of their actual cycle. Solar energy is now cheaper than actually sort of fossil fuel-based energy, right? It's past that milestone. Electric vehicles have crossed now sort of 5 to 10% of purchasing, which means that over the next 10 years, don't be surprised if then all of a sudden we see 80 to 90% of vehicles on the road as electric vehicles. Think about all the money that gets made on the fringes of that. And once again, that aligns with the renewable energy infrastructure as well. Next one, Wright's Law. The best part about all these platform technologies, and this work is from Kathy Wood from ARK Invest. I recommend doing a deep dive into that. I'm sure many of you already have. The best part about it is going to get cheaper for every single one of us to service our clients. Every unit of manufacturing that we're going to put out as we actually scale our businesses is going to get cheaper when you bring all these different components together, right? Especially when you're incorporating AI into it and robotics and genomics and so forth. Genomics is the best case for Wright's Law. And then the last one, network effect. The most beautiful thing about right now is every single one of us, whatever we're doing, we can access millions of people via different social media platforms, business platforms, or platforms in general to go connect with our end clients or build networks or build ecosystems. So for building a business now, there could not be a more exciting time going forward. And it's a crazy thing for me to think about sort of after 14 years of business. I genuinely believe in the next 5 years, more wealth will be created in the innovation space than was created in the last 15 because of all these factors combined. Now, here's the different part to it. There should also be the most profitable companies in history being launched right now because of those factors as well. And we all know, as I said, AI and software will improve, and the platform technologies will improve at an exponential rate because they align with each other. So for me, the reason why I'm very motivated about this next 5 years is all those different 5 factors combined. And, for us, obviously we as a company, we want to be at the forefront of that. We want to be empowering it. We want to be promoting it, and we want to be engaging everyone with it to help make money across all different areas. At the end of today, we'll be sending an email out sort of after the event. If you'd like to express interest or learn more about the channel partner opportunity, either come and speak to me during the day, or you can send me an email. You've all received an email from me over the last sort of couple of weeks, maybe just 1 or 2. So feel free to email me via that as well, and then we can have a discussion about it. So for me, from the entire Wholesale Investor team, and you'll see them working hard out today, especially the likes of Rhythm and Jackie have just been phenomenal in sort of setting us up. From the Wholesale Investor team, enjoy today, meet with all the companies. There's some incredible CEOs here. They work 24/7 to build their businesses. Every single one of them, as I said, has flown to be here today. Take that time, enjoy, and said you'll meet some incredible people. One of the beautiful things about our event, you'll realize that you walk away today, as much as things have been depressed for the last sort of 18 months, today is a beautiful bubble of optimism, right? And you'll notice that when you walk out of here today, you'll feel slightly elevated because of all the good conversations you've had. You won't sort of quite know why, but that is why I love what we do. Thank you. Enjoy Venturing Capital Singapore.
Hi everyone, welcome to Venture in Capital. I'm your MC of the day. We're really excited for a morning filled with insightful discussions, impressive presentations, and outstanding speakers. Throughout the course of the day, you will hear from some of the most innovative companies and knowledgeable speakers in this space. It's time to hear from our first set of speakers. Please join me in welcoming Guan Tay, Managing Director of Customa.
My name is Guan Tay. I'm a Malaysian-born Australian, trained in Australia as a molecular geneticist in the transplant field, and now working on a medtech project for a very close friend of mine who's a surgical oncologist that lives in Perth. It's an opportunity for me to talk to you about our tech, but it's also an opportunity for me to advocate for a very small group of people who live with a stigma. They put up with a lot of shit every day. The people that I'm referring to are ostomates, right? People who basically walk around on a daily basis with a waste disposable unit on their abdomen. These stomas, these little holes that surgeons place in their abdomen, are a result of disease. So they don't only have to live with the burden of the disease that they are diagnosed with, colorectal cancer, for example, but they have to actually manage a waste disposable system that they have to carry around on a daily basis. These ostomy systems, there's about 1,200 Singaporeans diagnosed with colorectal cancer every year. So most of these people will actually get a stoma surgically implanted on them. So today, on this small island, about 2 or 3 people will be going through this procedure. So it's not an uncommon issue, but it's a very silent and very long-suffering issue for the people who actually get this stomas implanted, and for their families who have to actually help them through this process. Now, these waste management systems come in the form of what they call an ostomy pouching system. It's a bag that you have to wear, and between the bag and your skin, there is a seal, not too different to an O-ring that your plumber will use in your plumbing system at home, right? Now, there have been advancements. These bags have been around for at least 75 years. There have been advancements in the technology. The material has changed. It's a bit more flexible. Therefore, it's more comfortable. It creases a bit better when you bend over and you sit in your car, so it doesn't actually fold up and leak outwards. Now, the real issue with these systems is that they have remained essentially the same for 75 years, and they leak notoriously. As someone invented it 75 years ago, they've made gradual improvements, but it's still a generic product that you can buy over the shelf. So it doesn't make a lot of sense where you are trying to solve a problem that is fairly diverse. We're all very different. Our stomas are very different. But you buy your little O-ring from a chemist or a pharmacist or a hospital that is produced in a factory that is essentially a one-size-fits-all over-the-counter product. We have looked at this problem partly because of a patient that we had, and we've thought about the process of customizing the seal, not the bag. Our seals are bag agnostic, to actually fit congruently with the patient's peristomal region. We do this by scanning the individual. We print a mold, the white image over there, and we pour a medical-grade silicone seal, like an O-ring, and we put it into the patient. Now, I need to warn you that the next slide might be a bit graphic for some, so look away if you don't like to look at medical images. On the top left-hand corner is a severe stoma of a patient. It's a cavity. In the patient. At the bottom is where your bowel actually sticks out, right? So we've printed a mold, poured that pink seal, put it on, and you can see that we've actually created a nice even surface on the abdomen of the patient. Stuck it down with an adhesive, put the bag on, and that patient actually went on living with minor leakage, not major leakage. We've been working with hospitals in Perth, where I come from, in Australia. We've secured patents in major territories around the world. We're now TGA Class 1 approved, the Australian version of the FDA, and we're now working on basically process implementation in our little factory in Perth to produce it on a commercial scale. And we're also running a little trial so that we can convince the government to pay us for our services. Patents in the US, Australia, Japan, and Europe. The reason why we've gone there is because in these territories, the government pays. So in Australia, we pay for all these appliances for our patients, right? There's about 50,000 patients there. And every one of them gets about $200 a month for their appliances. So my objective as CEO is to actually get us on the stoma appliance scheme in Australia. We've ticked off 2 boxes. We're registered with the Therapeutics Goods Administrator. We meet a clinical need. We know we are better, but we've got to demonstrate it to the government. We've got to fill in a form and give it to them. And we need to be ready to supply. So we need ISO 13485 accreditation, which that we are now almost completed. Market size, there's 50,000 patients in Australia. Conservatively, we've estimated that 8%, those who really leak badly, will need our product. It's 20 times larger in the US, 14 times larger in Europe, and 3 times larger in Japan, where all our patents have been filed. Okay? So what motivates me to get up every day, trot off to work to do this, right? There is a real clinical gap. Right? Literally, there's a gap between the bag and your tummy, and it leaks. Okay, we have patented technology. It is listed on the equivalent of the FDA in Australia, and we're moving towards FDA in US. The government, who is a good paymaster, will pay for it, so you're not out of pocket. Unfortunately, in Singapore, you pay for it yourself. But that's why we've actually approached. Our strategy is to actually target Australia first, into the US, and then the UK, and then potentially into Singapore. And it's not an insignificant market. It's a small group of people, but they have a daily problem of throwing away products, right? So it's a fairly large market with a very small group of people. I get to wake up every day and work with talented people. The guy on my left and your right was the innovator. He was the one who actually came up with the idea that I need to solve this problem, because the first patient he did basically told him after the procedure, you know, if I knew what I was up for, I would have rather died and not had the procedure. So he started off this revolution. Okay? I also get to work with people who are in advocacy groups, in research institutes, and in hospitals throughout the breadth of Australia, and that excites me. So thank you. I know I've only glossed over very high-level information. I'm in booth 1. If you need more specific details, please do drop by, and I'm more than happy to take you through PowerPoints and presentations and more information. Thank you.
Next up, let's invite Richard Randall, the CEO of Biosignals Diagnostics.
My name's Richard Rendell, CEO of Biosignals Diagnostics, and we are on a mission to save lives using precision medicine and precision healthcare to predict, diagnose, and treat cardiac disease. It's a complex landscape, and heart disease remains the biggest killer, predicted to double within the next 20 years. Every 3 hours, a woman dies of a heart attack, and symptoms can be quite different to those experienced by males. No pains in the arms is sometimes one of those hallmarks. 2 out of 3 adults with diabetes will actually die of a cardiovascular event. And while we monitor for glucose reasonably easy these days, not so for ECG. Atrial fibrillation is the cause of 30% of strokes, enormously bad outcomes for people who actually suffer, but can be prevented. Chronic stress leads to all sorts of impacts and leads to cardiovascular disease. This is clinically diagnosed chronic stress, and it is on the rise worldwide. So we have some solutions to basically giving us this ability to get early detection. You see at the bottom there, the main point that we're making around all of those issues is that early detection through comprehensive and accessible remote ECG monitoring saves lives. So our approach is just about to be launched. It's a very small handheld device called ECG Me, size of a credit card. Drop by, get your ECG taken at our table, and it is a CE mark and TGA approved medical device, class 2A. It is directed at consumer, clinical and remote care. ECG 3Me is a 3-lead device, which is clinical use predominantly, and it is one of the first devices that we know of that will stream your ECG to the cloud 24/7. There is no other streaming services or devices. OmniMe is a future set of products we're working on, which is a body area network, small tattoo-like sensors. They're so thin. And we can do sweat analysis and those sorts of things, as well as high-fidelity ECG. All this sits on a platform which is based on Oracle. We house most of our stuff on Oracle. And you see a number of types of data in there which we triangulate in order to get that higher resolution of analytics. So the markets, from our perspective, we tend to fall into multiple markets. Some of it is digital health. Others are things such as mobile cardiac telemetry, remote patient monitoring. So overall, about 125 billion total addressable market, 28 service available, and then we think there's about $2 billion serviceable obtainable market. So the team, other than myself, I was covered in Forbes magazine some time back around precision medicine with a background in doing genomics as well. My co-director, Stephen Foy, is a cardiologist and he is associate professor. He is someone who has built and actually led cardiology centres in hospitals. Chris and Lexi's here today, come visit us on the stand. My advisory council, we are so lucky to have people such as Associate Professor Cheng Hon Yap. He is a teaching cardiothoracic surgeon and he goes around the Asia Pacific region doing teaching work for up-and-coming surgeons. Our go-to-market is fundamentally 3 different streams. And so from the clinical perspective, this rapid ECG assessment can be done in a clinical sense where your GP might put this in your hand, for example, while you're getting your 12-monthly checkup. And so just like your blood pressure is taken at that time. Where we are being used at the moment, we have about 150 odd devices out there in our pre-release at the moment. The program's been going for about 3 months. And that post-operative monitoring is one of the sweet spots for the devices used. So they basically give you the device in a post-operative sense. Pharmacies and medicines reviews. So it's interesting that the pharmacies approach that we have, in some countries, a pharmacist can actually do a medicines review. And for people who are older, who have polypharmacy, as we call it, so they're on multiple drugs for multiple comorbidities, can actually get reimbursed for that particular service, about $300. And using this device helps to detect adverse reactions to multiple drugs being taken. We have a database of around 300,000 people of over 50-year-olds, which we can pursue, especially around that over 50-year-old atrial fibrillation point. The general public tranche is really around disease prevention, but also health, sport and fitness. We're focusing also on the worried well, or as it's technically termed, the people with health anxiety and female health. The status and traction, so we are pre-revenue at the moment. However, we are about to open the online shop, and that is going to happen in the next 2 weeks. We have some Australian GPs, there's a Middle Eastern distributor we're working with through there at the moment, and so pharmacy services, as I mentioned before, in a number of different places. And remote and rural is where we particularly shine. As you can probably see, that remote patient monitoring is a very important piece that we can contribute to. There is competition there. Happy to talk about this if you want to drop by the stand. Yes, you see Apple Watch, AliveCore and the others in there. We tend to sit at a slightly different level to all of that because of the number of arrhythmias that we detect, the types of ECG tests that we do, and the fact that we can convert that little device to an on-body device. So you can actually use a couple of sensors and put it on for 24 hours. None of the others do that. So the business model, just taking those 2 near-term devices and, of course, little ECG-Me, direct-to-consumer, we've taken around 50,000, an achievable number over about a 3-year period. The device itself is $270 Australian, which we're putting in a $120 a year subscription with. And that leads us to that 24 target revenue and 5 million recurring out of just the 50,000. The doctor to patient is a little bit different because we actually supply that to the doctor. They actually put it on a patient, and then the patient is actually monitored for a period of time. And so that every time the patient uses it, it's 368. So that gives us about a 21 million targeted recurring. So just a reminder that it's a 3-horizon approach. We are already there with ECG-Me. We have the 3-lead device, which will be the first of its kind to be applied into clinical revenue. And then using the graphene sensors and the body area network, we will probably serve both of those devices through a very, very simple, non-invasive way to do extensive monitoring and multiple disease management. So we are raising 1.5 million on a 12.1 valuation and 12.5% of the company. So half of that will actually be expended on the go-to-market for ECG-Me and the product and development of the 3 leads device and further work on the platform. So that's us. That's the summary there. Thank you very much to Wholesale Investor. Thank you, Steve. Please drop by and say hello. Have a wonderful day, everyone. Thank you.
Next up, let's invite Thomas McLean, Head of Innovation at SNORETOX.
Thank you, everyone. My name is Thomas McLean. I'm Head of Innovation for SNORETOX and also scientist inventor of the technology I'll be presenting today. So SNORETOX is a small biotech company out of Melbourne at RMIT University, and our goal is to develop and commercialize the world's first long-lasting treatment for low muscle tone conditions, including obstructive sleep apnea. Obstructive sleep apnea is caused by an airway blockage during sleep. It's a very common condition. 3 to 5% of people globally have it. And at the moment, there's no available pharmacological intervention. The main treatment options at the moment are all device-based. Most people have probably heard of CPAP. It's been the gold standard for many years now. And although it's a very successful treatment, it's not desirable for most people who suffer from it. It has a huge non-compliance rate of at least 30% after 1 year and up to 50% after multiple years. And it's just difficult to sleep with. It's basically a hose on the face. I'm sure everyone knows someone who's had to use one at some point. And apart from that, there's other devices such as oral mandibular devices. I'm not sure why that keeps jumping forward, sorry. And surgeries, neurostimulators, and lifestyle changes. And although some of them work to various extents, there is generally agreed upon need for better pharmacological interventions. Another thing that we've discovered while trying to treat obstructive sleep apnea is this major breathing difficulty conditions in dogs, especially dogs with short face, such as bulldogs, pugs, French bulldogs particularly, which is becoming the most popular breed in the world right now. And they have a very similar condition to obstructive sleep apnea. The difference is they get it because of the structure of their face, and they actually get it while they're awake. So it really negatively affects their well-being. And these are incredibly popular, well-loved breeds. And in 2021, the FDA CVM, which is the Centre for Veterinary Medicine, actually gave us breakthrough status for trying to treat this condition in bulldogs. So our solution to all of these is based on tetanus toxin. Now, we're not the first company or first person to decide tetanus toxin has therapeutic potential. It's actually very similar to Botox, but it works in the opposite way, where Botox relaxes muscles, and that's how you use it to treat things like migraines. It's how you reduce wrinkles. Tetanus toxin actually tones up muscles or increases the muscle tone. Now, the reason this is useful to us is because with obstructive sleep apnea, regardless of what causes it, whether it be obesity, whether it be neurological problems, it's all the same thing in the end. It's an obstruction of the airway. So if you can find a way to keep the airway open during sleep, you can treat it. And the way tetanus toxin for us works is you inject it into the muscles in the lower mouth, and it just increases the tone ever so slightly. You only inject a very small amount. You're not trying to induce cramping or anything like that, just enough to keep it at a resting daytime tone while you sleep. Keeps the airway open, allows people to breathe. So the other part of the problem is we're all vaccinated against tetanus toxin, if not all, 90%. It's incredibly common, incredibly successful vaccination. We're very lucky to have it, but that makes it almost impossible to use tetanus toxin as any form of therapeutic. As soon as you inject it, the antibodies just wipe it out and it doesn't work. So our technology is a way to use it in people who are vaccinated. And we've been developing this for several years now. It's in the national phase of patenting in a lot of countries. It's actually been granted in New Zealand. It's ready for granting in Australia and Canada once we pay for it and decide when to execute that. And it's in the national phase in several other countries like the US, EU, and Japan, amongst others, and the review process is going very well. If you want more information, just come and talk to me afterwards. I'm happy to talk about the technology all day long. So in a nutshell, we see our solution in the human side of things administered by an ENT doctor or dentist in a standard in-chair consultation. It actually lasts for about 4 to 6 months. We've been treating bulldogs, a cohort of bulldogs, and so it fits quite well with the 6-monthly dental visits that most people should have if they don't. Our goal is to have a very small volume preloaded syringe to make it very easy for injections. And the way that it works in the small injections we give, it's local acting and long lasting. So we've been treating large mammal model of bulldogs for obstructive sleep apnea, and in amongst this we discovered how well it works to treat the BOAS syndrome as well. So on the left is the veterinary BOAS rating, which we've been asked to use by the FDA, which is a way of treating the breathing disorder in bulldogs used by breeders and so forth. And we found that after treatment, all of the bulldogs we've treated so far have had significant improvement. This is the first 4 that was in a cohort. We've got 2 more in a cohort right now. And we also found that there was significant improvement in sleep disordered breathing in these dogs. Now I'll let you, that's playing at an extreme pace. But basically, this is Buddy, one of our most recent dogs who had a serious breathing disorder. You can see him struggling there. He couldn't make a 3-minute walk test. Sorry. After treatment, he's able to make the 3-minute walk test. His breathing's significantly quieter. I can show you the video out at the table if you want to see it at the normal speed. It doesn't really do justice to how much he's improved, though. We visit his owner on a regular basis, and she actually used to walk him down the driveway and used to carry him back after about 2 minutes walking. And when we last went out and visited her, which was 10 weeks after our injection, he had just completed a 5-kilometre walk with her, jogging the whole time, and just about dragged her back. So the improvement we see in the dogs is absolutely incredible, how much it helps their health overall, not just their breathing. And in terms of sleep apnea, the sleep device market is large. It's growing in all countries, and a lot of that's due to aging populations, but also just due to better awareness of the actual difficulties involved with obstructive sleep apnea and how many side effects on your health it has, such as heart attacks, strokes, and various other conditions that all increase if you have sleep disordered breathing. And the veterinary market, it's a little harder to define. It's a bit harder to get data on, but there are a lot of these what's called brachycephalic dogs. They're very popular, they're very expensive boutique breeds. And we expect there to be a large market there for treating. And at the moment, a lot of them are treated with surgery, which has limited success and often only works when they're done at a younger age, whereas our treatment's been working on older dogs. And it treats some of the other conditions that go along with the breathing, not just the nasal problems. And it's cheap to manufacture as a protein therapeutic, and we expect to be able to make a significant markup on that. We have a very experienced team of directors and advisory committee who all work without remuneration at the moment because they believe in the product, and leads on to the money side of things. So at the moment, we're preclinical in terms of human research. In veterinary, it's a little different. We're obviously treating our target market at the moment, and we have a pathway through the FDA Centre for Veterinary Medicine. I just want to talk about a couple of deals we have coming up. We have a convertible note offer from Bridgewest Ventures to cover 80% of our manufacturing costs. We also have a $35 million USD pipe deal on the table from Gem Capital in New York, and we recently passed due diligence with their venture capital firm. Thanks a lot. I look forward to anyone coming and asking me some more questions out at the table, and thanks for this opportunity.
Right now, we have a pre-recorded video that is held by Dr. Jeremy Crisp, the CEO and founder of EpiAxis Therapeutics.
Well, good morning. It's my pleasure to be here. I'm Jeremy Crisp, the founding CEO of EpiAxis Therapeutics, and it's my pleasure to present on behalf of our company and tell you about our lead candidate, epiresitine. This is a novel and disruptive therapy for overcoming treatment resistance and preventing cancer recurrence. Allow me first to give you a little bit of background, some highlights on EpiAxis. We came out of academia in 2015 and have remained private ever since. We've been using epigenetics as our therapeutic modality, if you like, to monitor and provide a prevention strategy for cancer. We've got a lead candidate, epiresotide. It's targeting LSD1. It's a first-in-class, non-catalytic disruptor. It's got a novel mode of action. It's there to restore the transcriptional balance both in the tumour side of it and on the immune side of it. We run a very lean, capital-efficient structure. We collaborate with leading groups. We own all our intellectual property. We've got a highly experienced team, and we've raised successfully $4.5 million US thus far, and we're seeking to raise another 12. We're focused on nuclear LSD1, and you can see from the data there from the Human Protein Atlas, LSD1 is highly upregulated in a number of solid tissue tumours. And we've been focusing primarily on the breast, glioma, colorectal, and prostate. This is because LSD1 is a prognostic factor, and indeed when you've used standard of care therapies, you leave behind populations of cells that are highly enriched with LSD1. It's for this reason that we set out to target LSD1 with our novel strategy. Our vision, at the end of the day, is to make cancer a chronic disease. This is because we are disrupting the LSD1 CoREST axis, and we recommend this for combination therapy uses with standard of care for active disease management. We also advocate monotherapy for prevention as well as for long-term maintenance. This is because some cells may well resist treatment as they do, and therefore we want to prevent their ability to reseed and cause metastatic disease long-term. We've got extensive data behind our program. This has been supported by our cell line work, which has been largely focused on breast cancers with keen interest around the melanomas and colon cancers, our animal models. We've also got a lot of clinical data, both where we've harvested circulating tumour cells and immune cells from patients that have had various treatment regimes, as well as our pioneering phase 1 study. This is the first ever study where an LSD1 inhibitor has been used with standard of care. That showed that we could demonstrate in metastatic breast cancer patients the ability to restore this transcriptional balance. And in the process, we're able to demonstrate the importance of these biomarkers, LSD1, EGFR, FOXQ1, and SNAIL. That study, by the way, was published last year in Frontiers in Oncology, and I certainly recommend you have a read of that. Allow me now to introduce our team. We've got a highly experienced international team led by our executive chair, Dr. David Fuller. David was a pharmacist by training and then did medicine, a 30-year veteran in the oncology space. I'm a physiologist supported by our chief financial officer and Rob McGuinness, who is a leading expert in licensing technologies. Supporting us is Dr. Jeanette Wood. Jeanette is ex-Novartis, ex-AstraZeneca, preclinical oncology specialist, supported also by our clinical colleagues, Roberta Pilley and Alfredo Judillan, both oncologists, epigenetic specialists, giving us broad coverage in hematology and solid tissue tumours. And of course, Professor Pamela Munster. Pamela is an oncologist, epigenetic specialist, and she runs the phase 1 unit in San Francisco for UCSF. So collectively, we've got 4 MDs, 3 PhDs, just under 300 oncology trials this group has got experience with. And we've brought to market, both from an EMA and FDA perspective, 11 drugs thus far. Epigenetics is an emerging area, and it has attracted very strong interest from pharma. This is across the board from discovery, from preclinical as well as clinical assets. And the best illustration is the most recent transaction that Merck was involved with. It acquired outright the LSD1 pure play company, Imago Biosciences, for $1.4 billion, and that closed early this year. So clearly epigenetics is seen as a next generation therapy by pharma. So the question to ask is, why invest now? Well, we feel with the announcement of epiresotide as our lead candidate, it's an excellent point to join us, a very favourable pre-money valuation at $8.8 million with plenty of scope for inflection in the short to medium term. It's a first-in-class with a novel mode of action. We've got clinical data behind this candidate to support its use. We own extensive intellectual property with 14 patents already granted, and we're accessing to the emerging epigenetic market, which is currently valued at $1.5 billion and growing. So at the moment, we're seeking $12 million in 2 tranches. 2 US to get us into the clinic so we can have an open IND, and 10 to complete our phase 1 program. We expect to be in the clinic in late 2024 with our last patient out in December 2025. So in summary, we're seeking to raise 12 million. We've got a first-in-class LSD1 disruptor for rebalancing transcription both in the tumour side of it as well as on the immune side of it. We've got a lead candidate in epiresitide. We're raising funds for our Series A for our clinical program. This is to be positioned for an existing standard of care across solid tissue and hematological malignancies. We've got a very extensive granted intellectual property and a highly experienced team. We believe this is a compelling proposition for consideration. So we're offering a disruptive program with epiresitide. This has been positioned for prevention of treatment resistance and cancer recurrence. I thank you for your interest. Very much look forward to following up your expressions later after this presentation. Thank you.
Next up, let's invite Ms. Leslie Chong, the CEO and MD of Imugene.
Good morning. It's an honor to speak to you about Imugene. Imugene ticker is IMU on the ASX. So my disclaimer. So first off, Imugene already has some money in the bank. As you can see, 153 million just in June. We just completed a $35 million raise in 3 hours, may I add, and we're currently under an SPP. So roughly we'll have about 200 million in the bank by mid-September. We have 6 unique assets, but I'm not going to go through all of those. I'm going to talk about our new acquisition called Azer-cel. So Azer-cel is an allogeneic CAR T, and I'll go through that. It could be a little bit of an arduous process because it's quite scientific. We have 4 unique platforms. So roughly we have about 9 to 10 clinical trials in cancer patients. Excuse me. A little bit of pollen in there. We also have 4 scientific collaboration with various different biotech companies, as well as we're addressing the hugely unmet need of solid tumors, as well as now blood cancers, and we have 2 supply agreements from major pharmaceutical companies. So I'll talk to you about a little bit about what's happening in the field in terms of chimeric antigen therapeutics, which is called CAR T. So they're revolutionize how blood cancers can be treated in lymphoma and leukemia. As you can see to your right, 53 to 98% response rate. So if you went to the doctor and said, you know, I can pay the $500,000 price tag for these drugs, and if the doctor said you're going to get a 98% cure, you would definitely take it, wouldn't you? And this is what's happening in the revolution of certain kinds of blood cancer. So these are called autologous CAR T. And it's in blood malignancies. So we thought we'd do one better. We took on an allogeneic CAR T. This means off the shelf and on demand, and I'll explain that in just a second. But Imugene has a plethora of beautiful products that works in various different cancer types, especially in solid tumors. And now we will have a first-in-class allogeneic CAR T to be ever approved in the world as little as in a few years. And that's why I'm excited to talk to you about today. So this allogeneic CAR T cell therapy comes from a company called Precision Biosciences. They're NASDAQ listed and they're in North Carolina, USA, where I actually hail from and then moved myself to San Francisco to work at Genentech. So we have a worldwide license to this product and 3 additional asset targets. And we don't have to talk about that, but that just means more shots on goal. But we've already have FDA guidelines on the registration or to market study. So that's huge. FDA doesn't give out guidelines or formal or informal guidance on how you get a product approved. And I've already received this, so wonderful. We've also completed the manufacturing process. That's huge because manufacturing in CAR T is the thing that matters. That will be your stumbling block. If you can't get the drug, if you can't get your T cells generated in a manufacturing facility, then you really don't have a product, and the product is why it's so expensive. So we took on the manufacturing facility as well as the 55 scientists in that building in North Carolina, to my mom's pleasure. And I'll explain to you autologous CAR T. So autologous CAR T, if you're a patient with lymphoma and leukemia, you come in, you get diagnosed, and you sit in a chair for roughly about 5 to 7 hours, getting your white blood cells taken out so that they can tease out the T cells. The T cells are then taken to a lab and reformulated or regenerated so that they can put the same T cells back into you. So that means it's highly patient relative. You have to be a fairly healthy patient. Your T cells have to be in fairly good shape because it's getting re-engineered to put back into you. So it's a self, auto CAR T, auto, self. And then the job is done. The CAR T cells then go after your particular kind of tumor types. And this process can take anywhere between 19 to 42 days. During that time, a patient's likely to relapse or progress. They have to take steroids or other kinds of chemo to keep them alive until they can get their drug. It's an arduous process. Allogeneic CAR T, and especially our azer-cel, is taken by healthy donors. So healthy donors give their T cells. It is genetically engineered so that you are fitted for every universal match. So there is such a thing as donor and host rejection. With this, in our 84 patient, we did not see this. It's incredible. Allo CAR Ts generally have a rejection. This, because of our unique ARCUS genetic engineering product, we haven't seen it. So each batch then can be shipped, frozen, and then each batch can provide upwards of 15 patients. So that is on demand. As you get diagnosed, you can now get that product. This has already been dosed in 84 patients, and I can't wait to show you the data. So the major difference is between autologous and allogeneic is that auto, self, highly personalized. It depends on, and not everyone qualifies, even if you're diagnosed with this deadly blood disease. You get your T cells regenerated during the time of the leukapheresis process. You're quite weak. You could be in the hospital for days. You could progress. Whereas allogeneic, as soon as you're diagnosed, your doctor can give you this drug, this life-saving drug, at the moment on demand. And the manufacturing process for an auto CAR T is because it's your own T cells being generated. It could fail. They could go through the leukapheresis process again. Allogeneic, it's off the shelf, on demand for you. So the first disease we're going after is called diffuse large B-cell lymphoma. This is an aggressive type of non-Hodgkin's lymphoma. It affects roughly about 33% of non-Hodgkin's lymphoma. If you are diagnosed with this, you are giving weeks, maybe to a few months to live. So we think this is a dire unmet need, and it is a first-to-market strategy in terms of registering this drug to market. If you're diagnosed with DLBCL, the first thing that you'll get is this sort of toxic mess of chemotherapy and steroids to boost you. About 60% of the patient population does respond to this, so this is great. But now, those autologous CAR Ts that I showed you earlier with the 53 to 98% response rates in a clinical study, they're now moving up to that second line. After you fall off of auto CAR Ts, there is nothing else. So in cancer, you want to provide a number of lines of care because you want to live a lot longer. And this is an opportunity for us to get into because every patient that has ever taken auto CAR T will be eligible for our study. 84 patients have already been dosed with our product. Response rates. So we know this drug is active. In 61 non-Hodgkin's lymphoma patients, and some of them DLBCL, 58% response rate, and leukemia, 61% overall response rate. You do not see these numbers in solid tumor, unfortunately. You get something like 20 to 30 in a very short number of population. All 84 patients responded to this drug. So we know it's quite active. And even still, out of that 61 non-Hodgkin's lymphoma patient, 18 patients had taken auto CAR Ts, progressed or fallen off that disease, and took our drug. And look at that, 83% whopper of an overall response rate. That's incredible. No drugs have ever seen auto CAR T failures in this space. So that's why we're taking this to market. We will be the first allogeneic CAR T to be approved in the world. So the biomarkers are still there. Even if you progress off of a CD19 directed target, you still maintain your CD19 biomarker, meaning the protein that the drug is going after. And if you fall off of Yescarta, Breyanzi, Kymriah, these are all auto CAR T, roughly about more like 60 to 70% because more people are taking CAR Ts. DLBCL, about 30,000 patients get diagnosed in the US alone. Of those, about 33% fall off of the chemotherapy. And once they take the auto CAR T, you've got 60 to 70% rate of failures. And those are the patient population that we'll go after. If you just took all the accessible patients alone for the azer-cel in the US, we're looking at a 2.5 billion cells, peak cells. And once we're in the registrational study, we'll also go after some leukemia patients as well. These are just graphs to show you that DLBCL is only increasing in numbers because there's so many auto CAR Ts approved and taken up. So as little as 2018, the sales were 292 million. At 2022, we're looking at $1.8 billion sales. 2023, they're projected at 2.2 billion. All those patients, if 60 to 70% of those patients fall off of those disease, they have nowhere to go. So we have a fast enrollment as well as a well-established market size. So the guidelines that we received from the FDA, these 5 very well-known sites in the US have already agreed to participate. They're already participating in the phase 1B study. And as I said, the manufacturing process is laborious, and we've got that completely locked down. So this is my new facility in North Carolina. It's GMP compliant. This is the manufacturing plant that made the 84 patients worth of drug, and experts, the scientists and the engineers have already transferred over to Imugene. They all have Imugene emails. It's kind of funny to go from a company of 20 to now roughly about 100. So we have an existing product that we call OnCARlytics. It's an oncolytic virus that infiltrates into every known solid tumors, shuttles up or flags the solid tumor cells with CD19, and now we have control of the CD19 therapeutics that we want to combine with. So beautifully aligned with our existing pipeline, as well as dominance in the blood cancer space, as well as solid tumors. The timelines are swift and fast, so every manufacturing process has to be, process has to be FDA approved, and that's currently with the FDA, so moments away from receiving that, and we'll enroll swiftly into the expansion, and this is to validate the product as well as validate our registrational study design. So it's rock solid that we know we're going to go after auto CAR T failures that have not done well. They progress, they come on our study. So this is the patient population we're going after. And this helps us accelerate the overall corporate goal is for company acquisition. So CAR Ts have generally been taken up at phase 1B for billions, if not multiple billions. So we've got that acceleration. Partnering with big pharma, we have a few partnership with pharma, but we can anticipate further relationships, licensing technologies separately because we have quite a lot of assets, and commercialization. So this could be commercialized as early as in the end of 2026. Okay, I think that's the end of my presentation. Thank you.
Right now, we have the last speaker of our first company presentations. So now let's invite Brett Hill, the founder of Limestone Coast Brewing.
Yeah, g'day everybody. Oh, that's loud. So I've got the pleasure here of talking about, how as a business, Limestone Coast Brewing is, I suppose, renovating, transforming, engaging with the market in a different way to make money out of craft beer. So I'm sure, everybody's exposed. Everybody understands the whole beer market. It's a big market, 750 billion per annum. And the craft beer market segment is globally about 12%. Interestingly, in Singapore, it's about 3%. It's a $2 billion industry here in Singapore. So the market globally is dominated by the big players. Here you see Tiger, you see Carlsberg. You don't see too many of the craft breweries yet. There's roughly 12 currently operating in Singapore. But where I'm from, in the southwest of WA, we've actually only got a population of 100,000 people, yet we have 12 craft breweries, same as Singapore, and the turnover of those craft breweries is $77 million a year. So the interesting thing about the craft brewery market is that the cellar door is the place where the margins are made. When you're selling by can and keg, you roughly make 50 cents, maybe $1 a litre if you're doing really well. But when you're selling a pint of beer over the bar at a brewery at the cellar door, you're making 70 to 90% gross margins, because the actual cost of production for that pint of beer is actually only 70 cents to $1. So the problem that all the craft breweries have in scaling, so historically they've just gone for volume, so they have one cellar door, and out of that cellar door, they use a lot of their space just for the manufacturing process. And what that does is it limits your bums on seats. So if we had a craft brewery in this room right now, there would be maybe the size of this stage available for customers. And yet what we do with Limestone Coast is really, really different to that. So that one cellar door being the only place that the top line dollar is made is where really what we've done is we've split the brewing process, and we've actually cracked the code in that. Because the hot part of the brewing process, where we take the grains, we make wort, that's the very industrial part, right? So if you think about real estate in Singapore, obviously it's very expensive. Using all of that space for a manufacturing process is really, really inefficient. So what we've done, the team of engineers behind what we've done, and we've patented this process, is we've split the brewing process between the hot part and the cold part. And so we put the cold part into the venues. So this is our brewing hub that we've built in Malaga in the outskirts of Perth. And we ship the wort generally in trucks, in tanks on the, and when we build out our venues, this is sort of the footprint that we have, So we're talking 30 square meters where we produce the beer on site. And we have a very, very low, very small footprint for that. So this video is showing,
one of Perth's most exclusive
one of our
destinations, Point Fraser, has undergone a transformation and is fast becoming the destination to visit for great food and craft beer. And the latest arrival to this iconic location is the Long Neck Brewery. On the doorstep of the CBD, the destination is super convenient with free parking for the first hour during the day and then free parking at night. Day or night, Long Neck is well worth checking out. Brad, it's a spectacular venue. You've really done an amazing job, and it's the perfect place to come and relax, isn't it?
When people come through the door, they feel like they've taken a trip down south, and yet we're right on the edge of the city. It's absolutely brilliant. What was really interesting when we first started here was actually getting our brewery approved to make beer here on site over the river.
You guys created your own special IP, some technology that's made the difference, right?
Yeah, so the technology actually splits the brewing process between the hot part of the process and the cold part of the process. In our central brewery, we do the hot part where we make wort. Wort is unfermented beer. Yeah. So it goes through essentially the whole cooking process. In Long Neck Brewery here, over the river, we're doing the cold part of the process.
Yeah.
And this is where we add the yeast. This is where we dry hop. This is where we run all of those cold brewing processes. And we serve straight from these tanks. The flavors that you're able to get when it comes straight out of the tanks, and you haven't had to put it in kegs or cans and all that other logistics.
Well, it's closest to the source is going to give you the purest, best taste, isn't it?
Absolutely.
Yeah. So how many different brews have you got available at any one time here?
We've got 18 different taps on right now. And out of that, we've got 3 seltzers. And so again, we make those ourselves. So they're real fruit seltzers. We've got anywhere between 1 and 3 different ciders, again, that we make from scratch. And then we've got our core range of beers, plus we also throw seasonal beers and occasional beers in there as well. What makes us really unique, the art and science of brewing beer, the art is coming up and creating the flavors, but the science is being able to perfectly replicate them every time. we make the right water for the style of beer. We filter water down to its purest level, and then we add back the minerals true to that region or style of beer. And that is where that art and science merge. The best way to really work out whether this is a good beer or not.
Yeah. It's the taster. All right, cheers.
Okay, so what really makes us special is that as we roll out these breweries, we're doing them for a quarter of the capital cost because of the centralised hub and spoke model. Out of that, we've actually designed we've written every line of code, we've designed every part of the equipment. So we have this, a real natural hedge around our business that makes us, both with the patents and what we've got internally, very, very hard to copy. So we've proven this business model in Perth. We've got 6 venues currently up and running, and we've got 4 more in the pipelines, 2 of which we hope to start before the end of the year. We also contract brew and build for others, but that centralised hub that we've got can do 20 venues comfortably in Western Australia, but we're looking to expand that. Right? So just recently, like just last week, a venue in a Australian Venue Co. they were sold by KKR to another private equity firm. They had 220 venues around Australia, and they just sold for a market cap of 1.6 billion. Our cost to manufacture this is nowhere near that. So just quickly running through numbers, we're going back to those 70% gross margins. That's a nice number. So we're looking to raise $10 million to help us move to our next phase. I was on stage 2 years ago with Steve and Wholesale Investor, and we raised our target then, and have now, we've executed. So our plans on the raising is to keep growing into Western Australia. We've got 5 venues that are coming on board in Queensland, and then we're looking to expand into Melbourne. We are planning an exit for our early investors. Some of those guys came in with a 10-year capital gains tax-free period. So we've committed ourselves to list before the end of that 10 years. We're 7 years in so far. As founders, we're staying for the long haul, though. This is far too much fun. So out of our team, and I note that I'm at the end of my time, so I'll skip over this a little bit. But 2 of those guys are engineers that have run multinational companies. The other's a lawyer and a stockbroker who's paying for his sins. And I'm the entrepreneur of the team. We've won awards. We know how to execute. And what I'm really here today is just to meet everybody that that is here, and those that want to come and join us, great. But I'm looking forward to meeting you at the stand over the course of the day.
Now we have a very exciting panel on venture investment trends. Please give a warm welcome to our distinguished panelists. For today, our distinguished panelists include Xian Hui Tong, Executive Director, Investments at SG Innovate, Jacqueline Rachel Yee, Chief Investment Officer at ABE Capital Markets, Jeff Lin, Operating Partner at iGlobe Partners, Wee Ming Thu, Partner and Head of Investments, Digital and Sustainability at Leonie Hill Capital. And lastly, we are joined with Rufus Sorsa, Associate Partner at Ensler.
Good morning. Thank you everyone for joining us. It's very rousing to see such a big, nice, engaging audience. So today we have a very, very diverse and experienced panel. And I would like to let each of the panelists introduce themselves. And this panel has been put together so that you get a broad range of viewpoints and insights from government-related investment entities right through to family offices and exchanges. So perhaps, and also venture building partners. So perhaps we could start from my right. So Xian Hui.
Yeah, thanks a lot. Really excited to be here. My name is Xian Hui. I'm Head of Investments for SG Innovate. We're a Singapore government-linked fund set up about 8 years ago, primarily to look into what we would term as emerging technologies, but more specifically, emerging technologies with the relevance to the Singapore economy. So we will try to be the forward-looking or the canary in the coal mine when it comes to technology, making small early stage bets in technologies such as nuclear fusion, hydrogen, participating in the mobility transition, technologies such as this. We tend to be a bit smaller, of course, than the sovereign wealth funds, Temasek, GIC, that have a much bigger charter and responsibilities for the for preserving the wealth of Singapore. We can afford to be a little bit more risky with the kind of bets that we place. Areas of focus for us, obviously biotech, but more specifically cell and gene therapy, sustainability, but perhaps a little bit more on the energy side of the equation to enable energy self-sufficiency for Singapore. So nuclear fusion, hydrogen, the grid, decarbonization, agri-tech, in the areas of cultured meats, bioreactors, fermentation, and finally, advanced manufacturing, where we sort of cluster everything else, space technology, quantum, semiconductors, so on and so forth. Thanks.
Thank you. And then next we have Wee Ming.
Yes, very good morning to all of you. It's always very good to be back here. I think Wholesale Investor has been putting in place a lot of very diversified ventures, and I think we are very happy to hear that it's always running on an annual basis. And Singapore has always been a hub for investments, for finance. For us, we are one of the early family offices that is established in Singapore. You guys know recent influx of all this money coming into Singapore, setting up family offices. We are not strange to this. We've been doing this for more than 15 years. Venture businesses for us is always a constant upgrading because, as families putting their own pocket money to invest, they always look at what is the growth. But along the past 15 years, our exposure has told us that if you are not accessing to technology, if you are not looking into disruptive element, one of these days your asset will be displaced. And the fact here is that you can see that a lot of family offices, the young generation, are really trying to understand, learn how technology impacts their own business, how technology could be one of their growing pattern in formulating their investment strategy. And this is, I think, my opinion that this is where we should also learn from you guys in the venture business. Whether you're a startup founder or you're a venture capitalist, it's an ecosystem. And this ecosystem itself needs to have this collaboration among all the stakeholders. So we are one of the stakeholders. For us, simply speaking, we do not invest everything because we want to make sure that we are familiar in the space that we operate in. However, there are a lot of fund managers in the world that we invested in, from the US to Europe, of course here in Asia. And I'm very sure that some of you guys in the VC or even, you've got the experience in the venture builder business. We are here to work together so that we can scout founders that will be able to make a difference, not just in the industry, but we're talking about society now. We're talking about impact investing. And we like to be one of the forefront risk taker to work along this field. At the end of the day, for us, we do not believe in just returns. We believe in the balance. And this is where I think we are always looking ahead that, okay, if you've got the very exciting business proposition, you've got the disruptive technology, my third question to you is that how does this impact all of us, right? So I think these are some of the very practical way where there's a constant trend changing how investors look at technology, how investors look at technopreneur, and how investors will also look at picking the right technology to transform, if not to also revolutionize their business. Thank you.
Thank you very much for the very, very detailed and insightful briefing. And so next we have early stage VC, Jeff from AgLive Partners.
Yeah, thank you, Jacqueline. A very good morning to all of you, and thanks to Steve and Tim for having me here today. My name is Jeff. I'm with AgLive Partners. It's a Singapore-based cross-border early-stage technology venture fund headquartered in Singapore, but we primarily invest in both Southeast Asia, US, and UK. Firm has been in the market for close to 24 years already. We have been delivering a lot of good returns for our LPs over the years. For a firm actually in the market for more than 20 years, actually it says something by itself, right? Being able to consistent fundraise one by one. Our founding partner, Subun, was actually the one who back in 1988, together with Philip actually, they started Vertex, which is part of the Singapore government's technology investment arm actually at the time in Silicon Valley. So because of that heritage, we kind of over the years have been focusing on helping a lot of Western startups scale the business to Asia Pacific, but also helping some Singapore startups actually scale to other countries like Japan, for example, in other part of this region. In terms of technology sector focus we have been over the years actually investing actually primarily in more B2B kind of deep tech kind of domain. You can see that when I joined the firm actually more than 10 years ago, we started going into a field called synthetic biology. There's one actually the so-called sector actually today we actually kind of focus on a bit. And we also have a lot of focus on enterprise tech when it comes to AI, big data, data platforms, cloud services, software as a service. Actually, this is another sector actually we spend a lot of time in. And you probably heard about companies like Unity Software, right? So this is actually one of the winner actually in the category of so-called the games platform and also in the AR, VR kind of domain. So we were the Series B kind of co-investor back in the firm actually back in 2011. As for myself, I joined the firm like close to 10 years ago. And over the years, actually, I really grew along with the firm. Today, we have a much bigger firm, a much bigger team. And then when I joined actually 10 years ago, and I also have a couple of colleagues in the audience today. You can just go and talk to them during a tea break. Very nice to be here. And thanks, everyone. Thanks.
Thank you. Thank you, Jeff. And now this is very exciting. We work quite a lot with Antler, and Antler in terms of, it takes a village to build startups and get funding. I'm very happy to introduce you, Rufus.
Thank you, Jacqueline, for that very kind introduction, and thank you, Wholesale Investor, for having me here today and putting together such a great panel. My name is Rufus, and I'm an associate partner with Antler. Antler is a early stage venture capital fund, predominantly investing in founders. So what we do is that we like to work with founders from the early days when they're ideating, when they're forming their teams, and support them with investments all the way until Series C. We're a Singapore-based or Singapore-headquartered fund, but we've always been a strong believer in network effects. So that's why we've, over the last 5 years since launching, expanded into over 25 locations all across the globe. We have 17 active early-stage funds via We Deploy Capital, and roughly around a team of 300 employees globally. I think according to PitchBook, we were also the most active early-stage investor globally in Q2 of 2023. Obviously something that we're very proud of. And we hope to invest into more companies all around the world. A bit here in Southeast Asia, we're completely industry agnostic with on-the-ground operations here in Singapore, Jakarta, in Vietnam, and also we're launching Malaysia now in the coming month in October. Obviously, if you're a founder or you're an investor yourself, feel free to reach out to me and come to talk to me if there's a way that we can collaborate. We're a strong believer in collaboration, and hope to have a chat soon.
Thank you, Rufus. Just briefly to introduce myself. So thank you, Wholesale Investors, for inviting me again this year, and very good work by all the team. So I'm Jacqueline. I currently with AB Capital Markets. We are the capital markets business of Australian Bond Exchange. We are HQ'd in Singapore. We have a very, very powerful capital markets business that is currently working financial institution to financial institution. Our team can't be here this morning. We're busy trading, and I'm sure Nick is online viewing, listening to all the panelists. So as part of, the conviction to Asia and being an exchange, as part of offering investors a diverse range of opportunities, a portfolio range of investment opportunities and instruments, the AB Capital Markets and Australian Bond Exchange were expanding into asset management and still HQ'd in Singapore. And this will then enable us to bring to the investor community and also to the venture founder community and businesses here the opportunity to either participate on the issue side or on as investors to participate investing in a broad range. So we work on fixed income instruments, which means that investors will get a fixed regular return on their investments. The underlying substance of the fixed income instrument could be equities, could be debt, could be anything that we can monetize and securitize. So very interesting to be based in Singapore currently with the likes of SG Innovate and venture builders and investors like Antler and family offices. And it's such a rich ecosystem, and it keeps growing. The report is there are over 500 VC firms now. Private markets AUM has doubled in Singapore. The money is flowing in. Judging on Slingshot each year in the segment of green energies, technology and environment, we see cutting across all the segments, areas of industry is agri-tech, food tech, climate tech, biotech, and energy-related companies moving into the sustainability, the realm. And so it is a very exciting time now. Come speak with us, financial institutions out there, institutional investors out there, come speak with us. And also, family offices, come speak with us. We're growing into this broad range. Without sort of further ado, I wanted to kind of introduce a topic and get the views of the different perspectives from each of the panelists. So firstly, with Sian Hui, some of the areas you mentioned are very deep tech areas and getting investors involved and understanding the risk element and the risk characteristics versus the rewards down the line. For example, biotech, very closely linked to healthcare, and then marrying that together with the medtech type thematics. How have you sort of seen that change and that growth? And how has SG Innovate supported both the founder side and encouraged the investor community to come on board earlier?
How much time do you have? No, I think it's a good question. It's a very broad one. In terms of the biotech or the medtech sector, it has traditionally been one where a lot of the more traditional VCs have shied away from it. And to a certain extent, rightly so. I mean, it is long gestation periods. The outcomes are binary. We just had that conversation with someone outside. Outcomes can tend to be binary, especially when it comes to drugs. I think for medical devices, there's an iterative process that allows you to perhaps go back in. But ultimately, the drugs have to work. But I think, with COVID, with the opening up of the mRNA platforms, a lot of people are starting to realize that, more investments need to go into this sector. Some of the big drug screening organizations, the FDA, for example, are also looking at different ways in which they can fast-track certain drugs that they believe are likely to make a real impact on society. So I think there's a changing of mindset, especially after the COVID lockdown, when everyone realized, hey, this is not the traditional ways of doing things, probably will not work. Now, as an investor, I got to admit, I'm not from that sector. And when we were tasked to look into investing in that space, what we did is we did a very thorough assessment of what are the different milestones an investor would need to assess, from a funding, from a valuation, from a risk perspective. And ironically, we actually found that the biotech, medtech sector has the most clearly defined pathway to market. To a certain extent, you can almost plan it, based on the stage at which the asset or the research is at, and you can almost track its path all the way to market, and then assessing its market opportunity is also easier because reimbursement codes in the US have got a fixed figure attached to it, and you can sort of get an assessment of how big the market is likely to be, and you just work backwards from there to get a valuation. The big problem, of course, is at the very early stage, every scientist believes that his product is going to be $1 billion, so his company is worth $100 million, even though it's still at the in vitro or in vitro stages. And that's always sometimes the problem that as investors we face. We've got to bring them back down to earth and say, hey, you are here, your product is going to be $100 million of investment just to get you here, so don't ask me for a valuation that's going to kill me by the time I get to the top. So I think these are some of the things that I think investors are starting to educate themselves on, because they want to participate as well in this huge opportunity. From a SG Innovate perspective, and we are global investors, so we invest in other parts of the world because it would be very insular for a government to set up a fund and say you do emerging tech, but you can only invest domestically. I don't think the Singapore government is that has those blinders on. They believe that the best tech probably comes from other parts of the world as well. But of course, domestically, we try to help our researchers make that transition to commercialization by having programs in place where government grants are there to subsidize the de-risking of the science. In other words, if you have done some in silico modeling, for instance, of a particular protein, some of these government grants can be used to de-risk it to the extent where you can actually get some in vivo studies done and some clinical data that can actually contribute towards the commercialization. So I think those are the things that we have in place, and then of course programs where we would co-invest alongside these government grants so that there's always that commercial tracking of the science. Because sometimes the scientist starts here, the market is here. 5 years later, the scientist is here, the market is here. So we always try to bring the two together and try to not let the scientists run off and go back to the jungle where they came from. Okay.
Thank you very much.
It's always the case.
Thank you very much, Wee Ming. Yes, I used to be an investment manager for a biotech fund. So yes, the indications approval are very specific, and the risk, therein lies the risk. I want to continue on the thematic of impact investing, and we're very fortunate to have a family office fund on our panel. So we'd like to inquire, can you share with us insights into this segment? And you talked about this before, that you're very big on impact sector, investing in impact. What are the different areas you've seen that's come into that fold? So you mentioned energy transformation is coming to play, and that falls into the ESG space. I ask this because I'm so happy to see that this has taken a lot of traction. I remember doing ESG projects with the United Nations back 15 years ago, and it was so difficult to attract capital, attract interest. And then with COVID having occurred as well, and the renewed cognizant, recognition that health is also an impact area, and food security, the supply chain of food and health and energy are all intertwined. Could you share some of how a family office now views investing in those areas, and how you also co-invest, or do you co-invest?
Well, I should say that this is a very primitive stage for most family offices, especially in Asia, because a lot of the money, given that old money has been the wealth coming from very traditional industry, and property, real estate is always the darling of most of this wealth. But I'm very fortunate to be in a family office that the culture is different. So I've been exposed in Europe. I've lived in Switzerland for a few years and just got back. When you are exposed to a different environment, you are in a way being influenced into that environment. And being Asian, we are very, very commercial-centric, forward-looking, very dynamic. But in certain other places, especially in Europe, people are a lot very passionate in environment. And when you talk about passionate, they've got a theory to show you how passionate they are, aside of the commercial numbers. So those are the things that in the family office, I think, again, if I'm sitting now in the family office conference, I would encourage my fellow friends to say that, hey, you got to really go into other environment, maybe through your network, to go and learn some of those. It's a cultural stuff because there's many form of investments that we are always exposed to. So impact investing is a very tricky thing. While I was in Switzerland, I'm chanced to work with UN, the UN guys. So, the UN SDG, they've got various pillars for you the guidelines are there for you to get educated in a way and oriented. And then working with European fund managers, then you know that, okay, some of those things, even though today there are not many standardization still, but of course, there are other means to quantify the returns. So in Singapore, I know that, we are putting a lot of effort, or in Asia, we are trying to put a lot of efforts, trying to educate investors, not just in family office, what is really, we call impact investing. My personal opinion is that I would suggest, since this is a more founder-centric audience, I suppose, please, don't use climate as just a topic. Don't use sustainability as a topic. You've got to really ask yourself, that how are you going to make a difference? It's not about the technology. It's about how are you going to orchestrate the business logic that you've got access to a particular technology that you can create a differentiating factor. Need not to be a direct impact, but also it can somehow be a relation into an impact project. So I'm always intrigued by project that is not happening in, a city-state like Singapore. I'm intrigued by projects that is going into Cambodia. My guys in Geneva is doing a project now in Cambodia, doing, an impact project where, coming from a Westerner, you already put yourself in an Asian context, in the village, trying to quantify an impact project. So this one give me the sparkle that, hey, the founder themselves, they've got this passion because they are sacrificing, right? So in this kind of venture, it attracts people because you can see that the heart is there to create an impact, not just to use the language of impact, creating a commercial plan around and trying to fundraise. Today, a lot of investors are super connected to many kinds of projects. So please go down, really get down to where you want to do as an entrepreneur, how you can create an impact, and what are the resources you think that you can develop and you can bring together into an ecosystem for investors to put that dollar, to believe in you, to give you that runway, as well to constantly help you to fundraise in your future rounds, right? So I think that will be a sustainable model for you to really take part in impact investing, in my opinion. Thanks.
Thank you, Wee Ming. Yes. So focus on what solution you're bringing to the table and how you commercialize that solution so that the business becomes a going concern and is sustainable. And the beauty about impact businesses are you've got a triple bottom line. It's not just money. It's the other soft aspects as well. Quantify those. And that's where very good to hear impact investors are looking at that. So it will be remiss of me not to then touch on technology. So Wee Ming talked about the technology as the tool, right, to bringing the solution. So I want to then segue to, Antler and Rufus, where you bring together founders. You have a very rigorous approach in identifying high conviction founders and supporting early stage their growth. So both hands-on as well as an investor, if I'm not mistaken. And then we'll also touch on that with Jeff after Rufus.
Yeah, technology obviously plays a very important part in everyone's lives today. And as an investor and as a tech investor, it's critical to what we do, right? To your earlier point, what we try to identify is in founders are individuals or teams with kind of unique insights and clear spikes. This might be, domain knowledge in a certain industry or be an expert in a certain technology, having worked with that or being a researcher, etc. It plays an important part in our investment decision. So for us, it's important to couple the technology with the commercial acumen to create a for-profit business that obviously has, the potential to return venture, right? Meaning that it can scale 100, 1,000x over the next, let's say 5 to 10 years after we invest. Also to the earlier point just about impact and ESG, I think it's super important that, companies and founders, consider this when they're launching their own businesses. Nowadays, it's not so secluded that you need to be an impact company per se, but almost every single company here in the room or around the globe can have a positive impact with what they do, right? And we as a firm take this very seriously as well. We have a head of ESG and impact, Rosalind Basani, who's based here out of Singapore. And we also take all of our portfolio companies through impact and ESG training together with, a hard commitment to have this positive effect. Of course, it's very exciting to see the tech advancements that have been happening over the last couple of years, especially now in the post-COVID world, with a lot of analog bits, like industry is still digitizing themselves, together with, very cool advancements in AI and so forth. That brings a whole nother opportunity as an investor and as a founder. I think that's really what we're going to be focusing on moving forward over the next year or so.
Very interesting. Jeff, would you like to weigh in?
Yeah, I echo Rufus. Actually, I think there's the two elements. I think founders and tech are two of the most important drivers to drive this ESG forward, right? As we know, actually, even though we don't define ourselves as impact-only fund, but in many of our portfolio companies, you can see this so-called impact, right? One example is actually this Berkeley spin-off called Hue, H-U-E, actually, they're a color company, right? They use E. coli and engineer kind of E. coli to ferment and then produce the indigo, which can be used actually to dye your denim, right? So you may know actually a lot of indigos actually you're using actually for the gaps or other kind of mainstream jeans they're wearing today actually come from Inner Mongolia. Actually, they're producing it in very, very toxic and environment polluting way. And so this team actually in Berkeley, they came out to build this. It's never easy because the commodity price for indigo in the market is so low. So on the high side, we'll say probably this is not the kind of sweet spot they should choose, but the founder is very persistent. And in this case, right, because investors and founders, we are so determined to push these things forward, we'll be able to actually bring in leading ESG investors like Material Impact Fund, HSBC to come in to support them and bring them to the production scale, right? And I would say, I agree with being that material, so-called impact is not necessarily just to do with climate. You have opportunities to to make an impact in many, many different kind of industries and verticals. I give another example. You may know actually there's two companies, Databricks and Snowflake, are now tremendously successful, right? So they're the one who identified the trend actually to make data platform usage more efficient by encouraging more and more Fortune 500, 1,000 companies to move towards the public cloud, use data platforms, and use elastic computing to address the needs of all these kind of companies to kind of combine together. And they create value for shareholders. They create value to the environment by reducing carbon footprint. Because in the past, actually, a lot of companies really run the data platform on their own cloud. And this is actually the kind of thing can do, actually. The other example I can give you is actually, you may know that the failure rate for the biggest pharmaceutical companies in the world actually in the drug pipeline, the drug discovery process actually is very, very high. Companies squander billions of dollars and on certain pipelines which doesn't get the drug eventually approved by FDA. And you have a way to use AI or even with large language models and so on actually to help to screen and narrow down to certain targets actually we have much higher chance of success. You're going to be actually saving a lot of resources for the world. And the other thing actually I want to share, actually also want to add on to what Shen-Hui shared with you earlier. I mean, like, pharmaceutical actually is a very difficult kind of sector. I mean, like, the failure rate can be high, it's 0 or 1, right? And the other trend I can see in the US nowadays is actually, and there's certain ways actually leading investors, Arch Ventures, they kind of put together and to identify those platforms which can give you chances to generate a lot more useful pipeline in the early stage. And then straight away at the Series C or Series A stage, you're already pumping hundreds of millions of dollars to make sure they have the best resource, the best combination of IP to get it right. And all these kind of things will make the VC investment a lot more sustainable by itself. Yeah, that's what I want to share. Thanks.
Thank you very much. So with the time we have left, I just want to have a quick run through for one more aspect that's taken a lot of limelight in the investment world, in the asset world recently. So it's digital assets. I just would like to get everyone's quick one-line, two-line view on what your view is investing in this digital asset space. I'll start off by saying that, from a exchange and from an asset manager and from a capital markets point of view, it has been and is going to be very interesting in Singapore. There is a lot of VCC that's understood now globally, the Singapore Variable Capital Company framework. And now with Project Guardian, which is MAS's project with financial institutions on digital asset and tokenization, MAS has extended that into the VCC world, which is the fund world. So there is now a project on relating to eVCC, that's a tokenization, digitalization of VCC, and we'll be getting involved in that. So I'm very interested to hear whether the investor's perspective on this panel of the digital asset space.
So I get to go first.
Thank you.
Thank you very much. Well, I think digital assets are the future if they aren't already current. From our perspective, we believe that this is a long-term game, and whenever we see these long-term plays, we try to invest in not just the picks and shovels, but infrastructure as well. So if we believe digital assets are going to be replacing certain things within the more the non-digital world, then we have got to look into services that can support that, custodial services, exchanges, services to verify AML, KYC, that kind of thing. So I think lots of opportunities there. AI itself, or generative AI, or these large language models are throwing a little bit of a spanner in the works because they can totally distort some of the information that flows into the validation of some of these digital assets, and we have got to be wary about it. So that opened up a whole new area of investment opportunity for us as well.
That's right. Data sets are very, very important in terms of skewing the AI models. Yes, and Wee Ming?
Well, I always try to avoid this topic nowadays.
I'm so sorry. We can pass on, but would love.
It's so heartbreaking. Well, I mean, I'm not sure whether how many of you in the digital asset on this floor, but I would say is that it's really in a very bad. It's in a not a very positive landscape, in my opinion. Singapore is doing a good job. I think they're putting together all the right stuff to spearhead this, and I think this is a Singapore opportunity in the world. Do you need some water? You see, somebody is getting choked.
Sorry, no, because I know.
And I personally, I'm not very accessible to the Singapore project yet, but in Switzerland, I'm part of the Crypto Association. So Zook, where I live very near to, bunch of friends recently has not been very optimistic. I actually invested in a Swiss crypto bank. That is a very early stage. I got burned as well. So, and when I was back, I got in touch with some people that they are in the tier 1 exchanges, and they are all foreigners. I just find that people have exited their own personal share, and now they are branching into something else, this is not very healthy, in my opinion, because seems to be the incumbent. A lot of the incumbent had exited from their original position, and now they are doing something else. So I would say that if today you are in this sector, you have to really go back to the regulatory model. I think the only way to put this sector back on track is regulation. The risk in this sector is enormous. I think we've got experts giving us paper, and yet everybody of us, we are all being burned. So this has been a heartbreaking sector for me. But I hope that with Singapore, trying to drive this whole concerted effort, institution coming in, retail comes in, I hope we can see a light in the tunnel, and that can actually become a good case study to the world. But there has to be a lot of investors that has to be willing, LP coming in back into this sector. Otherwise, like every day, my email boxes, too many of these VCs are all, all over the world, calling private investors to continue to fund them. But it's going to be a very tough for now, right? So that's my take.
No, thank you very, very much. Very happy to hear that. It resonates with what I was actually speaking about back in 2019, that regulation needs to be at the forefront of this space, giving it the security to investors, that certificate of trust from being accountable in this space. And very quickly to Jeff and Rufus.
Yeah, so first of all, right, IGO Partners doesn't have a mandate to invest in the crypto asset or any kind of the other digital assets, but I would say we are a fintech investor, right? One of the three focus for ourselves, apart from enterprise tech and Simple Healthcare, is actually fintech, right? So we invest in digital bank in the Philippines, and myself actually have been in the payment and consumer lending space for a long time. I was involved in buy now pay later kind of stuff, right? So as a fintech investor, we have to stay open-minded and respectfully watching this sector, because a lot of people do believe that eventually some form of digital asset is actually going to be there. It's here to stay for sure, right? What I can say is here is probably we will pay attention to any of the enterprise tech which can be enabler or can be a service provider to players in this ecosystem to allow you to do better KYC, to be able to do better tracing. I'll give one example. We have a company in Taiwan. which is actually in the field of time series database. They're one of the 3 top time series database company of the world. The other 2 is Influx, DB, and also Timescale. So this one is called BigObject. And recently, actually, they moved the global headquarters here to Singapore. And the reason why they're here is because they won a very huge contract from downstream partner in China, right? So this database actually is very efficient for them to handle a huge amount of IoT and transaction data. All these are time series data. And so companies like this will benefit from the new generations of in-memory and data computing, right? So I'm sure that, there's a lot of innovations actually needed in order to improve, like what we mean say, actually, how do you protect, how to enable law enforcement to trace better about transactions and these kind of things. You need underlying technologies. Yeah, that's what I can say. Over to you, Rufus.
I think really kind of great points across the board. So Antler is an industry agnostic investor. So we do have, a number of Web3 and digital asset companies all around the world. Of course, kind of in 2023, the market for this space has cooled down quite a lot compared to 2020 or 2021. But nevertheless, I think it's kind of a interesting category with a long-term future for sure. One mistake that I've seen a lot of founders and companies make is, first of all, they're trying to force, this technology into a use case or a business that doesn't necessarily need it today. So meaning there's not a natural fit or need for it, right? So the kind of value proposition that they're trying to bring to market doesn't necessarily resonate because there's so many Web 2 type of alternative solutions or competition there that, are fighting for the same customer base. Then, a lot of these digital asset companies have also been very speculative. Of course, when a new technology comes up, everyone wants to capitalize on that, which is natural. But for me, it needs to have a clear use case, right? And clear value that it provides to, its users or customers for that matter. And, it's important that the right infrastructure is in place. So I think a lot of the consumer-facing applications have kind of disappeared. And a lot of founders that I'm talking with today, they're really focusing on the infrastructure, right? What can we do to support this for the next 10 to 20 years? Yes. And regulation plays an important part. Just yesterday, I was talking with a founder who's based currently in South America. And they want to come to Singapore and build here a Web3 company because Singapore is one of the leading places when it comes to Web3 regulation and support. So it's also very important that, or the part government plays here and just kind of the framework which these companies can operate within so that there's clarity and so that investors and consumers don't necessarily get, I get stuck with the bag, so to speak.
Thank you very much, Rufus. That was very structured in your answer. And I hope you've been able to get a flavor of the various different segments that have been quite interesting in the investment space, both on the founder side, the venture building side, as well as from the investor side. Please put your hands together and help me thank the wonderful panelists.
Thank you to all our panelists. I hope everyone gained some valuable insights from our panelists in the Venture Investment Trends panel. A great discussion on where things may be headed. It's now time for our second group of presentations. Please join me in welcoming Tim Freestone, founder and CEO of Alooba.
Hello, everyone. How are we doing? So I'm Tim, and I'm the founder of Alooba. Alooba is a data-driven platform that companies use to hire the best data and AI talent. And after our little chat today, go outside there, see our booth, just the first one out on the left, and you can see a massive CV there and a lot of swearing on our other little banner. So that's making it nice and attractive. Come across, have a chat to us about bias in hiring and how you can replace that with data. So basically, the way we view it, hiring for data roles is a big mess, okay? It's really full of lots of different issues. It takes companies on average 38 days to hire one data role, which is a ridiculously long time. And it's really expensive as well. So it costs companies on average $20,000 US to hire one data professional. This is whether they use their own internal resources or an external agency. It's really, really expensive. The problem is rife with bias. So from a candidate's perspective, they submit a CV that contains all this personal information, all this noise about a candidate that really the company doesn't need to know. Despite this long-winded process that's really expensive and goes on forever and is full of bias, companies still ultimately often make the wrong decision. So they'll often hire the wrong person. And the cost of a bad hire is really high. So it costs up to 2.5 times someone's salary if you end up having to replace them. That's a really big problem for companies. And so we've replaced all this bullshit with facts. So the way our product and technologies work is that companies can use them to automate away a lot of these time wasters and really get down to the objective facts of how good a candidate is. So as an example, in those early screening stages, instead of companies having to look through hundreds or thousands of CVs to decide who to interview, they can just give everyone a fair, objective, measurable assessment. And these are all customized based on the role. So they decide, what are the 4 or 5 skills that we really need in this role? Let's make sure we interview the candidates that have scored well in those assessments. Further down the hiring funnel, we also have objective interview products. So instead of doing more like a gut feel, emotions-based interview, again, getting down to what are the 3 or 4 criteria you're looking for and ruthlessly measuring those. So again, replacing all those feelings, all those emotions with facts to have a much more objective hiring process, one that's less subjective. And here's a little snapshot of a real dashboard. So this might be a little bit hard to read up the back, but basically this is a real dashboard from one of our clients who've been hiring a product analyst recently. And as you may be able to see, this company attracted about 1,000 applications. And if they'd done things in the traditional approach, they would have had to have read through all those 1,000 CVs manually, one by one, those CVs that contain all that noise, all that personal information about a candidate that the company really doesn't need to know. And instead of having to do all that, they basically just gave them a fair, objective skills assessment. And you'll see that around 5% of candidates proved they had the relevant skills for that role. So this meant that the company didn't have to read those 95% of the candidates that didn't have the right profile, they didn't have the right skills. So this obviously saved them a lot of time and effort in doing all that screening and ultimately reduced all those bad interviews that to go through. Having all those candidates who kind of looked amazing on paper, they used all the right buzzwords, they said all the big words, but ultimately didn't have anything to back it up with. So they saved a lot of time being able to just focus on those 5% of candidates who had the right skills for those data and AI roles, in this case, a product analyst. So that's on one side of the equation. The other side of the equation is, what about all the candidates who haven't written an amazing looking CV? Maybe they haven't added all the buzzwords, maybe they haven't jazzed it up, maybe they haven't exaggerated their claims. We have a way to objectively measure candidates and remove all that personal information. So you can see here, instead of looking at a candidate's name, which straight away gives you their gender, their ethnicity, you can figure out all sorts of things from their CV as well. We've replaced all of that with just a candidate reference code. So as a company doing screening, you basically just look at this and say, okay, cool, whoever this person is who scored 90%, who proved they had the right skills for this role, let's bring them into the interview process. So again, we're unlocking all these candidates that companies would typically skip over. And on our booth outside there, we've got a massive CV there. And I encourage you just to have a quick look at that and get a quick glimpse at all the types of biases that come into place, all the bits of discrimination that can really come to the fore at the start of that hiring process, just from a simple CV. And we've gotten rid of all of that. Who's behind Alooba? So there's myself, I'm the founder. And Alooba is really born out of my own personal frustrations as a hiring manager. So I led the analytics function at a tech company in Australia, now part of Booking.com. And I had all those pain points of having to read all these CVs, post all these job ads, do all these interviews with candidates who kind of looked amazing on paper, but didn't have the right skills. And so all that pain and misery has gone into our product. So our customers no longer have to put up with that. I also have another brand which is in the online testing space. This is more around practice psychometric tests for university students. So I've got a bit of experience there as well. The other half of our leadership duo is Adric. He's also here outside. So come and have a chat to him. He's got more than a decade's experience in managing and scaling technology and product teams, all the way from baby nascent startup to scale up and beyond that to large enterprise. And the products that he and his teams have built have in excess of 30 million active users. Now, it's not just us, so we're leading the business, but we've also got our team and we practice what we preach. So everyone who's joined our company has been through our own product. We've evaluated them in that same objective way. And I'm very confident in saying we would have hired none of them had we done it the traditional way. If we just focused on their CV, focused on the way they kind of pitched themselves, we would have missed all of them. And it's only through eradicating that bias and just focusing on purely, did they have the right skills for these roles, that we're able to identify these amazing people. So our hiring approach is simple. We just say, can we find the best person in the world possible for this? I don't care where they are, what their name is, how old they are, their religion, their race, just get rid of all of that and just say, who's the best person for the job? Now, the time is now for Alooba. We've seen already in the last few years a massive explosion in data, in companies hiring out and building data teams. This is across different industries, across different sectors, across different domains. And the normalization of AI tools like ChatGPT is only going to make this scale further. There are entire industries that are still kind of untouched, that are at the really nascent stage. So there's just so much room for growth. And so now is really, really about the time to scale this. Our revenue model is simple and straightforward for companies. We charge them based on the number of anticipated or expected hires that they will make in a year. This is really important because we don't charge them per test, which would give them maybe a disincentive to give every candidate the same opportunity. We just charge them a fixed fee per expected hire, and they can evaluate every single candidate in exactly the same objective way. From our current technology, we already have a good way to make pretty robust revenues from our clients. And what we're looking to do is increase that through 3 ways. So one is increasing that role coverage. And basically that means we're going to need to add more content to cover more skills so we can go outside of our core focus and then get more roles on board that way. We're going to have to make the product even better to make it even stickier and get that kind of internal adoption going on. And then as we build out technologies going up and down the hiring funnel, we can also charge more per role. We've already got some pretty happy customers. So some big names there across different geographies and industries. So Canberra and Woolies in Australia, Agoda in travel in Asia, and then Unilever's a worldwide agreement. And this is really exciting because this demonstrates that there's demand for what we're doing across industries, across geographies. And the companies are happy, which is great. And the other side of the equation has worked well as well. So the candidates are really important to this. Candidates and making sure that they're happy and they're on board and they feel comfortable with the process is really important to us. We survey all of them at the end of an assessment and we have more than a 90% candidate satisfaction ratio. So things are going well and now we just want to raise some capital to scale this. Our current market that we play in, which is the market for data and AI professionals, is about $8 billion and it's growing really quickly. And so we're disrupting this market. We fit in this nice little gap in the market here where we're focusing on data and AI roles specifically, and then we're also good at affecting change. We sit in this nice little spot where we're just really that data pure player. Most companies don't use any software to solve these problems. It's important to mention. We are backed by tech investors and angels in Australia. We've raised $1.4 million US to date. We've got a great advisory team. We are going to spend the bulk of our funds on sales and marketing and also double down on products and development. And in terms of our goals, so build out that sales and marketing function, build out that go-to-market function, double down on the tech that's gotten us this far, and then future plans, who knows? There's lots of other markets we can get into. The grad and intern market as one is really exciting to talk about. So just as a quick example, one of our current customers gets about 500,000 applicants a year to their grad program. And so they're looking to make sure that all those candidates have the right data literacy. Okay, cool. So basically our vision at the end of the day is to create a world where everyone can get the job they deserve. And we're really right at the forefront of this data and AI skills race. So this excites you, this vision, come out of a chat to us out there. We're just that first table out on the left where the big CV is and the swear words, so you can't miss us. Come out of a chat and talk to us about the future of hiring in data and AI. Thank you.
Right now, let's invite Jeremy Biggs, the CEO of Misio, to the stage.
Good morning, everybody. How are you doing today? Jeremy, co-founder and CEO of Misio, and just here to talk a little bit about what we're doing with corporate sustainability, very topical ESG, environment, social governance, and our view on how we can accelerate some positive change in the world. Steve mentioned earlier today this culmination of technology, and I'm a big believer of how AI can be used for good, and there are a lot of unintended consequences, social impacts and other things as well to consider. And my view is that if we can counterbalance this with really smart technology to help accelerate positive change, particularly for organizations in corporate sustainability, this would be a really good outcome for the world. So the challenge we have today is that we have $54 trillion of global climate risk. There's a lot of regulatory compliance coming to play here across the region in Singapore, but also around the world. And only the large listed companies, the top 150,000 organizations that are on stock exchanges today, have got the requirements to really accelerate this ESG in their organizations and do the compliance and reporting. This is accelerating. But we have 150 million organizations around the world. That's compounded with the fact that we have over 7,000 sustainability frameworks. Again, this is hopefully being consolidated over the next number of years with global compliance coming to play, largely driven through Europe. If you can imagine that you're an SME organization and you are wanting to pursue this pathway and you have pressure to begin, how do you start? And why would you start? Why do you care? And the reality is that most of organizations, particularly SMEs, don't have the time, they don't have the money, they don't have the expertise to start this. And I call it the too hard bucket. They just pop it in the too hard bucket and we'll worry about it later. So this is why we started Misio, is to help these organizations establish a unique sustainability pathway aligned to multiple global regulatory standards and output the reporting to multiple stakeholders as well. There's a lot of increased pressure from various different governments, from team members in your organization to investors. And just by show of hands, who's a VC or an investor in the room right now? Fantastic. And if you just think about this right now for your portfolio companies, which of your portfolio companies, even though they may be early stage, are actually progressing and pursuing an ESG strategy as a core foundation layer in the organization? You see, VCs and investors are the catalysts for change. This is what I love to talk about. And it's about how do we enable organizations with solutions that help their business grow commercially? What is the net economic impact and benefit to my company first? But ESG and sustainability is a core layer that needs to be included now as well. So we've got rapidly approaching timelines. This is actually something from Australia, but it's very similar across various different territories around the world. By 2026-27, we have a lot of what we call Scope 3 reporting requirements. This is about carbon footprint. Misio is more about across the entire spectrum. So it's looking at 1,000 different measurements and requirements. And my message to SMEs around the world is we have to start accelerating positive change today. We don't have to wait until there is a big stick in the room, a government is saying we have to do something. There's an immediate commercial benefit for the world and for our organizations to start right now. So our solution is end-to-end. The best way to describe who we are, we're almost a bit of middleware. We're first and foremost a collaboration workspace that invites external and internal stakeholders to work on various different sustainability projects. And our platform is able to generate a dynamic, tailored sustainability pathway and plan for any organization in about 60 seconds using AI. That's for any organization in the world. And then the output is really about what stakeholders need what information when and where. And then how do we help to use, how do we use technology like AI to automate that output reporting? This saves huge amounts of time, cost, and complexity, and allows organizations to report against multiple bodies. So you might be here in Singapore, but if you want to do business in Europe, then you have a different set of standards to consider. It's a great example. Being in Singapore, there's a couple of conversations I've had around validation of information as well, which I really appreciate. And this is key. Where is the evidence that a company is actually doing something or not doing something? How do we know this is true? We don't have enough talent, advisors, and people in the world to provide the assurance at the levels and scale that we need to. 150 million organizations, we can barely cope right now with 150,000 companies with their assurance and their compliance. We have to think about this smarter. We have got a really unique product called Misio Tile that not only demonstrates the public incremental progress the company is making, but we're also able to help validate this data, validate this information on which stakeholders care about this, and how does this narrative become part of my commercial growth driver. We've got some early traction, about 220 plus platform users. Our go-to-market is all through channels. So we want to be leveraging the collective intelligence, the advisory firms, the industry specialists with this solution as a collaboration workspace for their clients and beyond as well. My job is to take a company that has, let's say, 100 organizations that they're working with and enable them with a technology solution that helps them to work with maybe 10,000. And thus we can accelerate positive change around the world. So we're here today in Singapore, predominantly for commercial reasons. I'm really exploring what Singapore has to offer, and I've had amazing conversations so far. We are raising some capital to complete a seed round, which will be early next year. Love to have a conversation with anyone. But my key message today is really, if you're an investor or you are a VC firm, how are you empowering your portfolio companies with data, with the tools, the systems to help them grow and thrive? I'd love to have a conversation with you as well. Our mission as an organization is to enable 10 million organizations around the world by 2030. This is order of magnitude than anything else that exists in the world in respect to platform, scope, and scale. We've reverse engineered this plan and believe that AI has got a massive role to play to help accelerate positive change around the world. Our Misio tile product helps us to validate all the different stakeholders, who cares about what and where, and actually quantify and measure, does this narrative make sense? How do we change this into a lead indicator from a lag indicator? We've got a pretty large pipeline around the world. Global partners are set in play as well, and we're poised for some pretty amazing scale. Please come have a chat with me. I'm in the corner over here, just tucked away, but if you'd like to learn more, love to have a conversation. You can scan this QR code as well, and we can connect for a one-on-one. And that's it. Have a great day. Thank you.
Now let's invite Ray Montfort, Managing Director at Foresta Group Holdings, to give his speech.
Good morning. Yeah, Foresta is a New Zealand operation. We're an Australian-owned company. What we're doing is we're a manufacturer of energy. We turn pine. New Zealand's known for its large pine plantations, sustainable pine plantations. And we turn the pine into black wood pellets and chemicals. And these two products out of simply one process is something that we've patented it. We've patented the integration of these two products. We've patented the chemical extraction process. And so what we do is we get two bites of the cherry for our income, with the chemicals being slightly over about for 60% of the income revenue stream, and the coal replacement, the pine-based pellets being 40%. But the pellets, of course, are incredibly important as the world's trying to decarbonise. And the main thing that we actually, the issue that we solve is the ability to open and access existing sustainable sources of biomass at market rates, because in most the biggest issue that a lot of the biomass guys are facing is that they can't afford to actually buy the biomass on market, and so that wood gets used in other applications. So I'll just go through the products. Resins. So pine is known for its resin content. It's also known for its the fragrance of pine. And those two chemicals, we take them out first, and then we make the wood pellets at the end of that process. And those wood pellets, we torrefy them, which means that we actually increase the energy content and increase the density of the pellet to where it comes up to being the same as nice quality coal. And so it's interchangeable, and so the customer, this is very attractive for customers and energy users that are using coal as their energy feed. and we're targeting in New Zealand. We're targeting New Zealand local markets because New Zealand's government have actually outlawed coal from 2037, and every major company there is actively looking for a replacement. All over the chemicals are used in adhesives, flavourings, cleaning products. In car tyres, it's what the rubber and the steel belt on your car tyre, you need these resins are used in the formulations to ensure that the rubber connects with the tyre. Most of the perfumes that you're wearing, if you look on the label, you'll see it's Tapiniol 4-bar rolls or Borneols and things like that. They're all come out of the pine tree. Pine is the most sustainably grown tree on the planet. And what's neat about pine is that it absorbs carbon really well. So different plants absorb at different rates. And so that's what makes pine a very attractive plant to use for industry, but also to use for dealing with this issue of carbon absorption. From our perspective, we are just utilising existing plantations in New Zealand. New Zealand's got 1.7 million hectares of pine. They export for low-value logs compared to our process, 22 million tonne a year, and there's a further 6 million tonne a year of stumps. I'm happy to announce that yesterday we signed our 9 million tonne offtake agreement, supply agreement for a pine. We had an independent study done by Tonkin Taylor, which is a New Zealand engineering firm, Tier 1, and they came back with that utilising for our customers, utilising the wood pellets versus coal is a 95% reduction. What that means is that our first project that we are building down there in New Zealand will reduce New Zealand's entire greenhouse emissions by 0.5% on that first half factory, and the full factory 1%. And as we roll out across the country with the other 7 factories, there will be 7% reduction in the nation's greenhouse emissions. I'll mention the pine resource size, 1.7 million hectares. It's a lot, 40 million tonnes. You can read that for yourself. One of the just interesting notes there on that slide is that the stumps, we're one of only 2 companies in the world that can actually access the stump. And the reason we do that is it's really full of the chemicals. So it just adds us an extra boost, an extra kick to our yields. But what it does for the forest owner is it adds another 10 to 15% to the value of their forest, because they've now got something more to sell as well. Our processing technology, by having the 2 processes of the chemicals first, we bring the wood in from the forest. Actually, it's delivered by the contractors and the forest owners, and it comes in. We chip it up. We take it down to fingernail size, and then we use our patented technology to wash the resins out. We actually use the essential oils to do that, so we don't bring any other chemicals into the process. This is an entirely organic process, and it's one of a kind. It's the only one in the world like that, and we've patented that process. And then once we've washed out those chemicals, we then we steam out and we recover the terpenes that we used to wash those out, which is the pine fragrance, and then we compress and make the pellets. And then you make a white pellet, and then we torrefy that pellet, which is a process of basically gasifying the sugars in the wood, leaving us with a high intensity of carbon. And there's a look at the products. I've just got some of the torrefied pellets out the front. It's a little hard carting these samples around the world. I nearly got arrested going into Australia with those black pellets on the way up here because I didn't have an import license. I was like, hey, I'm just going to Singapore. They don't care. The process, look, we're all about the first project, and that's a significant one in itself, but there are 7 major areas in New Zealand where they have significant plantation pine, and these are sustainable pine. We don't use pine unless it's got an FSC attachment to it. And those plantations, a lot of them have been operating for over 100 years on a 30-year rotation. What that means is that they cut 1/30th of the forest is harvested each year, and they replant that 1/30th. And so, the forest has a range of ages from 1 to 30 at any time. And this is, important, obviously, when we talk about true sustainability and that sort of thing. It's just we're farming on a very large scale, and we're farming pine forests. These are the key points that I want to finish with. Tailored Energy Resources, offtake agreement for 2.4 million tonnes. They are the South Island of New Zealand's largest coal distributor. And as the process of them decarbonising their industry, because New Zealand, as I mentioned earlier, New Zealand has outlawed coal, so these guys' business is at risk. So we have, obviously they've got to provide to their customers an alternative solution, and so we're really proud to have signed that offtake term sheet, which has been converted, and basically on funding that will convert into a legal contract. And Yasuhara Chemicals is a Japanese company, as is Lotus, and those are for the chemicals. These contracts, if you quietly go away and do the maths, about $1.2 billion New Zealand offtake agreements over 10 years. We expect to be announcing significantly more than those in the upcoming time. So thank you very much.
Now, let me invite the next speaker, Alpha Solar Technology.
Okay, thank you. So I'm Kamal Alamay, the founder, director, and CTO of Alpha Solar Tech. So we are a technology company developing building integrated photovoltaic modules and systems. If you look at this image in the background, is actually a high-rise building and made of glass panels and then some marble tiles. If you can imagine that those panels are made as solar panels, then we can actually get this building to be a vertical solar farm. So we can generate electricity from the skin of the building rather than from the roof. So why we do this? We actually targeting, or we are addressing the goal of all the countries all over the world. Addressing the goal, the global goal is to have buildings in the future to be zero net energy and zero carbon emission. And then by converting high-rise buildings and urban infrastructures into vertical solar farms. So our photovoltaic modules can replace conventional materials. They are certain, and also they can be integrated or applied to existing building structures. This is a good example of building integrated photovoltaics. Look at this building and then think if we can replace those marble tiles and then those glass with semi-transparent solar glass and then solar facade modules, they look like marble, then we can power the entire building, and we can use the electricity to power electrical appliances in the building, and also we can store the energy to even charge electric cars, for example. And then we can also significantly reduce carbon footprint by generating on-site electricity in buildings. If you look at this building, the roof area is so small that you cannot actually install solar panels only on the roof. So you need the skin of the building in order to generate more electricity. Our solar or BIPV, building integrated photovoltaic products, they are all solar, they have different colors. They come with different colors. They can be used for curtain walls, facades, roof tiles, rooftops. We also have semi-transparent solar glass for windows, for balustrade, and for skylights. And we can also develop billboards that they are solar, and then road signs, and also noise barriers for we can install them along the freeways. We also offer solar footpaths where you can walk on them, and they generate power as they are illuminated by sunlight. Our technology is unique. It is patented. We call it a nano-layered micro-patterned ceramic technologies. We actually deposit ceramic nano-layered micro-patterned materials on top, on the cover glass of the normal solar panels. And then with our technology, we allow 80 to 95% of the sunlight to go through for conversion to electricity. And that's why our technology is it provides higher return on investment, because we are higher efficiency compared to the competitive, which we are at least 20% better than any other competing technology when it comes to developing colored solar panels with high definition imagery. And they can be designed to match any of the building materials, for example, marble, granite, terracotta, limestone, and any texture, arbitrary texture, and shade. This is important for architects and for end users to have the facades that they are solar panels. They look like exactly like building materials. Another advantage is the ease of installation. Our panels, they can be easily installed like normal glass panels because they are laminated glass panels, glass on glass, and the solar cells and all the colors are inside. They only have 2 cables and they can be all hidden into the aluminum frames of the building. We work with strategic partners. We have Nippon Steel in Japan. They are distributor for 5 countries. We work with vacuum technology, and I'll show you in a moment why vacuum is important. Vacuum glass technology, and then we have the thin film solar panel manufacturers, and then monosilicon solar panel manufacturers. We have the deposition of our ceramic technology is done by Glasspedia, and Modern Glass is a distributor in Western Australia and in Australia at all. We have different pilot projects at the moment implemented. This is a brand new building where the facade in the northern part is actually converted into solar using a charcoal colored facade and then semi-transparent windows. We have an existing facade where we converted it from a brick or a beige colored into a beautiful marble color, and then with some solar glass here. We also have a contract with Celebration. One of the outlets is a liquor store in Perth to actually convert it into marble look 30 kilowatt BIPV wall on the upper side of it. And we have another pilot project to do the L-shaped sound barrier or noise barrier for one of the shopping centers over there. We also have delivered, okay, so this is also a project which is a contract with the Kuwait University in Kuwait. It's actually solar passive room integrating our solar facade, the colored one, but they are double glazed with vacuum glass to increase the thermal insulation properties. With this type of panels, we can actually reduce the heat transfer at least 10 times more than what the normal glass can actually transfer. And this makes this one a passive room. That means it doesn't need air conditioning in summer and it doesn't need heating in winter, but also generates power from the solar panels all over the structure. And this is an example that shows how our solar panels, all colored solar panels and the solar windows can be integrated together into a facade or a curtain wall seamlessly. So you can see there's only silicon in between to hide the screws we use to connect them together. So we have a board of directors, expert in technical expert, and then Dr. Tim Song is an expert in corporate management, and then Maxi is in finance and investment. And okay, the milestone, we started the company in 2021, we filed the patent, and then in 22 we developed commercial scale products and we launched the products in an exhibition. And now we certified our products as building materials, and then recently as CEC to get some rebates from the government for installation. We are working on the pilot projects, and we intend to file list the company at the end of the year, start listing it. So hopefully mid next year we will be we have the full IPO. We have some MOUs with Japan and with Saudi Arabia for the NEOM project, and then with other countries as well. Okay, so the company has 85.2 million shares at the moment. We have no debt. We have $2.5 million in the bank. We are raising $3 million at 50 cents per share. The shareholding structure is 68% is owned by the founders of the company and 32% by external shareholders. Okay, I think that's it. Thank you very much.
Now, let's move on to David Briva, the founder and CEO of Geniux.
Thanks very much. It's great to be here today up in Singapore in lovely weather. It's great to get out of the cold of Perth. Let me tell you about our company. First of all, I want to make it clear that we're not a technology developer. We are a technology integrator. Genius's role is to facilitate the adoption of ESG, net zero, etc., into the property landscape. Our offer is quite simple today. I thought put this straight up. We're looking to raise $3 million. Why we're looking to raise $3 million? Quite clearly, the demand for our product being the integration of clean tech through the property sector, just in Australia alone, is increasing at a rate of knots, and we can't keep up with the demand. So most of this capital is going to be used to bring on more people. We have some of those people only on a contract basis at the moment, but we need to bring them on full time so we can meet our pipe. As you'll see through the presentation, we have secured a $300 million pipe on our confidence level at the moment. We know that there's $48 million that needs to be delivered over the next 2 years. The clean tech market's huge. So there needs to be people in the market that are going to integrate, not just invent. We don't deal in bleeding edge technology, we deal in leading edge technology. So one of those leading edge technologies that we're dealing in right now is not PV or solar generated electricity, but it's about thermal. We know the thermal market out there is 60% of the energy load. So why are we just dealing with electricity when we can deal with actually solar thermal, ground source thermal, etc.? Technology is out there to make this happen. We deal with clients who are doing this, who are delivering properties, and they need to deliver properties with high levels of net zero or ESG credentials to get finance. The whole capital market has changed. If you're not doing something to make the world a better place, then finance will probably not flow to you. We have a client who's presenting just after me who's been leading in this space with us back from 2017, and they're selling their properties each and every day. And it's really good. They've adopted the technologies at a rate of knots, and their buyers, and that's Griffin Group, their buyers are asking them the question, wow, we want to buy into these properties because you're doing the right thing. So net zero and ESG compliant is a huge, huge factor internationally today. Since 2015, when we started our market research, we just wanted to put the assets in place. And there's a lot of companies out there that just want to do that. But we've listened to our clients. They are so confused about the ESG space, and they're saying to us, I'm not going to do this unless there's a return for me. So we've put a new word into ESG. It's called economic sustainability. So it's ESGE. If you achieve the economic sustainability, then you're going to achieve the environmental and social sustainability as well. So the problems that we address, it's a complex area. And what Genius does for our clients is we make the complex simple. How do we do that? As I've said, it's about decentralized and distributed clean technology infrastructures. There's a typical model. There's people out there today that are calling large-scale wind and large-scale solar as a decentralized model. It's not decentralized. It's the same as a large-scale coal or gas generator. You open yourself up to so many risks called open market, called transmission risks through catastrophic failure, etc. We embed our technologies, our infrastructure at the point of consumption, and we contract directly with the end user. We don't open ourselves to the open market, and we definitely don't open ourselves to transmission risk to a level. Obviously, in some sites, we can't guarantee 100% self-sustainability, so we still need to rely on grid or scheme water. So the solution for us, as we've evolved today in 2023 from 2015, is we will sit down with our clients and take them on a journey. That journey is showing them the why in the consult process, and then showing them the how, and then the what, and then we guarantee them an ongoing return to their clients, their tenants, or themselves, and an ongoing facility management platform that they don't have to worry about. I can tell you right now, guys, there are so many solar arrays, be it rooftop or ground mount, that are underperforming because they're not maintained. And that's because the owners have just put them up there and forgotten about them. This is a simple model that we're running through. That 25% is now 40%. We're doing this on the East Coast. It's gone from 25 to 40% saving because as at 1st July on the east coast of Australia, they had an average 26% increase in their electricity costs. Guys, we're not here. I'm not asking you to help me start up. We've started up. What I'm asking you to do is help me take this company to the next level. We've got about $10 million of projects that we're currently locked and loaded. We've delivered some of those, as I've said, with Griffin Group. We've got $3.5 million worth of assets under management, and we're kicking on. We're working with government. We're working with private enterprise. We're working across the board. We are achieving our zero of making the world and humanity a better place. We are achieving carbon emissions reductions. And the great thing is the carbon credits that we're generating are the highest quality because they're totally renewable. And today we have investors who are getting an 8% return on their money, and we're producing an 11% IRR across our whole portfolio. As I said earlier, we have a $300 million pipeline. We have worked over the last couple of years to have a very strong mission into the agricultural space because as part of our social dividend, we want to pay back in terms of food security and cost of living reduction. So as you can see, Geniux is not only about a bottom line, it's about delivering an environmental, a social and an economic outcome. Our revenue projections, this is our commercialisation. We've proven the model, we've proven the income stream. Now we're looking to grow the company. I can tell you we've already secured some contracts this financial year, which has surpassed our last year's turnover. We provide a distributed risk in terms of income because we source income not just from the infrastructure play, but from sales of systems, through our advisory services and also our retail products. We have a great and a very, very experienced team, strong board governance, both public and listed companies in Australia, industry, finance, sales and marketing, etc. Our team, there's over 400 years, or whatever it calculated in terms of these guys, all experienced in their areas of finance right through to project delivery. Our general manager of fulfillment was one of the 3 directors that rolled out the Bunnings warehouse in Australia for Wesfarmers. So umpteen experience. As I said, we're looking to raise $3 million today at 5 cents a share. And I've told you what it's for. We're looking to use the funds for a headcount growth. We've achieved our book with not much marketing. We go out there, we speak to people, there's a high level of interest. And as I said, our book sits at 300 million. So I think with marketing, you're only going to see that book grow. We have developed our own integrated utility platform. It's a software as a service platform. It's getting lots and lots of attraction. That's the jewel in our crown. This system goes from metering all the way through to carbon credit reporting. We're building on that in that we're looking to put that onto its own blockchain trading platform. We are wanting to list this company maybe in Singapore, it may be in Australia. So we put some money in there to get that sorted out and a bit of working capital. That just shows you the areas that we're focusing on with the resourcing. As I said, we're looking to list the company. That listing is targeted for June 2025. And as I said, we make the complex simple. Thank you very much for your time.
Now, the next speaker, let's invite Philip Ruff, Business Director, Asia at Griffin Group.
Hi, everyone. Thanks for your time today. Philip Ruff, as she said, I'm representing Griffin Group. We have a disclaimer up here. It's important to note that I'm speaking to you today on the basis that you are an accredited investor. Griffin Group was founded about 12 years ago by our current CEO, Greg Devine. We offer a licensed and high-yielding Australian fixed dollar lending product. So we call it Secured Private Lending, SPL. It's more commonly known as mezzanine finance in the industry. The funds we raise support our product, our development of our projects, and more importantly, the investment that you make into this product is secured by a group second mortgage. This is our project model. It shows the capital stack across the top of the model. In the top right-hand corner that you see, secured private lending, it makes up about 15% of the total development costs. If you look at the numbers that are on there, 1 through to 4 shows the funding going into a project. So we take equity, we take, it was usually from the developer, we take institutional debt funding, first mortgage lending, and then the secured private lending. That all goes into a special purpose vehicle. It flows into the development asset. It allows us to acquire the land and subsequently develop it. And then on the way out, obviously the bank or institutional debt funding, they get paid first. The secured private lenders get paid second. And then once they've all been paid their capital and interest, that's when the developer gets their money. We offer a fixed rate of 14% on amounts above $250,000. The investment terms run from 2 to 3 years, typically 3 years if you come in at the acquisition phase, and 2 years if you come in when we start construction. The principal and interest are paid at maturity, and it's a, as I said, it's a fixed term, fixed return investment. We've had hundreds of clients over the years, and majority of those, upwards of 85, 90%, continue to reinvest with us as we roll from project to project. It allows you to diversify and create wealth through Australian property, but without the acquiring the physical real estate, and you avoid the costs that come with that. As I said, each development is done in its own SPV. That's the grey box in the middle. So what that means is that there's no cross-collateralisation between projects. So the money that you put into the project is only used for that project, and the assets in that project are not used to secure any products outside there. At the completion of the development, you're repaid from the revenue that comes from that development. So when we finish, we sell what we've developed. At the end, obviously, if we haven't sold enough to pay everybody out, there's residual stock financing available to us, and that's at lower rates than what we would be paying our secured private lenders, and so we're highly motivated to go and refinance and take you out. Again, it's important to note that as the developer, we don't get anything back until all of the SPL money has been paid in full. Just showing the capital stack again here. Again, what we aim for across a typical development is 65% from our first mortgage lender, 15% from secured private lending, and 20% of equity from the developer. If we can't get the full 65% from our first mortgage lender, we have the ability to go up to 25% in secured private lending. It's important to note, though, that we don't exceed 80%. So as a developer, we always put in a 20% equity. The security that you have, it's a grouped registered second mortgage. It's an independent security trustee that holds that on behalf of all of the lenders. So you don't invest, you're not the only one in a project, you're one of multiple lenders to a project. And again, until all the funds are paid back to the secured private lenders, their principal and their interest, it's only at that point that the security trustee will allow the mortgage to be released, and then the developer can access their funds. So we can't even access our capital until everybody's been paid back. This gives you an idea of our development profile. So we've been going for 12 years. We've completed 10 projects. You might wonder why that's so small. It takes you a long time to get started as a developer, particularly when you're starting off. You've got to go and acquire sites. You've got to find your capital. We've delivered just under $100 million. I think I can read that correctly, in gross development value at the moment. We've got about $170 million of developments under construction. It's 11 projects. We've got a similar number in planning, total $190 million. So we've got heaps of pipeline coming down the track. And we're also actively looking for new sites as we go. We have obviously adding sites all the time. This is some of our completed developments. What you'll notice about them is that they're all very similar. We don't try and reinvent the wheel. We stick to boutique infill sites in capital cities. There are projects where we've basically taken a project that we've done in one place and almost exactly replicated in another, slightly different facade. And we do that over and over again. It may sound like it's very boring, but we just keep executing to what we do well. Here are some of the projects we have under construction. Again, you'll notice very much a sameness about all of those, right? We just keep doing the same thing over and over and over again. we stick to what we're doing. So in summary, there's 4 points that I want to make. We give you certainty with a fixed rate offering. It's simple. You're the lender. You're not exposed to any of the risk that we as the developer are exposed to. You have security over the development asset. So you get all of your money back, both your principal and interest, before we get anything. So we're highly motivated to make sure that you get paid and get paid in full. Lastly, as a Singaporean resident taxpayer, you only lose a 10% withholding tax to the Australian Taxation Office. If you're an Australian resident taxpayer, it's taxed as interest in the financial year in which it's paid. So thank you very much for your time today. We're outside on table number 5 if you want to come over and have a chat. We'll also be around at the networking drinks tonight. I live here in Singapore. I've been here for about 20 years. Our CEO, Greg Devine, travels up here regularly. So if it doesn't suit you to catch up today, any time in the not too distant future would be perfect. Thanks again. Enjoy your day.
Now we have the last speaker of the group, Bruce Anderson, the Head of Funds Management at Stronghold Investment Management.
Good afternoon, everyone. Thank you very much for your time today. I'm Bruce Anderson. I head the funds management team at Stronghold. We're a specialist property fund manager located in Brisbane, which is the capital city of Queensland, Australia. A property fund is where like-minded investors pool their resources to buy an asset that they probably otherwise could not afford and outsource the day-to-day management to a professional manager. What I want to talk to you about today is really the convergence of 3 factors. The City of Brisbane, which is looking at a decade of outperformance, the maturing suburban office sector underpinned by Queensland and Brisbane's growing population, and also a specialist fund manager, Stronghold, linked to a group with a 40-year track record in delivery. For those who don't know, Brisbane is not only the financial hub of Queensland, but it's also blessed in location. It's an hour north of the Gold Coast, an hour south of the Sunshine Coast, and it also has World Heritage rainforests and reefs on its doorstep. It's a city that's had big plans. We've been voted a top 10 lifestyle city in the past. And in 2013, the local council put forward their Vision Brisbane 2031 document, which was the blueprint for the city's aspirations. Since then, it's been delivering on that vision. We've gone through a period of unprecedented capital investment on infrastructure projects, tourism facilities, event and commercial developments. I might just make mention here, your guest speaker for the next session was a major contributor towards that development. Campbell Newman was Lord Mayor for just under 10 years and then moved to be State Premier. The infrastructure projects were really put in place to future-proof transit commerce connectivity. We got the second runway was completed, giving Brisbane the most efficient runway system in the country. The Brisbane Metro is due for completion next year, and the major Cross River Rail project took an overland bottleneck and created a 10-kilometre underground heavy rail system. Queensland is known as the tourism capital of Australia, and projects like the Queen's Wharf development in Brisbane will only do further things to underpin that status. You're probably all aware that Brisbane was awarded the rights to host the 2032 Olympic and Paralympic Games. And following that announcement, there's another set of projects to be delivered in the event venues. There's $5.1 billion worth of projects to be delivered in the second half of this decade. There's a good graphic there which shows that $1 billion a year between 2027 and 2030. And also, once mooted developments are now getting underway to revitalise the Brisbane CBD. So where do we see value? We see that the growth potential in Queensland should outpace Sydney and Melbourne over the next decade, much like Sydney did in the lead up to the 2000 Games. Economic theory tells us that where there's investment spend, there's jobs growth. Where the job grows, the population moves to, and population growth underpins pricing and value in real estate markets, and that's across all sectors. So with the CBD experiencing increased rentals, probably a little bit of congestion with growing population, we're seeing that move to the suburban office parks as a positive. That decentralised dynamic is not unique. It follows systems that have been operating before in Sydney and Melbourne with suburban office parks. How's non-CBD performed against CBD? Over the 5-year, 10-year, 15-year periods, it's outperformed. Probably not surprising, the institutional investors invest in the CBD at tighter cap rates due to the perceived lower risk. I'll talk about our systems in a minute, but we believe that we can continue to deliver those higher returns in a risk mitigated manner. We know that 85% of all metropolitan jobs are based in the suburbs. That's the case across all cities on the eastern seaboard of Australia. We've been honing our skill in suburban business parks over the last 20 years. We know what tenants are looking for. They're looking for accessibility, access to major motorways, but also the convenience of public transport infrastructure. They're looking for high quality but cost-effective accommodation and plentiful but cost-effective car parking. They're looking for amenity which is good to attract and retain staff. By way of example, Brisbane Technology Park is now home to 10,000 workers, 130,000 metres of space. It's just 10k south of the CBD, but it's now got an ecosystem there that can support a hotel, a conference facility, a gym, 2 childcare centres and a variety of food and beverage options. And they're looking for flexibility both in design and also in the approach the landlord might take with their changing circumstances. A little bit about the manager. Everyone who presents to you today will have a point of difference. We believe our point of difference is twofold. That's our specialisation into one asset class, but also a vertical integration. Our origins are slightly different to probably most property fund managers in that we grew out of a construction and development enterprise, of which the last 20 years we've been delivering institutional grade products for other fund managers. Our milestone property management capabilities grew out organically out of that business, and about 10 years ago we launched Stronghold. We saw that a lot of corporate IP went into design and delivery of a building. We saw a lot of effort went into finding a tenant, negotiating a lease. You'd know from your own experience the biggest risk in property is what you don't know, and we were in a position where we knew everything about these buildings. So we decided at that point to stay attached to those assets moving forward. So by keeping those strategic services in-house, in particular property management, we think we more effectively manage risk through our complete knowledge of the market, true costs of incentives, true cost of building a fit out, and control of those tenant pipelines. We've now grown to $250 million worth of assets that we manage on behalf of our investors. So in closing, I think as a resident and a business owner in Brisbane, I'm looking forward to the next decade. It's going to be very exciting. We think the continued push in population is going to underpin property values, particularly in our sector. We believe we're a manager that has access to off-market deal flow. We're aligned with our investors. That alignment is twofold. We co-invest in every trust that we launch. And the way we structure our fees is slightly different to some managers. We link it to distributions. That keeps us focused on keeping distributions up. If there's a vacancy, we feel it at the same time that investors feel it. So we're set up outside. So if what I've talked about today, the macro theme of Brisbane, the maturing suburban office market sector, and our experience as a manager is of interest to you, then please come and have a chat to us. Thank you very much.
Up next, we have the privilege of welcoming Campbell Newman, the Chairman and Managing Director at Arcana Capital. He will be taking the stage to delve into the compelling subject, navigating the Australian commercial property market, insights into acquisition, distribution, and divestment strategies.
Well, thanks very much. Good afternoon, ladies and gentlemen. It's a great pleasure to be here. I really endorse many of the things that Bruce has just said to you, but I'm going to take a bit of a trip sort of upstairs looking across the nation. So Arcana Capital will be presenting later on this afternoon just after 4. So I'm not really talking about my firm at the moment, but I'll be talking about, again, the trends and the environment in Australia right now in property. So firstly, why invest in Australia? So this is the sales pitch. I'm also going to tell you the warts and all side of it as well. We do have a great legal system. These are international rankings from independent reports. It's a large economy. We have the 2032 Brisbane Olympics, which is a great story for Brisbane particularly. Bureaucracy is stable and clean, if I can call it that. A high median wealth per adult, and in the JLL World Rankings of Transparency, we're coming in number 4 behind United States, UK and France. The big message though is the Australian population growth. Currently sitting at about 26.5 million. By 2063, 40.5 million. In a 12-month period at the moment, Australia's population is going to grow by 400,000 people. It's a big public policy issue at the moment. It's causing great stresses and strains in the residential property market, but it is great for investors in terms of commercial property. Another thing to consider if you're a Singaporean investor is this chart. I remember as a youngster coming here back in the 80s, as a young army officer, seeing my friends here in the Singapore Defence Force. And back in those days, I can tell you what, the exchange rate was a lot better for an Australian. But what I'm trying to say here is the foreign exchange is going to work at the current time quite well for Singapore-based investors. There is quite a play on the exchange rate as that dynamic changes in the future. What's going on across the nation in the climate? What's the climate? Well, the RBA, our central bank, has put up rates by 400 basis points in a very short period of time, but they are getting some real success now in terms of beating inflation. The most recent numbers that came out yesterday had inflation down to 4.9 from as high as 7%. So it's now looking like there really is going to be a halt to those interest rate rises. They seem to have got it under control. There's the level of transactions. It's off the boil. It has been lower than in the period 2020, 2021. There is still plenty of foreign investment coming in. And there's the performance of the unlisted commercial real estate entities from publicly listed information. And that's compared to the real estate investment trusts. My big point here, though, is because of those interest rate rises, all asset classes have come off the boil. Cap rates have softened to varying degrees across different sectors within commercial real estate. The greatest softening has been in commercial office. I'll speak about that a bit more in a moment. That's one of my key take-homes for you. What's affecting the office, though, is sentiment, and particularly CBDs are being affected. And it's due to, I think, the major corporates and government bureaucracies being the sort of organisations that have had difficulty getting people to come back to work. Literally, our HR and IR policies in Australia have made it hard for the larger enterprises to actually get people back. There is therefore plenty of spare office desks around the place in our CBDs, and that has given rise to a requirement for less space. But that sentiment is right across the sector. Going back to what Bruce was just telling you from Stronghold before, that's where there will be opportunities. I'll come back to it. Industrial logistics, some softening of cap rates, but high rental growth expected. And in retail, it's a bit steady as she goes. Some areas have softened, some areas are tight and remain tight, quite remarkably so. So what I wanted to do here very quickly is give you my take on the biggest opportunities for investors in commercial property in Australia at the current time. The first one is the REITs. Now, don't take it the way I've put it up there. That's a little bit premature the way I'm pitching that to you. What I'm saying to you though, the REITs are in trouble. They are having to market assets at the moment, and there is probably more downside, but there is a time coming soon where the REITs will present great buying opportunities compared to where they were 2 or 3 years ago. So the patient investor, the discerning investor will monitor what's going on across the REITs in Australia, and when the timing is right, that's one to go for. Another way is to go in and look at the unlisted property trust. So this is where we are in Arcana Capital, or Stronghold, you've heard from Bruce before. And particularly that space has done quite well. And if I may say so humbly and respectfully, we've outperformed the big guys. We have attention to detail, we have focus. I'm talking across the offerings of various competing firms, but collectively we have that focus. We have that attention to detail that actually gets better value for investors. And if there is a qualifying entity being a managed investment trust, then Singapore investors, through the tax treaty and the like, are hit with a one-time 15% withholding tax on distributions being repatriated back to Singapore. And so that's the most beneficial place to be. But that really does depend on the product that the operator is developing. So you've got to look in and look at that. I'd also say, just amplifying what I've already mentioned about suburban office, this is a really big opportunity. Because of the negative sentiment, it's affected the whole, I suppose, of the office sector. The cap rates have softened by about 200, 250 basis points, and there now are fantastic buying opportunities. We, this year, have bought 3 suburban office buildings. The first 2 are fully occupied with a great mix of government and private sector tenants and strong firms, and no sign at all that those enterprises or organisations wish to downsize or vacate. As Bruce just told you, Bruce from Stronghold, it's about having great connectivity with the suburban road network, the motorway network. It's about having access to public transport, but particularly it's due to the amenity and car parking ratios. In the Brisbane CBD, the council will only let you build 1 car park per 200 square metres of lettable area, whereas out in places like 8 Mile Plains that he referred to, car park ratios of 1 to 35 square metres, 1 is to 50 square metres, and so forth. So the fact that you can provide great car parking options for staff really is attractive to those SMEs. Another point that I'd like to make, though, before I close, is in relation to, I suppose, the philosophy of investors. I said Australia was a great investment environment. Yes, it is relative to other jurisdictions, but let me speak frankly with you this afternoon. Sadly, in the last 5 years, many Australian jurisdictions have seen offshore investors as a cash cow. And depending on the jurisdiction, there have been increases in taxes and charges, land tax, stamp duty, on offshore investors. And it is quite varied. So you do need local expertise and great advice from lawyers or real estate firms when you're making investment decisions. But I'd also pitch to you, and it is a bit self-serving, it's better to come in to invest alongside Australian investors. If the deal is structured the right way, with the level of interest, you can actually sidestep these higher imposts of land tax or stamp duty. You can also ensure that you get better outcomes in terms of foreign capital gains tax, withholding tax, which can be levied on individual overseas investors. So I'd really urge people, as a final strategy thing to think about, it is actually, whilst you don't have that control, if you seek the right partner, if I can put it that way, it's great to invest alongside Australians in the way that I've said. So thank you very much. I'll look forward to your attendance after 4 this afternoon when you'll hear about the Arcana Capital story. Thank you for having me.
Now, lunch is ready. Please feel free to enjoy the food and the opportunity to meet and connect with your fellow attendees. We will resume the event promptly at 1:30 p.m., where we have an exciting panel on digital asset investment trends. So please be sure to return to your seat on time. Thank you.
Okay, so thank you for those that have come in. I was just telling anyone that's sort of in my range at the moment, when you're a conference organizer, you always appreciate the people who come politely back after lunch because it's always the hardest time to get people back into a room. So thank you very much for coming in. So one of the things I love to do at this sort of stage is that I love to sort of provide some insights into how we curate the opportunities. By now, you would have gone around and had a chat to a few of the companies, and you would have realized that it's actually different to most sort of conferences where it's working in this sort of area. In that, you know, most people, when they sort of come to an event like this, they're expecting, oh, it's sort of companies with an idea. The reality is the majority of the companies that are here today have already had millions of dollars invested into the companies. The majority of their teams have been there, done that experience where they've had successful exits, they've been involved in companies before. And we're incredibly fortunate as a position as a company that we come across opportunities like this and we get referred them by their existing investors as well. And this is a great opportunity, I said, for us to showcase Australian, UK innovation, and obviously, you know, local innovation as well in Singapore. So how we actually curate opportunities is really quite simple. The first part is we're always looking for we're looking for management teams with been there, done that experience. Right. The reason for that is it does make it helpful for you to understand what is the track record of the companies from their previous experience. The next thing we're looking for is sectors of interest, right, or the growth sectors. So typically you find in this space, and there was that great sort of TED talk, these names literally gone from my head, where they did an analysis of 200 companies that they'd invested into. And they discovered that some of their biggest gains with companies was all due to timing, right? And if there's a panel that understands about timing and markets really well, it'd be the digital asset trend. Now, the interesting part about this, we're always looking for areas and sectors that are of interest. If you notice outside, a lot of the companies are from, you know, either renewable energy tech, life science, healthcare, software, AI, etc., and energy storage, so forth. And that is logical because that is what is of interest right now. The next thing we're looking for is companies that have actually got shareholders that are recognized in some way, whether they be high-profile private investors or whether they be seasoned venture investors, professional investors, etc. And that becomes easy for us to articulate to you that someone else has already done the research, done due diligence on the companies, etc. Then typically with B2C businesses, B2C or B2B businesses, B2C, we're looking for some type of traction metrics. So we want to see how they've actually grown, even if it's in periods of instability. And then with B2B businesses, we're looking for, do they have blue chip clients or brand name clients that they're working with? So for an example, a company like AgLive, you know, my first conversation with them, I found out they've had 14 million invested into the company and they're working with some of Australia's largest beef producers. And they've just told me today, for example, one of their clients is the Carlton Ritz in Singapore because they want to verify where their actual beef comes from. Things like that become super important for us from an opportunity perspective. So if you want to understand why, when you're walking around, there's so many incredible companies and it's incredible what they're actually doing, these are some of the fundamental reasons as to why they've actually come over. So one of the important parts from my side when we're curating the opportunities as well is that I hope that you guys from the investor side can provide introductions also that could be relevant to them as well, because that is how this ecosystem's built. Now, the panel session coming up is a favorite of mine. You know, when we were setting our plans, you know, for us as a company, we had 4 key areas that we wanted to focus on. And obviously one of those was Web3 and digital assets. And the reason is for us, we've been super lucky. We were very, very lucky to be sort of early adopters of this in the area. And funny enough, one of the panelists in this actual next session was involved in that one of sort of early adoption. In 2013, we had this startup at the time basically come in and they were actually hosting, you know, capital raising meetings in our office. That company's now independent reserve. And we've got Lasanka here from there. And it's been one of the better success stories of companies that we've worked with. And we're super proud to be able to have worked with him. So, you know, for me as an area, I agree with HH from the earlier panel. I think this is one of the most exciting areas. I find it super hard to keep up with how fast everything moves, especially while I'm trying to keep track of life science, renewable energy tech, and so forth. And this is why I love these types of sessions. I want to hear from them what's coming up in the future, because effectively they get to see things from a helicopter perspective that I don't get to see. So hope you're all going to enjoy our next panel coming up. I'll let our host do the introduction for it. And I also hope that gives some context as to how we curate the opportunities featured today. Thank you.
We are now heading into the afternoon with some great keynotes, panels, and presentations. Next up, we have a forward-looking panel on digital asset investment trends. Please give a warm welcome to all our distinguished panelists today. We have Lasanka Pereira, co-founder and CEO of Independent Reserve Singapore, Lim Huijie, founder and CEO of Vision Group, Gan Fong Jack, founder and chief investment officer at Jollibee Capital Management, Clarence Chong, CEO of Custody Plus, and lastly, Sonny Mohanty, Vice President APAC at Nordec.
Okay, great. Thank you very much. And in our next segment, we're going to cover really the key topic on digital assets investment trends. Now, it's going to be the toughest time of the day because it's just after lunch, but I'm sure all the panelists will give a really exciting session today. So before we actually start, we're going to get the panelists to do a very quick introduction of themselves, and we'll jump into the discussions and hot topics very shortly. So starting yourself.
Thank you, Hajay. So I'm Lasanka Pereira. I'm a co-founder of Independent Reserve, an Aussie crypto exchange. So about 10 years ago, we walked into Steve's office, and Steve and team kindly let us present our big, crazy idea of building a secure, robust, scalable Bitcoin exchange to serve Australian customers. And in that, I think I was a kid in my 20s with a flowing head of hair. Lots happened, but in the last 10 years, we've kind of, served a few 100,000 customers, helped them buy their first Bitcoin and other crypto assets. We've done tens of billions of dollars of volume, and a couple of years ago, we got the very first license for a crypto exchange in Singapore. So so it's great to be here. We wouldn't be here if it wasn't for the the platform that Wholesale Investor gave, and so thanks very much.
Hi, good day to all. My name is Clarence. I'm the CEO of Custody Plus. Custody Plus is a MAS licensed custodian for digital assets. Custody Plus is a wholly owned subsidiary of VC Plus Limited, which is a Singapore-listed fintech company. So we provide safekeeping of digital assets as well as reporting capability relating to the digital assets for MAS or for other regulatory compliance. Thank you.
Hi, good afternoon, everyone. So my name is Fong Jack. So I'm the founder and CIO for Jollibee Capital. We are a MAS registered fund manager and started in 2015. And I have two funds that was launched in 2016 and 17. One's a tech fund, the other is a blockchain fund. So was lucky to be to launch a fund during the boom time of the crypto. And we have exited from the crypto fund, and I've done a few investments in different so-called securitized tokens and the normal unregulated tokens. So be happy to share some of the experience for some of the projects with you all.
Hi everybody, good afternoon. My name is Sonny Mohanty. I am the Vice President of Nordec for the APAC. So what is Nordec? Nordec is a layer 2 blockchain solution which is built on Ethereum. So we are EVM compatible. Maybe you've heard of Polygon. We could just sort of compare us with a Polygon. We are based on delegated proof of stake mechanism. Currently, we are a zero gas fee protocol blockchain solution and EVM compatible. Besides being a layer 2 solution, we also have a set of products from our ecosystem. The first being a crypto debit card called NorPay. We have a Web3 banking solution. Currently, we have received licenses from Lithuania and Switzerland for that Web3 bank solution. We also have partner solutions like a Swap a DEX, and a bridge solution. We are also building our own decentralized exchange DEX and a centralized exchange as well. So yeah, we are, if somebody is looking for a holistic sort of solution, then we are like one-stop solution for your blockchain needs. Thank you so much.
Thank you. And I'm Lim from Vision Group, and I'll be the moderator for today. So before we actually start and jump into the questions, I'd like to shed some light on the context of the cryptocurrency market cap and market over the last couple of years. So we first broke the $100 billion mark around the mid-2017, and within the same year, it grew to more than 8 times to more than 800 billion. 3 years after that, in 2021, the crypto market broke the 1 trillion mark and grew almost 3 times within the same year. Now we're just 3 years after that in 2021. What will 2024 hold for us? That's something hopefully some of the panels will give us some light into. At the same time, from a comparative basis, Bitcoin in terms of percentage market or contribution towards market cap grew from 2018 to 2023 about 39% to 46%, which is pretty all right. 12% to 18% for Ether, but for stable coins such as USDT, it grew from 0.24% to 7.5%, which is huge growth itself. DeFi market, 2018, 3 billion, 2021, and 173 billion. We are just now hovering around the 43 billion mark. So, as we go into the first question of the day, and as we all know, we're going to have elections tomorrow for Singapore for president. We'll be asking the first question in regards to regulation itself. So just 2 months back, MAS proposed a framework for open, interoperable, safe, and efficient digital assets networks. MAS is expanding one of its key projects, Guardian, where some of the major financial institutions such as HSBC, UOB, and UBS, Standard Chartered, DBS, piloting asset tokenization across both the assets and wealth management, fixed income, and foreign exchange space. So the first question very much to the panel, it's, in your view, how important is the role of the government in shaping the digital assets investment trends in Singapore? First to you.
Thank you, Lim. Yeah, so, I love the idea, first of all, that, tokenization, enabling big corporates, kind of scope to be able to build these products. I think that's fantastic. Tokenization of real world assets, I think, is going to be a pretty big theme over the next few years. This will create jobs. This will, attract more capital to Singapore. That's fantastic. I personally believe what got me excited about this space 10, 11 years ago was Bitcoin. It's just this unstoppable money with a provably computationally scarce asset. And I saw this as something that would improve human rights, enable people to hold their own value. And ultimately, this was a permissionless, decentralized network that anyone could participate in, build on, hold your value, and you're never going to get debased, and you can't. So this is the background of how I came into it. So I personally think that the faster innovation will happen on open, public, permissionless networks. But I think Singapore overall are doing a great job in terms of guiding the digital asset investment space. But I think that over and above that, I think what Singapore's done is it's created, it provides stable regulation, stable government, favourable taxation, rule of law, IP protection. So it's first and foremost a great place to build a business, raise a family. So I think these are couple of the key things that I think is great about Singapore. And I think Singapore is just going to thrive from the fact that it is becoming an even bigger hub for asset protection, where some of the other jurisdictions around the world are falling away. I'll leave it there.
Perfect.
Clarence?
Sure. I think any catalyst of change, whether it's business or social, brings implications. Implications, whether it's positive or negative. And involvement of all stakeholders is critical to ensure the particular new sector can evolve and develop without stifling innovation and adoption. So I'm very happy to have government coming in, giving guidance and advice. So the role of government is critical because it provides an environment that is for sustainable development of digital asset. Of course, the question will be what kind of parameters will be put into the sector without stifling innovation and adoption. Thank you.
Thank you.
Yeah, I echo Clarence and Lasanka's opinion as well. I think it is a big plus for government to be involved, to provide guidelines to help the sector weed out bad actors. From day one when I was involved in this sector, I've seen a lot of projects, and the moral hazard risk is actually very high, because when innovation is really being pumped up and a lot of players are coming in without any guidelines, there's the risk of people misusing the tool is very high and can be very, very damaging. Think of all the P2P lending at the time when there's a lot of tokenized lending platforms proliferating in the sector. So it's very important for the government to be involved. But I think it's just a balance. The innovation or the guidelines should not weed out innovators as well. So we need to encourage more entrepreneurs to develop, whether it's D-apps or DEX or NFTs or Metaverse. There's a lot of application. And as long as the guidelines are clear, then I think the whole sector and ecosystem will become better and better. So personally, I'm definitely for it.
Yeah, I think I echo to what my fellow panelists have just spoken. I think we've realized that we need government's intervention when it comes to crypto or digital assets, especially in Singapore, because I travel a lot. I've seen other countries as well, but Singapore is very different. I started my career during the ICO days back in 2017, when Singapore used to be like hosting investment meetups, and there was no clarity on what these ICOs are, what these projects are doing. But they introduced this Payment Services Act in 2020, and after which it was very clear that for a digital asset service provider, for instance, like a crypto exchange, to operate and do business in Singapore, you have to have this license. So government's involvement has been, has proven that Singapore is seen as a crypto hub, but it's unlike other jurisdictions where the regulatory framework is not clear, the mode of doing business is not clear. But with Singapore, I totally agree that things are very clear. And even when the initial coin offering ICOs were introduced, they also introduced the different guidelines for having ICOs. For instance, like a blockchain company, I can have a foundation here. There's a lot of legal clarity also there in Singapore. A lot of help is offered here to companies and startups, to entrepreneurs. For instance, we want to incorporate a foundation here. And we spoke to various people who are representative of government also. And they give us complete guideline how to operate here. If you are into crypto payments, or you are establishing a blockchain foundation here. So, and in terms of the anti-money laundering and the counter financing terrorism regulations are also very, very clear. So in overall, I would say government plays a very important role, especially if you are a digital payment service provider in every jurisdiction. But however, I think Singapore is in the forefront, as for me. Thank you.
Thank you. I guess it's always the toughest point on how we really balance innovation as well as regulation. But we all do know that once regulation do kick in, it shows the maturity of the specific industry and potentially how all the things actually come together. And primarily, I guess Singapore always holds towards its trust, towards making the place and ecosystem and infrastructure a safe place for people to actually be in. And that then is able to attract a lot of other people to come here. So on a separate note, just last month itself, Temasek announced that it would stop investing in digital assets due to regulatory uncertainty. And I think we have a great panel today because whether it's from an exchange, a platform, from custody, from a fund, from technology, so-called platform itself, I guess we want to hear some of the perspectives on how this news would actually impact the investor sentiments towards digital assets. Sanka, what's your view on this?
I think if you've kind of seen the potential of decentralized networks, permissionless networks, crypto, Bitcoin, blockchain, I think if you're a Web3 builder, you've got fire in your eyes, I think this has really no impact on you. But I think who it may impact is, I guess, you know, a small portion of the people that are on the edge, you know, that haven't quite looked closely enough in the retail. So we might see, you know, 100 million people that might come into the retail next bull market, you know, into the sector in the next bull market. News like this might affect like 10% of those people that might take a step back. But overall, news like this, I think, doesn't impact, you know, the mood too much. It certainly doesn't change the positive impact this can have on population.
Regulatory clarity is important for all investors, not just institutional investors like Temasek. You and I as retail would also want regulatory clarity on it. And in fact, this regulatory clarity not only applies to digital asset, in fact, it applies to all asset classes that investment is available. So the investors will need to evaluate based on the risk-return profile. Blessing in disguise is that regulations throughout the world now has more clarity because each government is introducing the framework. So it's just unfortunate the investment of Temasek ended up this way. I believe going forward, there will be more digital asset products emerge. And these products will provide attractive value propositions to different category of investors. Yep. Thank you.
So I would add that actually regulation is meant to protect investor, and especially unsophisticated investor, retail investors, and investors who don't do their homework, right? But the thing is, investors must learn not to follow the lead of any branded investors, without doing their homework, because there's a lot of herd instinct, kind of groupthink behaviors in the investment community. So just because there's a big branded company, investors that have invested in a particular deal, it doesn't mean that you should trust the judgment and the decision of the investor 100% and just follow suit. Unfortunately, in the investment community, there is a lot of such behaviors, and you always look at who's the lead, and if the lead is a good brand name, then the other co-investors will just want to jump on without doing any of their own deep dive due diligence. So I think this is a very good wake-up call for Temasek, right? And I mean, I worked with different Temasek companies in the past, so I've seen how the issues have impacted. When the investment team is on the ground, when they assess, sometimes the type of due diligence done may not be complete, right? So just because there's a so-called Sequoia of the world or the A16Z of the world, the big brand name they are in, the investors should not just jump in. So I think this is a good thing from my point of view personally. I think it's very good that we have such incidents blowing up, and all the institutional investors, family office investors, individuals, they should review how they invest. Right?
Don't do DD by proxy. Do your own DD, right, Fong Jack? Don't do DD by proxy.
Yeah, of course. No, because a lot of investors don't want to spend time to do their homework. They don't want to be the lead, and they always want other people to take a lead, do all the duty, do all the deep dive and evaluation, and just want to say, okay, are you in? If you're in, I'm follow you. So this is a very lazy way, and I hate it, right? I've been a lead investor in many of the deals, but I hate it when co-investors just want to jump on board and say, okay, if the deal fails, they point a finger at you. I say, okay, it's your fault, right? Because you didn't do a duty. But are you paying me? No, you're not paying me anything. You're not sharing your profit with me. You're not sharing the upside with me. And just to give you an example, in my fund, when I started the crypto fund, I had a few experimental investments where I invested in ICOs, right? A few of the ICOs. There are a few projects that I put in. Okay, I'll just give you an example. Some of these co-investors who put in with me, they put in $50,000, they get back $1 million within 3 months. And they pay me nothing, right? So they say, oh, you've done a good job, no, thank you very much, or you're so fantastic, can you run your next fund? So what are you paying me? You're not paying me anything. And they don't have the decency of offering some rewards. So it really opened up my eyes to look at some of these investors who are lazy and you don't do your homework just to take advantage of other people's hard work. Please don't come and don't work with me. So I'm sorry, I'm a bit emotional.
We can feel the fire. We can feel the fire.
Yeah, I mean, I think I totally agree with my fellow panelists. Like, even though like Temasek is a very notable institution in Singapore, and they have a big influence on people in Singapore who are investing into crypto or digital assets or are very much interested to explore a different digital asset. So they have a notable sort of influence, I would say, especially in Singapore. It caused a lot of negative sentiments. Like I remember after FTX fallout, people were just questioning, like, are you still going to be in this space? Are you going to move out of this space and go back to traditional finance or something? So I was being questioned, everywhere, especially in Singapore when I went, and globally also. It had a very ripple effect with FTX, bringing a bad name, and Binance, sort of being one of the investor. But I think I don't think it's a how to put it, it's a negative thing. I see it like, the market is getting matured, like, correcting itself. We learn from our mistakes. Crypto, digital assets are pretty new, right? They're still in a very nascent stages, I would say. Not everybody, even though I've been working in this space for quite some time, there are still many things I don't understand yet. Especially the FTX, who would have thought they didn't have proof of reserves? And, you get into this technicalities of when things go wrong, you start, sort of venturing into the details, right? What went wrong and why? And why did that happen in the first place? That's when you realize, oh my God, this is like the tokenomics itself, So these are very technical aspects, legal aspects to this space as well, that is still evolving. If you speak to lawyers also, like a couple of years back, they were not very sure about the legal clarities. And today people are telling me, you can have a token issuance company out of a Cayman or a BVI, which is more crypto friendly, and a foundation registered in Singapore, if you would like to do that. But there are other people who are advising otherwise. So there are still gray areas in this space, and this space is maturing. I would say that, we still are very hopeful about the technology, which is the blockchain technology. Future looks bright, and yeah.
Exciting. So I guess in the audience, there might be some who are new to so-called investing in digital assets. Some might already have embarked for many years. But some of them in the audience might be thinking, what would be the pros and cons in investing into crypto? Whether is it via regulated exchanges, a DeFi platform, or through structured funds? What are your thoughts on that?
I guess if you're using an exchange, it's going to give you a bit more flexibility. You can, trade in and out really quickly. You might be able to, they'll custody the assets for you. You might be able to generate yield on the platform. But most importantly, what an exchange allows you to do, it gives you the option to withdraw your own assets and self-custody, which I think is a very, very important life skill to have going forward. And then the trade-off there is you have to make a call on the creditworthiness of that exchange. Are they doing all the things right by consumer protection? How's their corporate governance? How well are they regulated in how many jurisdictions? Do they have cold storage insurance? What's going to protect you if something happens to the exchange? So you've got to make that call. And I guess there are some like tenure, regulation, audits, working, the kind of people that sit on the board. What kind of major partnerships do they have? These are kind of trust signals you can follow, as opposed to if you're using a fund. It's passive exposure. It's easy. It fits in with your reporting and your taxation, but you don't have the flexibility to move your assets and trade your assets. So, and often these things will have regulated funds will have protections built in, like custody, like insurance. I guess you just got to evaluate. I think a lot of people that are retail often will come in, high net worths in particular, they'll come in with passive exposure with like a fund. And then, as they get a little bit further into the weeds and, they try to experiment with more, self-custody, holding your own assets, doing your own staking, running notes, things like that.
Every investor would want their investment to be safely and properly executed and safeguarded. So this fundamental interest carrying out the transaction through a license exchange for a fee provide that confidence to the investors. So for investing through fund, basically is outsourcing the investment analysis and execution to a professional party for a fee as well. So what I would highlight is that it all depends on the individuals or the entities' investment preference. So working with licensed players, of course, it provides the confidence and certainty that the investor can just focus on the investment itself. The other aspect of the investment relating to settlement recording is handled by professionals. Thank you.
So I would say it depends on how much time and effort you want to put into investing. If you want to take a more hands-on approach, then I would encourage you to go down to even handle the token itself so they can get a feel. Because I see a lot of so-called investment professionals. They talk about the familiarity with Bitcoin tokens whatsoever, but many of them have not really touched the actual token. They have not really operated hardware wallets. They have not gone to the different websites to do actual trades, and a lot of it is theoretical. So again, depending on your assessment of your own investment style. So if you think you can spend more time and you are interested in the token, then I would encourage you to go down to the really basic layer one, operate the wallets yourself, try to do a few trades yourself, do a few trades on the exchange or on a decentralized exchange or centralized exchange, so they can get a feel of this product. But if you don't have time, then of course you can work with funds, pay a fee, so they can help you do the more professional handling of the investments. Or if you are a bit concerned about being too close with the tokens, then you can also invest in proxies, right? Like all these listed companies, Coinbase and all the other listed companies who have, or even indexes, right? So that will be a 2-3 steps removed from actually the touching the token itself. So a lot depends on what kind of style of investment you have. Yeah.
I think this is a very interesting question, and I would like to answer it differently in the sense, because we are fundraising, we are a blockchain company, we've closed our Series A, because a lot of people come to us who do not know anything about blockchain, and they want to invest, they want to diversify their portfolio, and they ask us, how do I invest into your company? You are a blockchain company, but you also have a crypto element, like the token, the native token that we have. So we get asked this question a lot, and these people really want to have equity, which is like a shareholding in the company. They just don't want to hold tokens. So this is a very interesting discussion with the investor itself, depending on their risk appetite. If you do not know anything about digital assets, you do not know anything about blockchain, but you have the investment, you want to diversify a portfolio and you want to invest into a blockchain company, then we would rather have them go via a fund manager or a financial advisor who can advise them the risk associated, right? The risk associated, because ticket size goes up. When you're asking for equity in a blockchain company, the ticket size can be millions, 10 millions. I mean, I would just an example. It's not like a few $100s, it can be in millions. So you have to do your proper due diligence, go to people who, a lawyer, a financial advisor, a fund manager, and go via that route. But if you're a day trader, for example, you are a retail trader, right? You want to trade the popular cryptocurrencies, your appetite is very small, then you can go on a Coinbase or you can go to any exchanges, Binance, CoinHacko, licensed, unlicensed, whatever, operating in your country or country, and start sort of trading in a few hundreds. Okay, the risk is less, the risk is low, because you're not going to lose a lot of money, right? So it again depends on the individual and how much risk appetite you have in terms of your investment amount. So, but again, it boils down to the fact, even though starting out, you should do your homework. If you are not sure about, which project, because if you go that top 20 tokens and, the market is very speculative, there's a lot of volatility in the market, you get confused. So many things happening. Which coin can I invest so that I get returns? At least I don't lose my money. So better if you are unsure and your risk appetite is low, go and seek proper advice from financial advisors or fund managers. Yeah, thank you.
Thank you. So one of the exciting things is that Bitcoin's 4-year halving will occur probably in the next 6 months or so. And historically, very much, it really drives prices up. Now, how does this impact your investment strategy? What do y'all think will happen in the next short term, 1 or 2 years? And maybe in the longer term, the next 3 to 5 years?
So for me, what's going to happen? Bitcoin price, just to give, just a bit of an explainer. So right now, the Bitcoin block reward every 10 minutes is 6.25 Bitcoins that go into circulation. In about 8 months, I think it's March 2024, this will drop to 3.125 Bitcoins every 10 minutes. So it goes from 900 Bitcoins a day to about 450 Bitcoins a day. So the supply, the sell pressure will drop by 50%. Meanwhile, what we've seen is with increased regulation, with incoming ETFs, every time a fintech platform or an equities broker or an app enables people to buy crypto easier or get exposure easier, the demand side story gets stronger, and then the supply is going to drop. So in the last 3 Bitcoin halvings, what's happened? So in 2012, in the 6 to 12 months after the 2012 halving, the Bitcoin price went up by 9,000%. 2016, it went up 2,800%. And in the last halving, it went up about 600%. So this is what's happened. And I suspect, as supply tightens, demand grows stronger, the rails get better and easier, the price will once again go up. I guess that's what I'll see. From a asset allocation investment perspective, I don't change too much personally, but how I make resource allocation decisions at Independent Reserve, that changes. So for example, 2017, up until 2017, we'd onboarded 10,000 customers in 3 years. In the next 3 months, we onboarded 90,000 customers. So we're placing ourselves for a situation, to handle a situation like that in the next 8 months, in the next couple of years. So if we get 1 million customers, they get a super smooth onboarding, we have enough support staff to speak to them, our banking is going to be smooth, our settlements are going to be smooth, and so I'll position Independent Reserve and the team around that. I'll leave it there.
Digital asset as an asset class is a form of diversification for investors away from other traditional asset classes like equity and bond. So in short term, I believe investors will still be evaluating digital asset like how they evaluate other asset classes. In the current climate, we have a lot of geopolitical tension, high interest rate. So the investors will evaluate digital asset with more of the prospect of how these products will eventually evolve. And I believe there will be more digital asset products emerge instead of just the spot BTC. Now we are hearing about ETF, all these are coming on stream. I think what is important would be the regulatory certainty will provide the healthier development of digital asset as an alternative asset class for diversification. And investors will have to be mindful that there are licensed infrastructure service providers like Independent Reserve, Custody Plus to handle a big chunk of the investment processes. So of course, it's up to the investors whether they continue to invest in other venues with other players. Thank you.
So personally, I've gone through a few cycles. So I would advocate allocating some small percentage of your portfolio to hold some digital assets. And of course, Bitcoin will be a very good asset that you can start with. You can choose to go with a licensed operator if you don't want to be bogged down with a lot of technical handling of the tokens. But if you want to get a bit more exposure and learn a bit more, I would encourage that you can actually hold the Bitcoin yourself, right? And there's not much cost to it, and you don't need to pay for all the custody fees whatsoever, but you need to know what you're doing, right? So that will cut down the cost of holding these assets, and you must know
The
how to
independent
examine.
reserve will hold your assets for free.
Say that again. Say that again.
We don't charge for custody.
Yeah, or you can use any of these service providers.
Yeah, absolutely. So we've seen this. This is a big event in cryptocurrency space, like the Bitcoin halving. So basically, what happens is that supply goes down, right? We have Bitcoin halving. So supply goes down, which supply goes down means demand goes up, and when demand goes up, we think that by default the prices would go up again. But again, as everybody mentioned over here, a Bitcoin is a digital asset, and you should go through all licensed service providers and the crypto exchanges. We've learned from FTX, so I play safe. I trade with licensed exchanges in Singapore only. So probably Bitcoin is slightly different from other top currencies, tokens we have like Ethereum. I would say Bitcoin is a digital gold, which means you see it as a store of value. I'd hold it. I would not trade it or not sell it. That's just me, my personal opinion.
Thank you very much. And we are very much coming to the end of the panel. I'm sure there are many key takeaways and great takeaways that the audience has. But if there's going to be just one that you're going to leave them with, what would be that one key takeaway each of you will give them today?
In addition to the Bitcoin halving, which has a huge impact on the entire crypto complex, I'm quite excited to see the rapid growth of stablecoins. So stablecoins have grown in market cap from about $3 billion 3 or 4 years ago to now over $120 billion. There are 25 million active wallets that hold Bitcoin stablecoins, and maybe 20, like a large part of that hold, like 20 million wallets hold more than $1. About 5 million wallets have between $1 and $100 worth of stablecoins, and they transact every week. So they're sending and receiving every week. And this is now decoupled from exchanges and trading. So even though exchange trading volumes have dropped, stablecoin activities increased. This tells me, this is helping with remittance. This is helping the underbanked. And this is something that I felt really passionate about. So, I hope to see more stablecoin growth like we've seen in the last few years. And I think, this will ultimately benefit so many people around the world. So stablecoins have found product market fit. So I'm excited about that.
Digital asset will be an attractive asset class for diversification for investors, whether it is institutional or retail. So when a new product comes to market, there's always time for it to stabilize, to come to an equilibrium before a greater adoption will take place. So personally, I believe digital asset has great prospect, but every investors have to do their homework, have to able to stomach the volatility or even to the extent of complete loss. All right, so that is something you have to bear in mind. Thank you.
So I would say that you encourage you to open an account with one of the licensed operator, buy a few dollars of stable coin, USDT, USDC, and you can observe the different tokens that's out there. Maybe the application is something that you can identify with, and try to create 1 or 2 transactions. So get a feel of how things work within the ecosystem. And the more you get involved, the better you can understand it, and then watch the space and how MAS is guiding the industry through all these new announcements, regulation, especially the stable coin, a single currency stable coin. So that is a very big trend. It will drive a lot of new application in the tokenization trend. So I think that's very exciting. That's up and coming. So I would encourage you just go and try it yourself.
Yeah, I totally agree with my fellow panelists. One thing I would like to ask, if I were to start today, If somebody asked me, go and invest or trade or whatever with a crypto, I would just go and take some classes, like online classes. There are so much e-learning classes and courses on blockchain basics, cryptocurrency basics, digital asset basics, non-fungible tokens. There's so much of information out there. I would just go and first get a certification done. Once I'm little bit sure about what this technology is or what the use cases are, probably then I would go and then start with an exchange to play safe, go to a licensed exchange, and again, maybe $5, $10 worth of Bitcoin or USDT, USDC, or ask a friend who has already been in the space, who already has a digital wallet. Ask him or her to show you how to download or open a digital wallet and transact or transfer USDT, right? So these are some of the basic things that you could do. Ask your friend and families and the extended community, because we all attend these kind of conferences. The whole idea of attending these kind of conferences is meeting people who have been an established player, so we can learn from them as well. So yeah, this is all about learning, networking, and testing out before you realize you really want to have this diversification, or this is not for you. So that's all I have to say. Thank you.
Thank you very much. Some great key takeaways. You have been a great audience. You have been a great panel. Thank you very much. Thank you.
Pleasure.
Thank you very much.
Thank you to all our panelists. That was an excellent discussion, which should provide some direction for those looking to operate in the fast-changing digital asset space. Now it's time for our afternoon presentations. Please join me in welcoming our first speaker, Gerard Johnson, CEO of AgLive.
Hi everyone, good afternoon. Thank you for your attention. AgLive is a traceability platform enabled by blockchain, and I'll give you a bit of a demonstration today on our focus around cattle and the livestock industry. But effectively, we carry data through the platform from environment, farm, animal, and we link that through the supply chain to products. So the team is a pretty diverse team, but effectively we have integration specialists. We do a lot of API connections on the farm, co-founders from the livestock and cattle industry. Myself, I've been in supply chain. We also have people that are specializing in NFT exchange, which I'll get to at the end. And Kazumi in the middle there from the Fintech background as well. So last year I was in America for a full year. The problem in the US is sort of extreme in terms of lack of data, disconnection of the farmer to the consumer. And as you're seeing in the media, there's also a lot of counter-suing and issues around greenwashing, people making claims to product and environment that they can't back up. So effectively, we're using data to create evidence of where a product is sourced, and as I mentioned, carry that to the supply chain. But if we can connect high-end farmers to high-end consumers, we can help the profitability for those farms, which is a real problem, not just in the US, but in Australia, where many times farmers are commoditized. They're not able to carry the full value and quality story of their product to the consumer. So at the moment, we've got apps. We've built a cryptographic app for farmers. But more so today, I want to show you the platform and how we use that to bring huge amounts of data across to the supply chain. We effectively create an identity. Cattle have an ear tag, for example, as an identity. And from that, we're attaching genetics. So we have oracles with, for example, the Angus Breed Society, so we can understand the parents. And then we can track through any water, weight, GPS tags, and movement. One of the issues around agri-tech that I see is great innovation, huge amount of devices and software, but again, they're often running in a specific niche. What we're doing now, although we do have apps and software, is aggregating that data together to make it more useful for the farmer, give them an enterprise level report where they can see the water, the weight, the value of their herd, and how also the property is doing in terms of sequestering carbon and so forth. So effectively a plug-in model. We have 21 integrations across the farms in Australia. The environment piece comes through with the testing of the product. So that's from the genetic performance, but also the laboratory and science that is attached to product production. You can see the little vial on the QR code there. That's fetal bovine serum. So as an example, we've built the first blood traceability. That's a $1.2 billion industry. That's able to look at the parent through to the fetus, the extraction of the blood. We carry that to a serialized vial, as you can see in the lab. And then we can add all that other data like temperature, hemoglobin, endotoxin levels. And we use the blockchain for compliance just to write those critical events, whether it's blood or food. There's always a lot of critical events around the compliance and the validation of the product. In the farm, we see everything from water weight, as I mentioned, but now methane reduction and the ability to get a better environmental footprint. So we take devices, like here is a GPS ear tag. The farmer would get an email with a longitude, latitude, and some basic information, but we overlay that with Google Maps. We can create a geofence, and then AgLive is pushing notifications to the farmer. So the bull has gone over the fence or the cow is not active. So we can again bring multiple sources of data to one point. And here's a small video, shouldn't be too long. You can't hear me, that's good. I was quite awkward about having to watch myself on video, so I'm gonna skip it. So last 6 months or a year, we've really just layered all the environmental data on top of the livestock. So we already have the ear tag of the cow. We're integrated with the ear tag systems, the property systems, but now we're layering that environmental data. There's a QR code at the end, which I'd encourage you to scan, but you're talking satellite agronomy, biomass, soil samples for carbon. And I haven't seen anyone else that is layering that environmental information to specifically the cattle. So proving again, carbon neutrality. You may have heard Steve mentioned about the Ritz-Carlton in Singapore. Our farmer also just won the contract for first-class steak on Emirates, Qantas, and Singapore Airlines. My point is that, yes, it's a great steak, a great farm story, but why are they winning these contracts? Airlines, hotels, they need to buy valid ESG product. They're looking for carbon neutral beef. We're able to show farms in Australia now. They're some of the first carbon neutral farms, beef cattle producers, carbon neutral to the farm gate in the world. And they're able to validate that with their own data, get carbon neutrality to a global standard, and they're not having to use consultants or give away their carbon credit. So quite valuable in the future for these farming operations. So here's our showcase customer. Just by proving the Angus genetics, you can see the article on the bottom left, the animals are selling for $5,500 at auction. We've broken the weaner livestock auction records for the last 2 years. And you can see the little digital app there where we can, capture all that information like hormones or antibiotics. And again, very important for exports, for example, to the UK. Plenty of benefits through on the QR and the menu. Our job here is not to sell beef or QR codes. We provide the data to prove where it came from. The strategy is working through collaborative partners. We have, for example, Gallagher. They do all the scanning equipment, 70 countries around the world. What we're able to do with that data is take it out into the supply chain and attach it to the products. So we have quite a few motivated partners. AgLive sits in the back with single sign-on, but we can then pick up that ear tag, which eventually becomes a stake. So the platform is really helping to enable software and hardware vendors to sell more value in their product. We are now free to the farmer, so we give the app, the reporting, the promotional tools such as QR marketing, that's free for the rancher. So rather than clip the ticket on the cow and the livestock where there's very little margin, we focus on the food product. Places like Singapore, for example, really have a strong emphasis on importing quality product, but they want that proof. The chef wants the reputational proof that it is Angus or Wagyu, or the brand needs to prove the ESG component. So we make our money through enterprise reporting. We've just picked up Australia's biggest mainland dairy. We charge them subscription for the aggregated reporting, and we charge 1% for traceable product to prove that provenance, prove that story. As I mentioned, really focusing the last couple of years on beef and dairy, but we've just picked up the e-halal certification program. So we'll create the digital certificate. with the government for halal. And again, countries like Malaysia, it's very important that they can validate halal certification. We are forecasting break even this time next year. And we do have other areas, like we've deployed medicinal cannabis growers app and sitemap and nursery apps for DPI New South Wales. This is one last thing I wanted to show. We have built private NFT exchanges. So think of it like an Airbnb. It's the first time you can go in, you can choose Wagyu, Angus, choose a region. So even farmers are getting on board with this. They want to diversify against drought and different selling aspects. You can then view your herd, your mob, and you can buy coins or the digital twin of those cattle. This hasn't been done before. 5 years ago, it'd be very hard to validate that that animal is alive and well. But now we can see live data coming into that token. We know the genetics, the parents, and that it's in good order. Why are we doing this? It's more for the cash flow for the farmer. Farmers have a real problem. If you think about Wagyu, they spend 600 days on premium grain. The farmer doesn't have the cash flow, yet we all want to buy more steak and the demand for the high-end food is there. So by buying these tokens in the cattle, the farmer gets their cash flow up front. They can do the husbandry, manage the animals from a better perspective. And for us as investors, animals are a very productive asset. You can imagine how quickly they grow in a 150-day grain-fed program. So there's plenty of upside on the token. It is not a crypto coin. It's using a stable coin. The real cow, the real asset still sells at a real auction for real money. So there's no volatility from the crypto, but allows the NFT token to see that asset in good order. Okay, we're raising $2 million at the moment to scale in the US and also throughout Asia, mainly on the BD. Got our first dairy and beef customers, and now the DAF e-halal program will help us with the halal. And we have patent protection in Europe and America. And this is really allowing us to reduce the bloat. We have one hash on the blockchain that you can then open and see all that data underneath about the animal or the farm. So please feel free to scan the QR code with your camera. You don't need the app. That one is not a product. It's just showing the level of integration. If you are what you eat, you need to know what you ate. And you can see on this QR, there's a hell of a lot of information from satellite agronomy, biomass, all the way through to the soil. My last point is this data is very valuable to financiers and to insurers. We all know the volatility from climate change. This allows you to look at a farm and understand if they're sustainable, what their ACU score is for carbon credits. And I believe that's where our platform will add a lot of value for financiers and insurance in the future. Thank you. We have a little trestle table over there. You're welcome to come and have a chat. Thank you very much.
Now, next up, we have Beth Henderson, the Singapore lead at Startup Bootcamp.
Hello. Hello, good afternoon, everybody. So my name is Beth Henderson. I'm the Singapore and Southeast Asia lead for Startup Bootcamp. And today I'm going to be sharing with you a little bit more about our sustainable fintech fund that we're raising out of our Startup Bootcamp Melbourne office. So just a little bit of a disclaimer before I start. Any information I'm sharing today is not intended as financial advice. So I'll give you a moment to read through all this information. Just kidding. But you can find the deck on our on the CRISP platform if you need to read through that. So we have a huge challenge ahead of us. If we're going to meet the Sustainable Development Goals by 2030, McKinsey estimates that we need to be investing between $5 and $7 trillion every single year for the next 7 years. And we're going to need solutions that don't even exist yet. So that's where investing into startups comes in. Now, even if we invest a fraction of that amount into startups, that's still hundreds of thousands of startups that we need to be investing in every year. And of course, we need it to enable a safe and accessible way to scale these investments. So at Startup Bootcamp, we've been running fintech programs out of our Melbourne office since 2019. And every single year, we're increasing our focus on ESG and the Sustainable Development Goals. And we're finding more and more startups every year are also aligning themselves with the Sustainable Development Goals in the fintech space. So what we did is we took 8 of the Sustainable Development Goals and we devised these into 3 key themes that we're going to be focusing on for investments from our fund. And these are financial wellbeing and inclusion, sustainable business practices and communities, and financing sustainable growth and resilience. So we are raising a $5 million fund, and this is to invest into 30 early-stage sustainable fintech startups over a 3-year period, and that will be a cohort of 10 startups every year, starting in 2023. So why be a part of it? There are a few global trends that are really convincing people to get involved into this area. So firstly, the number of funds that are focused on ESG is more than ever, higher than ever this year. We're also seeing the amount of investment going into sustainable or socially responsible investments has quadrupled in the last 4 years. So team this with what we're seeing in fintech, and we're hitting an all-time high with the amount of investment going to early stage fintech. So in 2023, that was at 72% of all investment going into fintech, going to early stage. We also saw that the top 10 seed and angel rounds last year, 60% of these went to fintechs outside of the US. So we're also seeing a geographic diversification of where the money is going. So with early stage fintech and sustainable development being more appealing than ever to investors, we're now providing a way to invest in this space that's more accessible and less risky. So we're very excited to unveil our more detailed themes for the first cohort of the program. So we're going to be kicking off our first cohort this year. We've already scouted 40,000 startups globally that could be a potential fit, and we've narrowed this down to a list of 2,000 that we're currently doing outreach to join the program. So the 6 key trends or key themes that we're scouting for startups in is generative AI, fraud prevention, embedded finance, DeFi and blockchain, sustainable finance, and financial services in the metaverse. So a little bit more about Startup Bootcamp and who we are. We've actually been around for a little while now, founded in 2010 in Europe, in Copenhagen and Amsterdam. We're now operating in Australia, was our next big office that we opened in Melbourne, which is where I'm originally from. But we now also have a Singapore office, which I opened 2 years ago and now permanently located here, offices in Brazil and soon the Middle East as well. So we do 3 key things. We help startups and scale-ups grow through our accelerator programs. We also enable and accelerate corporate innovation, and that's both through partnerships and facilitating collaboration with startups, but also with helping them accelerate their own internal product development. And we also develop the next generation of digital talent through our growth hacker traineeships. So here's some statistics that we're really proud of. So we've accelerated over 1,700 startups since we began. 76% of our alumni is still active, which is a really high number when you consider the industry average of only 1 in 10 startups succeeding. 72% of our alumni have gone on to raise further funding, totaling almost $3 billion US. And a number I'm personally very proud of is that 41% of our alumni have at least one female co-founder. And diversity in all senses of the word is something we really focus on when we're choosing our cohorts. So what do we actually do in the programs once the startup's selected? So over the last 10 years, we've really honed this model on a way to de-risk and accelerate startup investments and accelerate startup growth. So we'll usually have a cohort of 10 teams and they'll go through a 3-month program, and there's 3 key pillars that we focus on. So there's pitch readiness, which cements the business story, and we do pitch training every single week in a 12-week program. Commercial readiness, we have our own proprietary process and some tools we've developed in how to help startups design and deploy proof of concepts with large corporations. And we also have an investment readiness module, which includes anything from really deep dive analysis on their deal room all the way through to multiple investment meeting simulations so that when they get to the real thing, they already feel comfortable they've done it many times before. This culminates in the demo day, which is a big celebration where we bring the whole network in to explore further opportunities. Now, what does our scouting process look like? It's extremely rigorous and detailed. It takes quite a long time with quite a decent team behind it, but we essentially start within the tens of thousands of startups. We have a lot of links to different databases and inputs, and we've really scaled up the way that we process the sheer number of startups on this scale. Of the amount of applications, we strive to have as many as possible video calls with the founders, because we really want to assess the strength of character of the founder, which is more important to us sometimes than the product itself. So this is why we really need to get that face-to-face time with the founders before we assess the cohort. We then have a 2-day selection event where we bring in our network of investors, mentors, and corporate partners to get involved, meet the startups, and help us choose who's going to be involved. And then we pick 10 from there. So the core team behind this, Jackie Bloom, Trevor Townsend, and Richard Selm, They have over 85 years of experience combined in startup investing, global fund management, angel investing, and startup exits. I'm very honoured to be able to work alongside them. And our wider team of 18 across Melbourne and Singapore have very diverse range of backgrounds and experiences in different industry verticals. And you can see myself there, Singapore Program Director based here. So our alumni have seen quite a bit of success. Here's some of the numbers that we're most proud of, or some of the most notable exits. Our biggest one was for $300 million. That was Relaya. And we have a few unicorns and near unicorns in the mix too. So our oldest fund, we started that in Amsterdam 10 years ago. It's currently operating at a 57% IRR, and that is quite high when the industry average fund is about 20%. So here are the snapshot of the investment terms that we're offering to get involved in this fund. So definitely you can see a lot more in our deal room, but the things I would highlight are that we're targeting a multiple of 3.3 times and a target IRR of 31%. So we've already done our first close of the fund. Definitely if you're interested, if you get in the next month, you'll get in before you increase the unit price. But of course, the fund will be doing the next round of raise throughout the next year or so. So my name's Beth Henderson. I really encourage you to not just think about, if we're to reach our goal in 2030, not just to think about, is this something I may or may not do, but can you afford not to? So thank you so much.
Now, let's invite our next speaker, Vikram Srivastava, Investor Relations Manager at Balfour Capital Group.
Good afternoon, ladies and gentlemen. My name is Vikram, and before I get started, I just want to thank everyone for taking out their time and listening in, and WI and Marina Bay Sands for giving us the opportunity to present here. Balfour is a global hedge fund with over 30 years of experience and operations globally. Let me begin by asking, has anyone lost money while investing? We all have, right? And anyone who hasn't has probably never invested or has a magic ball that shows them the future. We can all agree that Warren Buffett is the greatest investor of all time. And he famously said that there's only 2 rules to investing. Rule number 1 is never lose money. Rule number 2 is to never forget rule number 1. You see, people who invest and fail fall into 2 categories. There's investors who, try to get rich quick and fail to consider the risk and fall miserably. And then there are people who don't take any risks. They're the ones who keep their money stashed in their banks or under their mattress and let inflation slowly erode their wealth. Wealthy people are open to investment opportunities that grow their wealth. They identify risks and mitigate it to the lowest degree possible. This is what Balfour does. We're experts at managing risk and preservation of capital. Now, let me tell you more about our discretionary trading program and how we've been returning 36.93% annually over the last 3 years. So the discretionary trading program is 65% algorithmic based and 35% discretion based. We use algorithms. So what are algorithms? They're mathematical equations that we use to find the risk and reward on a particular model. We use these algorithms to scope markets globally and find assets that are overvalued or undervalued. And it's not just that the math and the research that we put behind our investing is what makes us great. It's our ability to understand the various correlations in the market. Today's markets are truly global and are always speaking to each other. Understanding the correlations between each asset is what makes a great investor. It's understanding why an asset like NVIDIA, Microsoft, and Infineon are related, or understanding the price of US dollar versus gold and crude oil. And behind all of that is our great team. Steve Elaine Lawrence, our Chief Investment Officer, comes in with 30 plus years of experience. He started off with the Chicago Board of Trade and has had an illustrious career in the market. And assisting him is our team globally that sits in Chicago, France, UK, Switzerland, Australia. You have Dilip Chong here in Singapore, and myself in Hong Kong. It's at the end of the day, it's about our top-class service, the 24/7 access to Steve, myself, Dilip, and the team, and our track record that makes us great. What I want to really show you is a live trading account from last week to explain how we manage risk and grow our investors account. So what you see is a live trading screen from last week. Each investor has a segregated account, has access to this 24/7. We trade across 3,000 assets globally. We trade across Forex, all the major indices, commodities, the US market, Australian market, Canadian, European. We're about to get access into the Hang Seng, and we also do ETFs and bonds. Now, as you can see, the system has been made very transparent for our clients. You have access to all our open positions. Each trade might last from between 25 seconds to months at a time. It's basically our sterling reputation that helps us work with top-class banks and brokerages. Some of our brokerages are Goldman Sachs, Cantor Fitzgerald, Citibank, and many more. This is the reason how we're truly able to globally diversify our accounts and provide institutional access to our clients. You see, one of our positions shortly is Rangerian. Now, this is the beauty of our discretionary trading program, is our ability to leverage 1:100 on each transaction. So we would not be able to afford a stock like Rangerian, which we got 176 of, which would basically use up half the equity of this investor. And this is how we're able to diversify our positions across 447 positions. Now, the edge that we get while investing is our platform is proprietary, and that we've licensed it to over 5,000 small institutions and banks, to which we get real-time order flow. Now, with that real-time order flow, it helps us find trends of assets that are overbought or oversold, and helps us create more short-term trades, while our intensive research and our ability to understand and read the market helps us find those core positions that really we hold for longer periods of time. You'll see Dow Jones is one of the trades that we make through our order flow that helped 15,000 in investment for this particular account. So this lady started her account in December 2022, and with 70K in equity. And as you can see, it's grown up to 268K. I'm sorry, this is the second account that I wanted to show. But market is truly about timing and opportunity, and that's what I wanted to convey here. Behind every great company, what you'll see is a great team. We have great people all over the world. Dilip here is a seasoned professional and a business strategist and an entrepreneur, and he's helping revolutionize the RegTech space. This is just the beginning for Balfour. We're already starting to look into the VC and PE community, and we're launching an arm very soon, while already helping startups take advantage of our extensive resources and connections all over the world. I urge you to look into our deal flow on the CRISP website. One of the companies that we're working with is helping the edutainment space by providing access to world's cultural legacy. This is by using extensive academic knowledge and combining with cutting-edge technology. This is one of the companies that we've been working with, and we really see a huge potential for them in the edutainment sector. At the end of the day, Balfour is all about creating long-term relationships, and I urge you to come speak to me, come speak to Dilip, and we'd love to talk more about the market, more about what we're doing, and how Balfour can be a real asset to you. Thank you, and have a great day.
Now let's move on to our next speaker, iSchool Alam Khan Sujon, the founder and CEO of PriyoShop.
Good afternoon, everyone. I'm sharing a story of Rohim. Meet Rohim. Rohim lives in Dhaka, the largest city in Bangladesh. He ran a small retail shop in Green Road, which is the most populated area in Dhaka. Every day, Rohim caters 150 plus customers. But it's not easy to fulfill everyone's demand. Every day, he faces the same problem, that is out of stock. And his customer moved to his competing store. Restocking is not easy as it seems. When he needs inventory, he needs to go 30 to 50 different sources to restock inventory by losing his working hour. But he don't get right price from wholesaler because he buys small quantity and minimum SKU from wholesaler. He also uses local transport, which actually costly for him. In the meantime, Rohim's shop is closed. And it's not a single day story. He needs to restock 6 times in a month because he has limited capital, limited shelf, so he would not hold inventory for long. In this inefficient process, he losing almost $1,000 sales per month. We are PriyoShop, a B2B marketplace for on-demand restocking. We provide a digital catalog to Rohim so he easily can access all the brand and distributor product in a single platform, can place order easily, and get delivery within 24 hours. Let me show how it's worked. Rohim download our app from Google Play Store. It's in a native language, so he easily can understand and navigate. He can browse SKU by brand, by category. And for add to cart, he just touch few steps. After review cart, he can place order, payment on delivery. After getting order, a automated purchase order generated to suppliers. Supplier confirm inventory for him, and our picker collect product from supplier and drop to Rohim's store within 24 hours. If Rohim eligible, we also offer pay later facilities for him in the partnering with local financial institute. Now Rohim is super happy because he don't need to shut down his store anymore and earn 20% more than before. Before I enter my business model, I love to share the Asian economic tiger, Bangladesh, the land of possibilities with the highest GDP growth in the world. Bangladesh per capita income already crossed India. Our per capita income currently 3,000 USD. You will be happy to know that Bangladesh is going to hit $1 trillion economy by 2040 with 170 million people, where 66% people are youth. Average age is 28. Almost 71% people already use 3G and 4G internet, but still 97% retail transaction contributed by 5 million small retail shop like Rohim, and market worth almost $191 billion. Our business model is very simple. We connect brand and supplier directly with mom and pop shops and make money through take rate. PriyoShop playing role in asset-light model. We don't hold inventory. We're trying to empower traditional player with the power of technology, enhance their efficiency level. On the other hand, our competitor playing role in asset-heavy model, which actually costly and less flexible. They don't solve any problem of existing players. They're trying to create another entity of distributions. Myself, Ashikul, I am 3 times founder. I start my career in 2006 as a web entrepreneur. And after that, 2010, I start a IT-enabled firm. And I also work in B2C space. And 2021, I start PriyoShop B2B platform to solve million MSMS business. My co-founder, Deepti Mondal, comes from telco background. She expert in brand marketing and customer happiness. She left Grameenphone, the largest telco in our country, to build PriyoShop. We also have diversified teammates with their domain expertise, like our CTO has 14 years experience, our software lead has 17 years experience, our product lead has 17 years experience, our finance BP has 12 years experience, our commercial BP has 11 years experience, and our operation excellence by Ehsan Jaman has 9 years experience. Ehsan left Daraj backed by Alibaba to build PriyoShop. We already help 160 leading brand and supplier to connect with mom and pop shops, including PepsiCo, Coca-Cola, Ajinomoto, and few local brands. We already impacted 33,000 micro merchants business to digitalize their supply chain process, connect with financial institute, ensure financial inclusions. I'm proud to announce here, we already hit $14 million monthly GMV last month, and it's close to 700K revenue. Here our strong revenue growth. Last 18 months, we grown 11x, 59K to 671K. We already got validation from leading investor like Iterative Capital, Y Combinator for Southeast Asia, SOSB Venture, SBK Tech Venture, Sabor Capital, Accelerating Asia Singapore, Asymmetry Venture, South Asia Tech Partners, Business Angel Network Southeast Asia. Currently, we're looking for $2 million to support more MSMEs business, transform their supply chain process, ensure financial inclusion. We already got 1.5 million and now looking for the rest 500K. With this fund, we want to expand 40 new area in Bangladesh with 20 hub, onboard new 100K micro merchants. And also, before Series A, we want to launch alternative credit card. That means the fintech space in partnering with Visa card and MasterCard and offering POS solution for small businesses. So let's digitalize and empower million MSMEs business jointly. Thank you so much. Thank you.
Now let's move on to our next speaker, Christopher Merrick, the Managing Director at Pivotree.
Good afternoon, everybody. Thanks very much for having us. Just here to talk to you today about Pivotree, which is a novel solution for oil and gas fields. Here's our disclaimer, particularly when we talk about the future-looking promises. Oil and gas is a big business. Lots of exploration over many years has delineated many fields. So we've rightfully gone after the largest reserves first, deploying very large systems that employ lots of capital to get the oil out of the ground. So what that means in exploration terms is that while there's been plenty of successes finding large fields, there's also been plenty of technical successes finding small fields. So our technology is designed around bringing to market those stranded resources that are either too far away from existing assets to tie back or in too deep water that you can't use a conventional system. So the Pivotree is a simultaneous structural mooring for a small floating storage production and offload vessel, and also the well and flow control for the oil well that goes into the ground. So we're a step change in the equipment that's required. I'll show you a little bit further more.
Globally, there are over 3 billion barrels of proven oil reserves with no route to market. Stranded economically because of the resource size, or physically stranded by the distance to offtake. Until now. Because all this equipment can now be replaced by just this, the Pivotree Harvester System, a self-supporting hydrocarbon production system. The system consists of a subsea oil production tree called the Pivotree that provides both well and flow control and is the structural mooring for a handy-sized floating production storage and offload vessel, or FPSO, called the Harvester. Designed in accordance with international codes and standards, the technology redefines minimal facilities. No other subsea elements, such as platforms, moorings, flow lines, umbilicals, or manifolds, are required. The Pivotree Harvester System vastly reduces the time from drilling to production and the capital required for field development, and significantly reduces project risk. The installation is completed seamlessly at the conclusion of drilling the well. Hookup of the mooring line and riser occurs when the harvester arrives in field. Subsea wells are massively constructed to meet the loads imparted during drilling operations. The Pivotree utilises the strength of the cemented well conductor as the foundation for mooring the Harvester FPSO. The Harvester is a self-supporting FPSO with full 360-degree weather vane. By eliminating the need for a spread mooring and turret, no costly structural upgrades are required to the vessel hull. General operation of the field is to produce the well in suitable weather conditions, and once the harvester is filled, shut in production, disconnect the riser and mooring, and sail to a receiving facility to offload the cargo. In the event of extreme weather, the harvester will shut in, disconnect, and move off station. All designed and engineered for 15 years of safe operational life, with in-field replaceable components to support continuous operations.
So value proposition is that we reduce time, reduce risk, reduce the capital hurdle required to get into production for these stranded resources, reduce the environmental impact, and reduce the abandonment burden. And this is becoming a big issue in the industry. Customer value over the 15-year life, capital cost to deploy is 150 million. That gets you 15 years of production in as many as 5 fields, depending on how many reserves are in the ground. What that means is a return to income for Pivotree is 110 million per customer over that 15-year period. So we have achieved our first customer. We have a binding MOU for a sale in the UK for a system to be deployed there. And we have ongoing income being generated from customer studies where we determine what field requirements they have and how best to install the Pivotree into their fields. In terms of use cases, we have 3 that I'd like to present here, which is the first use case is economically stranded, too far away, too deep. The second is a bootstrap development where you may be uncertain about the field size. So you install a small Pivotree system, produce the field, understand the characteristics, and if warranted, upgrade to a much larger system. And then finally, which is probably more attractive to the larger operators with stranded assets, is extending the sunset asset life, so kicking the decommissioning can down the road, so to speak. By implementing a Pivotree, we can keep producing for a lot longer and maintain those historical assets and continue to use them. What sort of market are we addressing here? Well, it's very large. So in the top 20 jurisdictions that we've examined, there's 5.3 billion barrels of stranded oil. So that's in keeping with the targets. This is not reserves, this is the stranded resources. In our top 7 markets, there's over 2.5 billion barrels, the largest of which is the UK. So with our first customer putting their field into production in the UK in coming years, 18 months, we'll expect to start to see some further interest in the system. And so our deal pipeline of 30 qualified deals, we expect to be able to monetize that and start bringing more systems into production. So our business model is around leasing the Pivotrees. So we lease them for a particular cost, $5 million per unit. That pays for the tree and it gives a 15-year license to use the technology. Then once in production, we become a technology partner with the operator and we claim a royalty in production. So for every barrel they produce, we claim a percentage. And so this means the company is self-supporting with only a single customer. So our first customer will eventually provide the cash flows to generate all of the G&A that we require, plus a very handsome dividend. In terms of investment, we are seeking 1.5 million Australian dollars. So with a share price of $1, that's based on a valuation of 22 million. So we're going to use the funds is to convert that pipeline of 30 qualified deals that we've got, and these are largely oil companies around the world with stranded resources, finalise the prototype and then put on the work and the intellectual property management that's required to manage a portfolio of IP. So once we go into production, really the need for capital is significantly reduced. And so this is going to be our last capital raise for the company before it moves into the dividend paying sort of realm. So this is not an idea on paper anymore. It's been taken, all of the engineering has been taken off the paper and now we've built our first prototype units. So back in Perth right now, I'm testing this equipment in its intended form at full scale. So we've got, as you can see here, this is the first generation of the more impermanent guide base. And this is a physical unit that we can actually deploy. So as I mentioned, very large accessible market. We've got a binding MOU for our first customer. And then passive future income stream are the highlights for Pivotree. So thank you very much.
Now let's move on to our next speaker, Associate Professor Dr. Michael Nguyen, Director and Chief Medical Officer at Cannaponics Limited.
Okay, thank you. Welcome everyone. I'm excited to be here. I want to present Cannaponics, but first, I just want you to imagine something. Imagine you have a daughter who has epilepsy, who has 10 fits a day and you can't do anything about it. Imagine you had a father who has disabling Parkinson's disease, or Uncle Roger who has chronic back pain, who's on opiates for a workplace injury. Now, these are real life scenarios that face people every day. Imagine that you could actually give them something that could help them. And that's where I'm really, really excited about presenting Cannaponics. Look, I'm a cardiologist. You know, I treat patients. I give them statins and I give them other drugs for blood pressure. But I'm giving them one drug that treats one condition. Imagine you had a super drug that could treat 20 or 30 conditions all at once. And that's why I'm excited about this. This is a naturally organic grown product. This is not made in a lab. This is what nature's given us. And I think we're coming around to the idea that nature, knows what it's doing and it's providing us with, something that is really life-changing for a lot of people. This is what we're about. We're about helping people. And this is the core of what we want to do. We want to make sure that this product is accessible to not just Australians, but the world. And that's what we're thinking. We're not thinking just local, we're thinking global here. There are always challenges with any industry. In Australia, we import 90% of our medicinal cannabis. We import it from South America, where we're not sure of the process of how they produce the product. We import it from Canada, but we don't have the resources to make 90% of the medicinal cannabis for our own population. There's quality issues. These are all challenges, but really currently our patients are driving the demand to have better product, to have cheaper product. And that's where we're trying to offer a solution. The solution is providing better supply, but also providing better quality. And our process is at the heart of everything is to provide better quality for our product, for our patients. We're building sustainable product to reduce cost. And this is our secret sauce. This is our site. This is in Collie in Western Australia. Now, Collie used to be a coal mining town, but the government has really transitioned this away from, let's change the industry to a sustainable industry. And they essentially provide us the land for a very cheap price. And we're changing this town into a self-sustainable, greener economy. We have 165 acres. We've got a 4,000 square meter greenhouse that can produce 10 tons of medicinal cannabis a year. The market is huge. The market is a $1.4 billion industry in Australia. We used to remember I said 90% of this is imported. But now there's new regulations in Australia that say you actually have to be able to produce this product at a very high standard. You need to be GMP certified. That's what we are. So it cuts away a lot of this import market and really is encouraging really good production of this product. And really, the government's really trying to encourage local manufacturing and production. The international market, $47 billion. And I think the really sleeping giant is the Asian market. No one's really looking at this market, and we in Australia and in Perth especially are positioned perfectly to really tackle this market in the future. Thailand, you can see already as a case market of how it can grow. South Korea, Japan are embracing this, and it's only going to get bigger. And we're talking to multiple jurisdictions in Southeast Asia like Malaysia, Vietnam, Cambodia. But we want to partner with these countries. We want to partner with governments in these countries to make sure that this product is regulated and this product is delivered in a way which best benefits the patients in these countries. Our other secret sauce is the production. We have state-of-the-art equipment that can produce this medicine 24/7, which means we harvest this product 24/7, 365 days of the year. Our first harvest will be 10 tonne in the year. That's just in our greenhouse. We're going to grow 15 tonnes outside, and we'll go through some of the metrics in the next few slides. This is some of the state-of-the-art equipment we have. We have the key one is this dryer. Now, if you to educate you about how cannabis production is made, is essentially we harvest the flower, and then it usually has to dry for 2 weeks. Mold can develop on the product, bacteria, but this is how it used to be harvested. But with this dryer, we can harvest in the morning, dry the product, and package it in the afternoon. This is why we're embracing this technology. This is the team. Look, I'm a cardiologist, so why am I in this? Well, I'm in this because half my patients are on cannabis oil and cannabis products for pain, for insomnia, for anxiety and depression. The other person in the room that I want to really highlight is Rod, who's the founder. Rod is, if you ever meet him outside, he's probably the most enthusiastic person and the most enthusiastic person who believes in this industry. And I would applaud you to go and have a chat to him. We have, the other one I want to mention is Kenneth, who's our grower. He's a Canadian grower, who's been a pioneer of this. He started growing in Canada when it was legalized 22 years ago. And he's brought this technology to us. So we're really excited about this team. And the team is about, do you believe in what you're doing with any team? And we have a belief and we have a vision that we're going to be the biggest cannabis company in the world. This is the metrics for you. We envision conservatively producing 10 tonne of cannabis in our greenhouse alone in the first year. We're going to sell it for $3.50. We've already, we've got off-takes at $3.50 at a minimum per gram. It only costs us 77 cents to produce a gram. So our first year of revenue is $35 million just in the greenhouse alone. If we grow outside, another 15 tonne, enormous revenue. This is a late stage company. We're about to make profits in year one. Remember, we've pre-sold all our first year of growing already. These are our targets. We envision huge growth over the next couple of years. We think that we have a product that will aim to grow in Asia, and our big expansion is the export market. We're talking Germany pays $8 to $10 a gram of this product. We're talking about Thailand paying $30 a gram for this product. And we're making it for 77 cents a gram. Our ask, we've raised nearly $20 million already, but remember, it takes a lot to buy the land, to build the facility, to have the infrastructure to be able to produce this product and all the equipment that is involved. We're raising our last 10 million, that's it. There's no more. This will take us to completion of the facility and have $5 million of working capital. This is our final raise. At the end of this, our capex of all the equipment and land that we own will be around 30 to 35 million. We have no debt in the company. We have a great vision to really, really grow this market and expand this company. What about exit strategies? I don't want to think about exit strategies. I want to just build the best and most lucrative and most successful company we can. And if we do that, there will be always opportunities for our company. So I want to leave it there. I want to thank everyone. Please come and have a chat to us. This is an exciting company. We want to work and really help our patients and have this product delivered to, have our patients have access to this product, not just in Australia, but throughout the world. So thank you.
Next up, we have the last speaker for this session, who is Rohan Hawkins, the CEO of PYC Therapeutics.
Thank you, and hello everyone. My name's Rowan. I'm the Managing Director of PYC Therapeutics, which is a biotechnology company that is based in Perth, Western Australia and San Francisco in the US. The afternoon is starting to feel quite long and I think attention spans are waning, so I'm going to dispense with the company presentation and instead try and mix things up a little bit. What I thought I'd do is just share with you an anecdote to start with that reminds us why biotech investing is such an exciting space to be, and then see whether or not we can use the insights from the panel discussion this morning to try and divine a basic set of rules that will enhance our probability of success in the field of biotech investing. And to make that a bit more interesting, I'll put an outrageous assertion out there as the premise to that second part of the discussion, which is that if we get this right, this journey that we're about to go on in terms of defining these biotech investing rules, you can actually stack the odds of success in your favor by more than 5-fold without making any sacrifice in terms of the return that you are looking to achieve. So in terms of the anecdote, there was a company that you have probably never heard of that had a drug approved in the US about 6 months ago for an indication that you have likely also never heard of. The company was called Reata Pharmaceuticals, and the indication that they were pursuing was a disease called Friedreich's ataxia. And the interesting thing about the Reata story is that what happened around 1 month ago is that Reata themselves were acquired by a company that you probably have heard of called Biogen for $7.2 billion in cash. And it's a nice reminder, firstly, of the impact that biotechnology can have in patient lives. Because today there is a treatment option available for patients who have a degenerative neurological condition where there were no treatments available previously. So the potential to change people's lives is a big attraction for investment in the biotechnology space. And also the second part of the story that's relevant to today is the reminder that where goes life-changing science also goes phenomenal commercial returns. So we're going to skip through what PYC does, as I mentioned previously, and just to see whether or not we can try and work out some basic investment paradigms for life sciences investors. The first thing that we need to do is to make sure that we are pursuing a commercially attractive market. And this is a threshold issue. So for each one of these disease indications, we need a minimum viable patient population to make it commercially attractive. And to keep it really easy, I want to draw on the Reata example of a first-in-class medicine. So I don't want to get drawn into a competitive evaluation and trying to work out how much market share we're pursuing. We're going to stick to indications where there are no drugs available for patients. So they don't have any treatment options at all today, and we're creating the first medicine that's approved for each of these indications. Does anyone remember what the panel member from SG Innovate suggested were the two fundamental drawbacks of life sciences investing, biotech, from this morning? No? Recall the comment in relation to the binary outcomes? That's the first one. And the second time, the long lead time to revenue generation. These are the two fundamental issues. What can we do about the probability of success in life science investing? This is what it fundamentally comes down to. So that binary 1 or 0 informs whether or not we make a successful market entry into what we know are commercially attractive markets. Does anyone know what the average probability of success industry-wide is for a drug that is starting out on its clinical development journey? Any guesses? About what, sorry? Less than 1%? It's not quite that bad. Gee, that's pessimistic. It's about 10%. So still pretty bad when you consider the cost of the clinical journey, and that's even from having passed through the valley of death in the non-clinical space as well, right? So that's not terrific, because if you're looking at it from an investment perspective, you're allocating only 0.1 of those 1 units in that binary outcome to risk adjust those cash flows. So your 1 billion is reduced to 100 million straight away, or your 2 billion down to 200 million, 5 billion to 500 million, and so on and so forth. What was the other panel member who was sitting on the other side mentioned there's something that we can do in life sciences investing to fundamentally change that 10%. Does anyone remember what it was? No. It's the validity of the target. How well validated is the target that we're going after? And so what I would like to do is to talk to you the story about Reata went after what we call monogenic indications. So the very simple end of the spectrum. If you focus in life sciences on diseases that are caused by mutations in a single gene, you know exactly what is going wrong in the disease and exactly what you have to do to fix it. And this has a very fundamental impact on your probability of success in the clinic. There's a company that you may have heard of called Alooba Therapeutics, an American company with a market cap of around $30 billion, has just recently put out a retrospective on their pipeline that looks at what are their chances of successful market entry when they launch a phase 1 clinical trial. Does anyone want to hazard a guess as to what that number was, bearing in mind that the industry as a whole is at 10%? 64%. Now that is quite a fundamental change if you are now risk adjusting your revenue streams by 0.64 rather than 0.1. And it makes the paradigm of the biotech investment much, much more attractive in that context. So that's the P success, that can be fundamentally changed, but there are other variables that we can influence as well. So the time to market, there was a comment made by one of the other panelists from this morning's session in relation to getting the US regulator in particular to recognise the importance of a new treatment or potential new treatment for an unmet need. And he mentioned a designation called a fast track designation, which is where the regulator understands and accepts that the potential for the therapy to meet this unmet need is so great that they will work with you to collect the evidence to push that drug through to market faster. So the potential for 2 clinical trials rather than 3, which expedites the path to market, as well as the potential for an accelerated review process. And so that's quite important as well, although not as fundamental as changing the probability of success. There's one other thing that we can do. We've got 58 seconds left, so we'll throw one more rule in there. You can actually, in these monogenic diseases, these rare diseases, get an insight into what's going to happen before you get into a human in the clinical trial. And this is a technology that has become available in the last 10 years where you can take a skin sample from a patient who has the disease that you're interested in, send it backwards into an induced pluripotent state. You can create a stem cell from that patient's skin sample that has the genetic mutation that you're interested in fixing. And you can grow from that stem cell every cell type that exists in the human body. And so for us, this is a blinding eye disease that we're interested in. We can make ourselves a human eyeball in a dish that has the genetic mutation and the disease phenotype that we're interested in correcting. So we can actually assess whether or not our drug is going to work before we get into human clinical trials. And in doing those 3 things, you can fundamentally tilt the odds in your favour of a successful market entry. Flick through now. We have got lots of different clinical readouts coming. We are pushing an asset into clinical development now every year going forwards. Our pipeline is built on a platform technology that is creating these first-in-class drugs. So the other thing that life sciences investors like are human readouts. Is the drug safe in humans, and is the drug going to work in humans that inform our probability of success? So a very exciting time coming over the next 36 months for us. And I'll leave it there because I think we have a panel discussion coming very shortly. Thank you.
Now, let's move on to our panel discussion. We have a panel exploring the alternative investment space. Please let's give a warm welcome to our distinguished panelists. First up, we have Campbell Newman, the Chairman and Managing Director of Arcana Capital. We have Rohan Hawkins, the CEO of PYC Therapeutics. Kishore Ravichandran, Ventures, Sustainable Cities at Plug and Play Tech Center, followed by Leslie Chong, CEO and MD of Imugene.
Can anyone hear me? There we go. Win. Okay, so obviously this is a good topic now. For the alternative investment area, really Wholesale Investor is built around the alternative investment space. And this topic for us is always sort of interest. And I suppose the perspective I want to get from the panelists is both from their own professional perspective and also their own personal perspectives as well. So as a starting point, it'd be great to have the panelists give a quick introduction to themselves. I'll wait for you last, Rohan, because you literally just spoke. Kishore, kick off with you.
Hello. Hi, my name is Kishore. So I'm working with Plug and Play Ventures. So we are a global innovation and corporate innovation and venture capital platform. Particularly, I'm looking after investments in the sustainable city space. So I'm looking after investments within the APAC market.
Yeah. Cam? I find if you just stare.
Yeah, Campbell Newman with Arcana Capital. It's a commercial property fund, unlisted. We have about $230 million worth of commercial property around Australia, from North Queensland down to Tasmania and west to Perth and Kalgoorlie. We provide opportunities for wholesale investors to take a slice of the action. It's a unique sort of offering in that it's a single asset, single trust. So everything is a SPV, which provides great clarity, transparency about how the investment is being put forward.
Leslie?
Hi, my name is Leslie Chong, and I'm the CEO and MD of Imugene. We are trying to look at a space of great unmet need and trying to rid this world of some of the scourges that cancer has caused. We go after validated targets because we know that it works and that there's a proof of pudding there, right? And so we've got a myriad of potential assets, and we've got a very near-term to market product that we just acquired. So excited to be with you guys today.
Rohan?
And my name is Rohan Hawkins. I'm the MD and CEO of PYC Therapeutics. Just gave the introduction there. Very, very similar company in many respects to Leslie, although instead of focusing on the oncology space, we're very much focused in the rare disease domain.
So Rohan, I'm going to kick off with you, because I obviously know your background before sort of PwC and, for PYC Therapeutics, and you initially came into the company as an investor. So going from the alternative side, what attracted to you, firstly, about the investment into life science as an area, knowing that it's sort of a long gestational time to build value, to grow wealth and so forth. With your personal or family investor hat on, what sort of got you into the area? And I suppose, what would you like to articulate to other investors about investing into life science as an area?
The second part's probably easiest. That because it's really hard, and be careful. In terms of my journey into PYC, and I think you know, Steve, my background originally was in medicine. And so I felt like we had some enhanced understanding of the industry. I think I was probably wrong in hindsight. I think the very early stage nature of what gets done in life sciences companies was not as I had envisaged it, so it wasn't right in that sense, although the underlying asset in the company at that time was very attractive, and it didn't have a very clear commercial focus and path to it. So I was drawn to the attraction of the intellectual property and the idea that we could transform what was effectively a failed company into one that was moving assets productively into the clinic and seeing whether or not we could make a difference in people's lives.
And Leslie, I'll ask you a slightly different perspective. As a business builder in the life science space, you know, I said we talked before, we initially worked together. I made a mistake earlier. I thought we were working together when Imugene was at 20 to 30 million market cap. It turns out it was 5 million market cap, and they went as high as $3.5 billion. In fact, to give you a stamp, I remember the first investor evening Leslie spoke at one of our events. I had one of the investors beside me going, "That share price can't go lower. I'm buying some." Like it was like 0.001 cents, something funny like that. So what perspective would you provide for investors looking to invest into, life science companies early, which is where you join the Imugene journey, and what it looks like getting traction, hitting milestones, etc.?
I think you need to be very focused on the work, have experienced people to work with you and for you, because that's critical. Especially in building a drug, you need people that actually know how to do drug development. I myself have 4 drugs that I've helped market all the way from bench to bedside. Everyone that's joined our company thus far has had a life science experience and drug development. So I think that's critical, that experience. And you want to put together a team that actually believes in the cause of curing cancer or an unmet need, because truly, if you don't believe in what you're doing, you're going to do a mediocre job, and that's not what we're here for.
Campbell, I'm going to go you on the personal side, right? So you were formerly the Mayor of Brisbane, the Premier of Queensland. I'm sure when you finished your role as the Premier, you had all sorts of high-profile consulting gigs and all sorts coming your way. Why did you decide to move into commercial property as an area? And also, I suppose, give some, because I know you're an angel investor as well, so give some context to your own investment thesis for yourself.
Well, you're being very kind and polite. Actually, ladies and gentlemen, I was hosed out of office quite dramatically.
You're hosed in and then out.
I was hosed in and hosed out. But I suppose literally 8.5 years ago, I finished my political career, which I'd been in for 13 years, and I was sort of like standing there figuratively on the street corner with my little cardboard box with my office, cleaned out my desk. I think, what am I going to do for the next 10, 20 years of my life? And I've had a range of careers. And I wanted to do a range of things. So I actually wanted to get involved in tech. So I was involved in a very successful Australian agricultural robotics company based in rural Queensland. So I was with them for a few years as their chair and helped them raise capital. I was involved in an AI company in the voice recognition space, which it's still there. I don't know how it's going to go. But then I've been an angel investor with my wife in a whole range of startups. So it was just, I wanted to get involved in technology. I wanted to get involved in the space and help people raise money and also participate in their boards. But you also need to pay the bills initially. So, I love property, passionate about property. I got started in this commercial property space, and we just love the thrill of the chase, basically. We love finding value where others don't see it. We're contrarians as well. We invested in heavy engineering, industrial assets in the coalfields of Queensland at a time where people had mistakenly said, well, there's going to be no more coal mines. Well, that's not true. There will be coal mines there to provide coking coal for steel for many decades. And so we were able to get great assets at quite knockdown prices effectively. So I'm in commercial property because it does pay the base bills, helps me and my wife go into the tech space. But I do just love to sort of build that portfolio as well, and love finding great assets.
Brilliant. And just for the record, I actually lived in Queensland before I started WI, so I was a fan of yours sort of before.
So it wasn't that bad, really.
No. So no one could understand how popular you were, sort of, as they're going the approvals through the roof. Anyway, side note, Kishore, for yourself.
Yes.
So when we spoke, you mentioned about your areas. You cover a range of different areas. The space that I said I was curious to have a chat about was space.
Space, yes.
So it's obviously a hard area. Once again, like life science, long gestational period, lots of investment up front. Where do you see the opportunity in investments in space-related companies?
Right. So as we all know, recently India actually launched its satellite to the moon and we landed. But the updated news is that we actually did find several elements on the moon, for example, in terms of hydrogen. as well as oxygen elements itself. And I feel like the fact that we have already established, okay, the presence of certain elements, the next step towards that would be to have a colony on the moon itself for extraterrestrial or extraplanetary travel. So the next segment would be more into mining of space minerals, and a lot of companies would start coming up in this space. Apart from that, it would also be more of satellite tech and connectivity for land-scarce regions, satellite connectivity scarce regions, where you need more internet connectivity in order for us to generally grow itself as a society. Yeah.
And just go back to you, Rowan. Obviously, we talked about the life science aspect, mentioning that it was a family investment into the company, and then obviously so you mentioned about sort of taking out what was sort of a failed sort of listed company at that time. What other areas do you guys, outside of sort of life science, which I know you're heavily in debt, heavily sort of focused on from a business, what other areas do you and the family look at from an investment perspective?
We're pretty concentrated, so we're high conviction investors, and when we find something that we feel like we have an investment hypothesis in, we'll go hard in that domain. So we've got our life sciences investment in PYC and a couple of other companies in that space as well. And then, like Campbell, we are fans of property. So we've got a couple of residential property and one industrial property in Western Australia that we're invested in as well. It's really just those two asset classes for us.
Brilliant. And how do you think about the mix as far as obviously the high conviction, which also can be defined as high risk, and obviously there's been a lot of value created in that company, versus the sort of more, let's say, conservative, boring is exciting type of investment?
That's not our approach in property. It's not so boring. And we're after industrial properties that are going to be rezoned and then very large mixed commercial residential developments put on them. So I found two industries that are both highly cash flow negative with long lead times to any return. So I think if I get a third, I'm going to get a yielding product that comes somewhere in the mix. So no, we embrace
Campbell's
risk,
happy to chat with you later.
risk wholeheartedly.
And Leslie, for yourself, is there any areas out, and obviously being CEO, what areas do you sort of look at for yourself sort of outside of life science as an area?
Well, so my husband is a professor of quantum physics, so we do look at tech. However, I'm mostly invested in biotech because I believe in it. I think we need better biotech, we need better medicine. We're only getting older, and so these things are very important to me, my family, my friends, so that's what I invest in.
Brilliant. Kishore, so let's say traditional investor looking at investing, and I don't know, I know Plug and Play has been fantastic from an ecosystem perspective as far as bringing founders in, helping educate founders. In your role, do you also play the role of sort of educating family offices, new investors coming into the ecosystem?
Okay, so generally we don't work with family offices per se. But we do know of several family offices that we do come across. Let's say we go over networking events and we have conversations and stuff. And we kind of exchange ideas. That's where we kind of help each other. In terms of raising funds, that's where we would actually need to bring in family offices. So right now for Plug and Play APAC, we don't exactly have a fund that we are raising at the moment. But we do intend to in the future. And should that be the case, then we will be tapping onto our family offices network. But in other offices, because we are established in over 60 countries, we do have family offices who are working in that region as well. Yeah.
Do you want to give everyone a bit of a perspective as far as all the different sectors Plug and Play is actually across? Because I found that fascinating in our conversation.
Yeah. So Plug and Play is actually, it covers over 20 plus verticals. So we have agri-tech, food tech, mobility, energy, crypto is one of the new verticals that was launched. Traditional verticals like your fintech, insurtech, healthcare are also verticals that we cover. Predominantly what happens is that we are working with a lot of our corporate partners. So where we add value is the fact that we establish our connections with over 500 corporate partners globally. And we work with these corporate partners on their corporate innovation front to identify problem statements that will be very relevant for them. And what we do is the fact that we have our own proprietary software called the Playbook, where we have over 80,000 startups that we personally know of in our database. And it sort of acts as like a Crunchbase, but it's more in-depth and we have personal connections with every startup that's on board. because we have a global ventures team looking after these startups, right? So whenever these problem statements come from the corporate players, we will take the problem statements, analyze it internally, and they'll be like, okay, what are the companies that are working on these problem statements? And we will try to connect the startup to them. We might not actually invest in these startups, but these are the startups that are still in our network anyway. So having these connections and establishing these connections kind of drives the innovation front itself. So let's say when we introduce a startup to our corporate partners and they like it, they can run a POC and see whether it works for them. And then if they want to invest, they can go for it as well. And if we find that our corporate partners like it, and because they know the space more than us, we would come on board as an investor as well.
Got you. And just for you, and sorry to ask you 2 questions in a row, but I think everyone sort of appreciate it. You get a helicopter view that I think most of us don't get. Like, we're all busy, we're actually building businesses, and then we've got our sort of personal side. You, on the other hand, I imagine every day you've got people pitching you, and you're going to different events like this, you're networking and so forth. So from your helicopter view, you're sitting here in 2023, you've watched the sort of companies try and survive 2020, then scale 2021, then scale back 2022. Then obviously you're seeing generative AI come in. When you're sitting there by yourself, when no one's talking to you, thinking about your own investment thesis of as to how things are going to play out, what goes through your mind?
Okay, so the thing about me is that I'm a trained engineer. So I don't generally look at, when startups pitch to me, right, I don't generally look at their market sizing. To me, it makes sense whether your technology works in the first place. Because a lot of these companies, like you said, are coming up with generative AI, right? Ever since the hype of ChatGPT came in, they are just like, oh, they just throw in either blockchain or the word AI in the company. And they'll be like, okay, our valuation is 10, 15x. And then we are like, but does your company actually need AI? Or does it even need blockchain in the first place to solve the problem that you're working at? And when we question it, they're not able to give us an answer. So we are like, okay, thank you very much for your time, but take care. So it's more of having these kind of inquisitive, intellectual conversations and kind of like churning it out of the founders itself, whether this is actually necessary or not, and understanding the technology behind it that kind of drives our investment thesis itself. Because yes, at the end of the day, you are going to be able to make your return of investments. But if the technology doesn't even stand out or it doesn't even make sense, then why are you even investing in it? It can make sense on a global scale where you can try to have like a market for it, but can it actually come to fruition? I don't think so. So that's where I kind of look at startups from more of a technological perspective.
So in my next question, I'm going to come back to you about sectors. But Rohan, for you, for your own sort of, obviously you're working in the business, but you've also got your own investment thesis. You think about what PYC can look like 5, 10 years from now. And you also, I imagine, are observing everything happening in the life science space. What's your, with your investor's hat on, what is your perspective about what are the changes taking place in life science and healthcare? And what are the investment opportunities for investors coming into that?
Life sciences is a radical place to be. There is so much capital behind this in the US and so many smart people working in this domain, a bit like Leslie was saying before. It's a very, very exciting and hyper-dynamic industry to be in. So we've got all of the usual excitement in the generative AI and the macro trends that are happening outside of the life sciences, but there's stuff happening inside the life sciences in the last 5, 10 years. We spoke previously about the non-clinical models, so building human organs outside of a human. This kind of stuff is pretty exciting. The work that Leslie is doing, the idea that you can engineer the human genome now, so you can manipulate the DNA, I think fascinating in an ex vivo sense. There are now people who are moving to do that in vivo as well. So changing the 3.6 billion letters that make you, you, and me, happening live in real time in a human. These are phenomenally exciting areas. Now, most of it is happening in the cell and gene therapy domain, so the area that we have spoken about. And I think there's just so much excitement within that domain itself. A lot of the future is going to be directed there, coupled with whatever AI can do in that space.
So funny, our next event that we're going to do in Sydney, we're basically based it around Cathy Wood's platform technology, and obviously genomics sits there as one of those technologies, and we're calling it the future disrupted. I think it's sort of a good sentiment. Leslie, from your perspective, like obviously the same question that I asked Rohan, like how do you see this next sort of 5 to 10 years playing out? What are the investment, like when you go to the different conferences globally in life sciences, what are some of the investment trends you're observing?
I think due to the macro environment, the biotech has been hit fairly hard. And so people had to be incredibly competitive and then creative and innovative. So those, when I speak to US funds, they tell me, you know, the cream will rise to the top. And so it's much more competitive than it ever has been. So I think you have to be much more innovative and you have to use your money wisely. Choosing which product you're going to take forward is a choice we're now having to make that we had the luxury of not having to make before. So I think it's getting better though. So those products that are superior in your portfolio or amongst the competition will rise to the top.
And Campbell, for you, if you were asked to do a presentation on your investment thesis for the next sort of 5 to 10 years, what are you looking at?
Well, if I just speak to the commercial property side of it, but one of the comments applies to it, I think it's just going to be the environment of inflation that we're going to have. I don't believe that central banks will get it back in the bottle where they want it. There'll be higher levels. I think we're going to be living with inflation rates across the globe of between 4.5% and 7%. So I think the era of ultra low rates is over for the moment. And the reason is because there isn't the same political pressure on politicians for fiscal discipline. So like Australia, who've, you know, for example, for years had, you know, balanced budgets, the idea of debt was anathema. Politically, it was significant, not anymore. So that's just one example. So I think that really does actually push money back towards bricks and mortar. It's a pity, you know, because, you know, I think, you know, if I just speak from an Australian context, Australia was bad before where we've just got to, in that we didn't allocate enough risk capital to biotech, to tech startups and the like. That's historically been bad compared to, say, the United States, and there was a very limited VC space, still is, that's what you're sort of helping to try and fill. But I think when you've got higher inflation, it's going to be to the detriment of the higher risk areas because they just, you know, because people are going to be looking for more solid investments.
And I suppose to dive more into some of the wins that you'd be facing or you'd be sort of talking about, and I know you've got a lot of sort of networks in commercial property and so forth. What is the, you know, in San Francisco, in New York, they're talking about the issues, how buildings are now being valued at half of what they previously were. The issues of, you know, work from home. I don't know if Singapore has the same issue as far as trying to get people back to the office or them having to mandate people coming back to the office. What are you seeing as far as, from your perspective, what's taking place? And I suppose where is the threats and where is the opportunity?
Well, the big threat at the moment, which is the opportunity, is in the office space. And those people who heard my presentation just before lunch, I'm sort of repeating myself a bit here, but the sentiment against office is very negative. Okay, and you talked about the sort of the post-COVID people working at home. I would say that the top end of town, the large corporates and government have had particular difficulty or reticence to require people to come back and work. Now, I do actually have a feeling that that's going to continue. That's going to end. I don't think you can run productive organisations, build teams, culture, and achieve your objectives if you have a lot of working at home. I think you've got to
the very companies that really like the idea of work from home for a start with are the first ones mandating it to come back to the office.
Yeah, exactly. So where is the opportunity? Well, the opportunity is because the sentiment is so bad at the moment, parts of the commercial office space are being overlooked. So Bruce Anderson from Stronghold said this, and I said this today, that if you go to suburban areas, suburban office, which has great car parking allocations, good public transport, accessibility to major motorway networks, that's in demand. Companies, SMEs in particular, want to be there. We've got buildings that are full outside the Perth CBD. 10 kilometres south of the Brisbane CBD. We've got one we're buying in Canberra at the moment, which has been poorly managed, but we will fill it up. We're very confident about that. And the point is you get to buy those things really, really well. They have been undervalued. There aren't people wanting to be in the space at the moment. So that's an opportunity.
And Kishore, for you, as I said, you cover a lot of different sectors. What are the sectors which you think are going to experience I suppose, the greatest rise over the next sort of 2 to 3 years?
Okay, so I would say hydrogen, ammonia and ammonia storage, anything to do with that, and mobility. So these would be the three main spaces that I will be thinking that there's a lot more growth in. Simply put, the way that we need to change the kind of energy sources that we get have been a lot of pressure by governments as well as corporations to try and change these kind of usage of coal and oil and gases like fossil fuels. It's a hard shift, but it's something that a lot of companies are working on right now. And having those kind of alternative energy storage as well as energy creation platforms is really, really important. And ammonia and hydrogen seem to be the most promising ones in the recent years, at least from the startups I'm seeing. Another one would be also wave power, wave and offshore wind power. There's a lot of companies coming up in this space as well, but we don't see many of them actually having any successes. It's more towards companies that are in the corporate level that are able to inculcate these kind of technologies. But from the startup scene, I don't see many technologies in this space that are being successful.
Have I got some introductions for you?
Absolutely. Russell's just down there at about the third or fourth row.
I was going to say, we'll just walk you around and have a chat to some of the companies. So my own personal thesis, and I'll get the guys to finish on their own sort of, just on sort of any final thoughts. I mentioned at the start today, what I'm so excited about for this next 5 years. And yes, this last 18 months has been hell for our space. Wee Meng was up here talking about some of his, being open, talking about some of his failed investments, talking about how he got punished. It is such a hard thing for companies, especially alternatives. But what is interesting from my side is we were doing an event with a company called PEP. So in Australia, PEP is one of the largest private equity firms. And one of the things that they indicated was how the private markets is going to become great, how there's a lot more money going into the private markets, and how there's more and more companies looking to stay longer private and actually not go listed at all. And I suppose, both of you can attest to how difficult it can be to be a listed company in an environment where you need to sort of raise money. But the 5 areas I mentioned as far as, obviously all the different interests coming out from innovation in software, AI, and so forth, it means as us as business owners, we can build businesses faster with a lot less people than what we required beforehand. Therefore, the capital that we required before, we may not need as much. And this is what I think will be interesting, because really, if you think about the VC model needs more capital, more funds under management for them to grow revenue or bigger value exits. So I do wonder what this capital raising space looks like 5 years from now, if there's not the requirement for the large funding rounds previously to hire the amount of people. Then also the other part, the desire for the greatest transformation I see is the millennial wealth transfer, where baby boomers are actually transferring. It's something like $24 trillion in the US alone over to millennials and Gen Z. And so that changes the whole game as far as what are the investment trends coming forward, what are the consumer trends coming forward. Then you add to things like that as far as digital assets and crypto, which is very much built by millennials and Gen Z. Then you've got the Bitcoin halving. Then you've got network effect, which if you look at this next generation coming through, that is pretty much what they're all sort of, it's what they've grown up on, it's what they've been built on. And then you see the cost of some of the innovative technologies, obviously not for the investment in life science, but genomics as an example, the cost to sequence a genome going down from $1 billion in, what was it, 2000, down to $600 now per gene. That is absolutely nuts. So when I think about this whole area between the excitement of all those areas I mentioned in the innovation space, and then you've got private markets looking to become a lot bigger, to me, the alternative area is likely to become one of the most sort of focused upon areas going forward. And then with that, we'll probably get more media coverage, more disclosure, more people more investment coming into it. And my favorite saying that I learned from one of my shareholders is a rising tide lifts all boats. And that's why I like, that's why life science is interesting, how it goes through its sort of ups and downs. I know you've experienced with your share price, but when it goes up, and I remember a VC talking about when the bull market is on, that's when a lot of the wealth is actually generated. The hard part is for us, we've got to continue building regardless of bull or bear market, and so there's a lot of, from my perspective, having that helicopter view, super excited about what comes next, but also very cautious about things related to obviously how war can impact, the continued impact of inflation, how it affects capital coming into this space, and then also doing, I suppose, making sure that investment continues to go into innovation and more opportunities get created. So they're the sort of things I'm thinking about from my perspective. Just a final note, I know we're sort of running out of time, but just a final note from each of you. Any other thoughts on your sort of own investment perspective going forward? Starting with you, Ryan.
I think it's as you suggested, and Leslie made the point before, that it's been a really hard time in tech these last 24 months. I mean, really, really bad. And so a lot of the companies that were there are no longer there. And I think a lot of the cream has risen. There's the old adage in life science that good science always gets funded. It doesn't necessarily always get funded at fair valuations. And so that's the problem that we've had, but we are building businesses here and we've got to do it throughout different parts of the cycle. So I'm just grateful that firstly M&A has kicked off within our industry, which is a good sign. And then albeit the cost of capital may remain higher for longer, at least it's high, but with the prospect of coming down or at least staying stagnant. And what investors really don't like is the uncertainty of it continuing to rise. So yeah, I'm confident that there are better times ahead. And when you've been through a market as bad as that, at least you can say the only way from here is up.
Leslie?
Ditto, Rowan, totally.
It's been rough.
But I think you just have to stay focused, because at the end of the day, what you invest in a biotech company or invest in another company is to be able to produce what you're doing. And I'd like to be able to say, I produce a drug that cured certain kinds of cancer. I mean, and you would want that too as an investor. So I just have to keep focused, do multiple roles, do a lot more with the amount that I have, and produce.
Look, I just think it's probably in our business, it's about trying to take advantage of some of the technologies, particularly in the ESG sort of space, to help us run buildings more efficiently, squeeze more out of it, to help retain tenants, lower their cost of occupation, and deliver some better returns to investors.
Okay, so I personally think that the investment thesis right now is that everyone is holding back on their money, and the market is going to be a bit more bad for the next couple of months until the end of Q1 next year, I would say. So whatever we thought it was bad, it's going to only get worse from now on. But my word of advice to founders would be to just keep your head down, just continue doing what you're doing, and eventually there will be a VC or some angel investor who would believe in you, and just do the good work. And hopefully things will turn much better soon, and we all can rise up together.
Well, thank you everyone for participating. I just suddenly can't speak. Much appreciated getting your insights for our panel session. Thank you everyone, and back on to the next session. Thank you.
That was the last panel discussion of the day. That was definitely an illuminating discussion, highlighting what's definitely available in the alternative investment space. It's now time for our final group of presentations for the day. Please join me in welcoming our first set of speakers, Mike Nahan, Chairman, and Raj Agarwal, the Finance Director at Austvolt.
So you're going to have the good fortune of having to listen to me twice. Mike was my colleague who was meant to be giving this presentation, and yesterday morning when we were leaving Perth, he realized that his passport had expired. So I'm going to have a go at this. And I'm going to start off with a statement, and I want you to ponder over this statement. In my view, electric vehicles are winning the race to decarbonize the mobility sector. If you believe that that statement is true, then this is a company that you should be thinking about investing in. So right now, whoa, that got really loud. When I talk about battery vehicles, there's 4 problems that we're finding in the world in terms of uptake of batteries. The first one is that there actually is not enough mining taking place to extract the minerals required for battery production. And if there is enough minerals, the challenge is that a lot of the cell manufacturers do not have access to those minerals. The other thing is, and I personally own an electric vehicle. It is a really, really heavy car. It weighs 2.5 tons. So batteries need to become lighter. They need to become more energy dense because we want to increase their range. And we want to make sure that we can charge them a lot faster. So this requires a lot of innovation in battery chemistry and technology. The other thing we need is that the prices of cars have to come down. Electric vehicles prices have to come down. And a huge portion of an electric vehicle's cost sits in the battery. And then I consider it to be a secondary order issue. A lot of people might say, no, it's actually a key issue, is that the battery supply chain should be ESG compliant. So if you agree with those 4 statements, then Austvolt is trying to solve all 4 of those problems at once. What is Austvolt? I'm going to go straight to a particular slide. Austvolt is producing, if you're familiar with a battery, and most of you would be, there's a plus or a positive part of it and a negative part of it. The positive part of it is called a cathode. And 60% of the vehicle or the battery cost sits in the cost of that cathode. So we are trying to innovate in the cathode side of the battery. And what we're trying to do is increase the quantity of nickel in the NMC technology. The more nickel you can get into the cathode, the more you drive its cost down, and the more energy dense you make that battery. So we are the first company in Australia to have produced 85% cathode. To understand, or 85% nickel in the cathode. To understand what that means, the more you increase the nickel content, the more unstable your chemical reaction becomes. And so we're trying to drive really towards the cutting edge of how much nickel you can put into a battery. If we can succeed in doing this, we will bring down the cost of the battery, we will make it more energy dense. And that is really the focus of this company. What makes you know if you've been successful? It's those funny images that look like little balls. That is a cathode active material through a microscope. And the aim when somebody says, have you produced a cathode active material, is that those balls should be a certain distribution in terms of particle size, and ideally they should be completely round or spherical. If you've achieved that, you know that you're producing a cathode that works, and we've been very successful in doing that to date. What makes us unique? I mean, this is really, when we talk about battery technology, we're actually talking about a chemistry play. It is not so much a particular type of software or anything. It's really, can you create the right chemistry? So what makes us unique? There's actually 3 things. And the first thing is probably something that not everyone understands, is that it's our physical location that makes us unique. We're based in Perth, Western Australia, that produces a huge amount of the raw minerals. And more importantly, there's only one nickel refinery globally, only one globally that produces nickel, battery-grade nickel, and that is the BHP refinery in Kwinana in Western Australia. Our facility is located adjacent to it, and we will be piping that nickel directly into our facility. It makes a big difference to how cost effective we can be. We're literally the only company that has an individual who has produced 85% nickel cathode, and we're very fortunate that he's decided to join us. We managed to poach him out of an organization called the FBI CRC, or the Future Batteries Industry CRC. And if we can achieve what we're trying to do, then we stand to be able to gain significant market share in the battery electric sector. There's some other benefits of being located in Australia. The first is a lot of the materials can be traced back to where they were mined, and they can be done in an ethical way. The one mineral that is very hard to source ethically today is cobalt, which is an important part of this. And that gets produced with nickel, but Austvolt is using a recycled cobalt out of India for its cathode. Our facility is actually going to be powered by green energy. I mean, this has become very cliched, but the reality is that Western Australia has some of the best natural resources in the world, and it has some of the best renewable resources in the world. And our aim is to fully decarbonize the supply chain right till the mineral comes to our doorstep. We've created a really interesting team. It's chaired by Mike Nahan, who is the person who was meant to be here today. He used to be the former Energy Minister of Western Australia, understands this sector really well, has some fantastic contacts. I want to say one other thing in relation to where we are today, which is we've been on this journey for about 4 years. And while we've been on that journey, we've created the first laboratory scale facility that has been producing this cathode. For us to be able to find an off-taker or continue our discussions with some of the big car manufacturers globally, we have to prove that we can take that cathode that's being produced at a laboratory scale and produce it at a commercial scale. So our first fundraising was used to fund the laboratory. The second fundraising which we received, which is $8 million from the Australian federal government and from the West Australian state government, is being used to create the next size of laboratory, which will be completed by December. And this fundraising will then allow us to move on to the actual site where we'll be starting commercial production. So our aim is to raise $5.2 million of funding, which will start the actual work on site. We want to move towards producing cathode active material very quickly. You might ask, is this profitable to do? So the more you go downstream in the process chain, the more margin squeeze you have. So we're just one step after extraction of the raw material. And very interestingly, at that point in time, it's still a very profitable business. Our current economic modeling is showing that on a 40,000 ton per year cathode active material, you'd have a payback period of about 2 years. And that's based on current pricing of cathode. So what are we looking at? We're looking at a development equity raise of about $5 million. This is a business that currently shows that it should produce about $180 odd million of free cash flow per year. Very, very profitable. And it's very profitable because you're taking the raw material directly, processing it, and then shipping that raw material. To understand, we are not, a lot of people think about lithium as a key part of battery manufacturing. Lithium comes after the stage that we're doing. And our finding is that it's more economic to ship the lithium together with the precursor cathode to the place where the cell will be manufactured. And that usually happens wherever the car manufacturer is. So that's a very quick summary of our business. Our hope is that we will create a liquidity strategy for investors, either through a listing or more likely through a trade sale. That's the aim of this business over the short term. And we're looking at investors with you don't have to be investing that quantity of capital. We're looking for small-scale investors who really want to go on this journey with us. We want to open up the global market for cathode manufacturing, and we want to create one of the leading cathodes in the world.
Now let's move on to our next speaker, Ahmed El Safti, the founder and CEO of PowerCap Un Limited.
I'm glad we had that presentation before mine because I don't have to explain how batteries work, which is great. And certainly a very interesting presentation just before us because there is a lot of money being spent on the development of battery technology. So I'm just going to point out to you very quickly, I'm going to have to skip over a few slides here, but exactly where we are with our battery manufacturing technology and business overall. So the company is seeking to now raise somewhere in the order of about $90 million. As a matter of fact, the first time we actually presented, we thought we may only need to raise $30 million to be able to get us through the prototyping and contract negotiations to be able to sell out our production capacity. Well, that actually happened in a blink of an eye. So we're now at the stage where we're looking to build a gigawatt-hour scale battery plant in the Ipswich region of southeast Queensland, plus at a later date build one that'll be 20 times that size in Jacksonville, Florida. So effectively, the company is seeking to raise that capital to be able to get that expansion underway. So just a brief history about the company. I'm actually a petroleum and a chemical engineer and worked for Caltex Oil in Australia and then Chevron and Texaco in the US. So my background has been fossil fuel. So in 1995, my wife and I, which is the blonde lady in that photo on the right, and our CFO and co-founder, had a trip in Taos, New Mexico in 1995. And these guys are actually completely off the grid, and they were using batteries that they pulled out of forklifts. We nearly missed our flight because they ran out of battery energy storage capacity. So that was the aha moment for us. So we've developed since then hydrogen fuel cells, ammonia reforming technology, but we've mainly concentrated in the last 6 years on battery development. And we've developed a sodium solid-state battery. So the sodium solid-state battery, unlike the NMC battery, uses a very low-cost sodium substrate. Sodium, by the way, is sodium chloride, common table salt. So we can extract this stuff from the ocean or purchase it from people doing desalination at less than $400 a tonne. I'm talking in US dollars. The comparative lithium and other metals could range anywhere between $5,000 a tonne right through to about $30,000 a tonne for lithium. So that's the reason that we focused on sodium. So we employ 12 postdoctorate researchers. There's 40 engineers all up that are working on this. And we partnered with the University of Southern Queensland, who have recently been ranked to be the #1 science and engineering university globally, which is a significant milestone for us. I won't go through too much of the other information, but effectively using a solid-state battery eliminates any potential for combustion or having it become flammable. The minute that you introduce solid state, you remove the liquid electrolyte, and it becomes a much safer battery. We also use a compound of sodium. We don't use sodium metal, so nothing can combust. It's 100% recyclable, and the testing that we've had so far has shown for 2,500 cycles that we've had little to no degradation. So that just gives you an idea of the testing that we've done. As a matter of fact, the Generation 1 cell that you see there that's had 3% degradation is a nickel, manganese, cobalt battery that we manufacture right now using graphene as the anode. Still a very stable battery. But the applications there are wide. For stationary applications, things like grid stabilisation, virtual power plants, microgrids, just to name a few, plus also a lot of mobile applications, as you can see there. So we've been negotiating with 4 major multinational companies now, including Coca-Cola and AxionLog. AxionLog is the distributor for McDonald's, KFC, Pizza Hut, Carl's Jr., Subway, etc. for South America from North America. And a lot of the problems that they've had have had to do with a lot of brownouts and blackouts. So we've been looking at providing energy security systems for them, which, by the way, we've successfully have been able to do. So this is a project that we did on the north side of Brisbane, and it's the Baptist Union Church together with the Serenity Aged Care Facility head office. So we put solar on there and we installed our batteries there to support the solar. And we actually provide them almost 100% of their electricity, and we're saving them 45% on their current nearest grid price. And incidentally, the Coca-Cola guys, when they came over, that's what took their interest. So this is an animation of what we're looking to do for Coca-Cola. So in the middle of the day there, we can just fill up the batteries, etc. And then when it gets into night time, the power then can go through and supply their bottling plants. Coca-Cola have got roughly about 1,000 bottling plants, and they need about $20 million worth of infrastructure to be able to get that energy security. At a saving of about 20% per annum. I won't talk to you about the AGV. I'm running out of time. Look, I'm going to have to skip through some of this. One of the other products that we're supplying them is a smart UPS where they can actually plug our battery into the wall and then buy their electricity in the middle of the night to supply their Coca-Cola fridges, so that the folks that are running the point of sale don't turn off the fridges, which is, by the way, what they're doing in the majority of Latin America because of the increased prices. So we're delivering that to them as well. We've designed an electric fleet for them, and we're in the middle of getting those prototypes ready for them to be able to do testing and to be able to get certification for those products as well. That's a big driver to battery sales. So these are the sorts of figures that we're looking at supplying them on a yearly basis. So there's a couple of major plants that we're building at the moment, ones that are in Ipswich in southeast Queensland, and the other one in Jacksonville. The other 2 companies that we've been talking to, 3, Serenity, Crowley's, and United Parcel Services for their electric trucks. We've opened up offices in the US now, so Dave McGrath is our Vice President for US operations, and the board, our chairman, is just sitting out the back there. You would have seen him sitting with me at our desk, and myself and my wife actually set up the company some 13 years ago, and Ken chairs our small board. So thank you very much.
Next up, we have our next speaker, Nathan Fielder, the chairman at Sequester Offshore.
Hi everyone, I'm Nathan Fielder, the non-exec chairman of Sequester Offshore, a Perth-based company looking to develop a cost-effective, common, open access solution for safe and permanent disposal of carbon emissions. It's for those industry and company that are looking to reduce their emissions in line with corporate and regulatory targets in an effort to contribute to net zero by 2050. As we know, climate change is widely recognised as an existential threat to life as we know it. Responses from countries and organisations and businesses must match the scale and urgency of this worsening situation. As we're aware, the ambition of net zero by 2050 is unlikely to be met unless we are on track to achieve these targets by 2030. The transition away from CO2 emissions will rely on an increased use of renewable energy, which we've heard about today, and certainly carbon capture and storage. To have any hope of keeping global temperature increases below 2 degrees Celsius, the immediate development and deployment of an abundance of carbon capture and storage is desperately required. CCS, as we know, has been utilised for more than 40 years in certain locations around the world. There's 100 projects that have been developed. There's been one in Norway, Sleipner, that's been operational since 1996. There's proven efficacy in carbon capture and storage. However, currently there's only 32 million metric tonnes of storage been identified, but there's a small fraction, 0.1% of emissions as of the end of 2021. McKinsey have estimated that more than $150 billion are needed in investment to expand the storage requirement. So Sequest is here on a Series A raise. We're raising 2.5 million Australian dollars, 75 cents per share, and we're expecting to close our book by the end of September. So more about the Sequester opportunity. We're solving a critical carbon storage capacity issue. We have a flexible, cost-effective, permanent sequestration method, and we have a breakthrough innovation which is creating an industry advantage for us. Rapid deployment is a key advantage. So our system, which I'll explain in a moment, is capable of deployment to field operations within 18 months of regulatory approval. I'll go into a bit more about our low cost compared to other solutions requiring much more infrastructure and operational cost. We deliver a cost benefit. We have a flexible and scalable solution. As you'll see, we can deploy multiple multiple Pivotrees with our carbon harvester vessel, and we can move them around as our clients require them. And of course, we deliver permanent disposal of CO2 on an industrial scale. So this is how our business model works. You can see there that we collect a CO2 stream from an industrial emission source. It's then loaded onto our carbon harvester vessel, which is targeting a 50,000 deadweight tonne storage capacity. We then take that out to our injection site after we've gone through all of the seismic and geology work that is required to obtain the injection permit. We then connect up to the Pivotree, which you would have heard a little bit about earlier, which we have under a worldwide exclusive license for CCS activity. And then we inject downhole into a reservoir. Now, what that'll enable us to do in some jurisdictions, well, I should say we charge a waste disposal fee from the emission source. We then run through our operation, and in most jurisdictions, the permanent sequestering of CO2 will enable us to obtain a carbon credit, which we can then look to monetize down the track. It's, as I mentioned, a very scalable solution. So what you can see here is what we're calling a CCS hub setup, where we have multiple Pivotrees deployed and then in circuit multiple carbon harvesters running from the emission source. They're stationed then on the Pivotree, where they're injecting their cargo down into the reservoir, returning and repeating. A hub setup like that is a lot closer than you think. We've formed with our industry partners a CCS Hub Alliance, which will be formally announced at the GasTech conference next week. So that's bringing together the collective skill and experience of Axons, who are a French CO2 capture partner. We have Doris Engineering, again a French-based engineering and project management team, and we have AWT, who are the reservoir experts. We also have several other MOUs with other industry partners. So the idea that we're targeting with the Singapore CCS hub is up to 5 million tonnes of CO2 annually being taken away from the industrial emissions of Singapore and sequestered elsewhere. As you'll all be aware, that the cost of carbon emissions is rising. A quick scan of some of the local jurisdictions' carbon prices in Australia, we're heading very quickly towards $75 a tonne Australian. Here in Singapore, you've got a staged increase up to $80 per tonne by 2030. And then if you look across Europe, the prices for carbon up there are around €140. So Sequest's lowest cost advantage, as I mentioned, in order to deploy a carbon harvester and a Pivotree configuration is a capex cost of around low $100 million US. We have an operating OPEX of around $38 US per tonne of carbon sequestered. Now, if you compare that to our peers, we've got the Chevron Barrow Island CCS project, which they have spent more than $3 billion US. They've got an operating cost towards 100 Aussie, 77 US dollars a tonne. And then if we compare that to what's happening in the North Sea with the Northern Lights project, again, they've spent capex in the billions and have a OPEX around $62 per tonne. Our board and management team is lean but effective. We've got great skills across offshore operations and exploration. We have well integrity and geoscience, finance. We have health and safety and a great commercial team. In the short time since we incorporated last year, we've achieved tremendous progress with the team that we have. We've incorporated in February, as I said. We submitted a bid for offshore acreage in the last round in Australia in 2023. There were 5 blocks. Our bid was unsuccessful, but we learnt a lot and developed a lot out of the process. We completed our seed funding round in July. And then, as I mentioned, we were one of the founding partners of the Singapore CCS Hub Alliance with Doris, after which we then commissioned some engineering work to develop our flexible riser, which connects the Pivotree to the harvester. And again, we then joined the Kwinana Industry Council, which is one of the major industrial hubs just south of Perth. And we've engaged with them to deliver a feasibility study subject to an award of a grant in the coming weeks, where we will help them with their carbon emissions reduction targets of 8 million tonnes per year. Again, another MOU with InCapture, who are a subsea geoscience partner. And again, we formalised the exclusive licence with Pivotree in April this year. And we've now opened a Series A funding round to continue to propel us forward. In terms of use of funds, so $2.5 million Australian finalising the carbon harvester and topside engineering work. We'll be advancing our key business development activity, which is targeting both the CCS hub here in Singapore and also executing the feasibility for the Kwinana project. We're again going to be scanning the environment for greenhouse gas storage acreage, both here in Southeast Asia, Australia, and in the UK. And we're going to be building out our key executive personnel ahead of a potential ASX listing or a listing elsewhere. And just to finish on, we can't wait to act on climate change, as we know. We can't wait for a perfect transition, and with Sequester, we just can't wait to help. So thank you for your attention.
Now let's move on to our next speaker, Raj Agarwal, the Executive Director at Green Steel of WA.
Hello. Yeah. Sorry, everyone. You're going to have to listen to me twice today. So we've talked a lot about decarbonization, climate change. I don't know how many of you know that 9% of global emissions actually come from just making steel. And you know, one of the things I find really amazing whenever I come to Singapore is it's such a small country, but it uses an incredible amount of steel. So Green Steel of WA is a business that's trying to decarbonize the world of steel making. We're based in Western Australia, and some of you might know that Western Australia produces 900 million tons of iron ore a year. That iron ore goes to a particular country in Asia, and it gets processed through a blast furnace, generally run by coal, and that's what creates your steel. So there has to be a way to change the way that steel is made. In terms of Australia alone, about $100 billion of revenue comes to the country from the production of iron ore, but almost $400 billion of value is lost by sending that ore overseas for processing. The emissions from the Australian iron ore, we produce 1.2 billion tons of CO2. So this has to change. I'm going to talk a little bit about hydrogen as well, because there hasn't been a lot of chat in this session or in a lot of the presentations I've seen today on hydrogen. 6 months ago, 2 years ago, this was the real hype. And the problem that everyone is finding is that there is no buyer for hydrogen. Nobody wants to buy hydrogen. Whereas the reason why I bring this up is that the hydrogen industry's role, we feel, has a very strong link to steel making and decarbonizing the steel industry. So what is our plan for Green Steel? Green Steel hopes to become one day a multi-billion-dollar company that is producing steel. How are we going to do this? The first thing we're going to do is process recycled steel in Western Australia. Right now, Western Australia produces 600,000 tons of waste or scrap steel. It all gets exported. Every single ton of it gets exported. So the first thing we're going to do is produce recycled steel in Western Australia. That starts creating the industry, it starts creating the skills, and it helps create the ecosystem in which we can start making steel. After that, we're going to produce a product called direct reduced iron. For anyone who knows steel making, you have to reduce the iron ore into a pure ferrous product. And to do that, there's a particular, there's different technologies being touted, but the one that we're focused on is using green hydrogen or hydrogen that might be produced from natural gas as the way to reduce that steel. So the beauty of this particular step is Australia produces the iron ore, and the Midwest region of Western Australia is known to have some of the best renewable energy resources in the world. So you can combine those two to create direct reduced iron. And that project, we've kicked it off. It's in feasibility stage, where we're using technology by an Italian firm called Danieli and we've partnered with BP to provide the hydrogen. And there's a whole bunch of other initiatives that we're working on that will be further down the line, which is to take the less pure iron ores of Australia, which are produced in the Pilbara region, which is called a hematite ore, and trying to work out a way to process that ore through the same system. So that is the plan for the business, starting, as I said, with the first mill that will be in the southwest region in a town called Collie. Somebody spoke about it earlier today. This mill has started its development phase. It was given a grant by the West Australian government. It's a very proven business model. It's being used all over the United States. Almost every major city in the United States has a recycling mill. A lot of the cities in Europe have a recycling mill. A lot of the OECD countries in Asia have a recycling mill. So we're just doing exactly the same thing. The great thing about this is it will be powered 100% by renewable energy, and that will allow the steel that comes off this facility to be accredited as green steel. Right now, a lot of the steel that goes into Western Australia, incidentally, actually comes from Singapore. That mill is going to be the most energy efficient in Australia and the lowest carbon emitting mill in Australia. This particular business, the reason why we're doing recycling also is because it produces cash flow, and it produces cash flow very, very quickly. And it's incredibly profitable. I find it really amazing that recycling can generate this sort of cash flow, but there's great precedence for it from Nucor in the United States and Commercial Metals, both of which are earning about $500 US a ton as a profit margin. And so on a 400,000 tons per year recycling mill, it starts producing cash flow of $200 million a year, which actually helps to fund some of the further initiatives that we have on place. This mill hopefully will be ready for construction by the third quarter of next year. We've got all of our partners on board. We've got the technology provider on board, a lot of our advisors on board. Then, as we move forward, our aim is to then work out how we're going to crack the code for DRI. And so we've now secured a piece of land in Geraldton, which is the Midwest region, where we're looking to develop. We're working with a couple of iron ore miners in that region, and I said BP, to work out if we can produce DRI. The feasibility currently looks very positive, but it has a way to go. And as I said, there's a whole pipeline of opportunities that will come if we can be successful in DRI. The first one is a Midwest DRI plant in the same region in a place called Malawa. We've started a pre-feasibility study. Nangaloo is an industrial estate next to Geraldton again, where we're talking to a different set of iron ore miners and a different hydrogen provider. We're talking to one of the largest iron ore miners in the Pilbara, and they're working on an electric smelting furnace. This has been public knowledge. They're talking about co-locating with our electric arc furnace in Collie so that they can process their mine through our facility. And then in the southwest of Western Australia, there's another region that's very iron ore rich, and we're talking to the miners there. So a huge opportunity opens up if you are interested in it. Very solid team. McKinsey, Bain, Macquarie Bank, oil and gas, project development. The team is there really to try and create a diverse skill set and make our vision true. We're looking for $5 million. This will help drive the Southwest project to completion and acquire some land in the Nangaloo industrial estate, which is where we want to get the DRI project going. As I said, very profitable. We will work on the exit strategy. Current thinking is that it's probably not going to be an IPO. It's more likely that one of the major steel operators globally, whether it might be Arcelor, might be Nat Steel from Singapore, will buy out the project. And that's it. So if you wanted to talk to me about either one of this or the previous project that I presented, I'll be outside. Just drop me your business card. Thank you.
Next up, let's invite our next speaker, Dennis Murray, founder and CEO of Profsee.
My name is Dennis Murray. I'm the Profsee co-founder, and I'm going to present to you an opportunity in the financial services sector. Financial advisors are leaving the sector in significant numbers. There is now an undersupply of good financial advisors in both New Zealand and Australia. Part of the reason is that the cost of compliance is increasing and digital technologies are making life difficult for some of the older advisors. The average age of advisors in New Zealand in particular is late 50s. Profsee is a cash roll-up consolidation of the sector underpinned by technology. And that technology is going to increase efficiencies, meaning that investors are going to enjoy excellent margins. Profsee is a cloud-based ecosystem solution that adds value to every step in the value chain. It is a SaaS business with recurring revenue. Now, that revenue is projected to reach $80 million within 4 years. We are going to drive that revenue primarily by acquisition, but there is also going to be organic growth and cross-selling. So there is a significant opportunity there for having that sort of growth achieve the targets that we want to do. In fact, we believe that within a few years, probably about 18 months actually, we will achieve recurring revenue of around $10 million per annum. Now, we have received a report validating the Profsee acquisition strategy. What we need is that we need $60 million to help us drive that acquisition strategy and to achieve the scale that we are aiming for. So what we are asking for is the investment to create a profitable centaur, a company with revenues of $100 million or more. We have the expertise and the systems and the content. Profsee is approved as an acceptable direct investment for New Zealand residency. Those investors have to remain in the investment for 4 years. Our exit strategy for those investors and for others will be to list on the ASX. And as I said before, we believe that we will be able to do that within, well, we'll probably start that process within about 18 months of first investment. The numbers do look good. The target of achieving the $80 million, once you put the technology underpinning, the efficiencies, the margins are excellent. I'd like to thank you for listening to me, and my contact details are there to get in contact with me either directly through the CRISP platform or by contacting me directly. Thank you.
Good afternoon, ladies and gentlemen. Campbell Newman from Arcana Capital. I've been up here a few times today, but this is now a bit of an introduction to what we do in a more direct and informative manner. So Arcana Capital has been going for about 7.5 years, and what we do is we allow investors to build their own high-yielding commercial property portfolio. Our emphasis is on distributions, on income distributions, net of fees, regularly to investors. We pay monthly. We're providing the structure and the compliance and a stream of interesting opportunities to our investors. And importantly, it's a direct ownership model. So we provide an opportunity for people to buy directly into a unit trust, a special purpose vehicle, if you like, of a specific asset. Sometimes we'll have 2 or 3 like assets in the trust, but they're closed-ended unit trusts. And yes, we're providing monthly distributions. Our big focus as well is capital preservation. So our deal is you trust us with one of your dollars, you'll go into an investment opportunity for 5 to 7 years. Along the way, we'll pay you 7.5%, 8%, maybe 9% a cash distribution each month. At the end of that investment period, it's a decision of the investors and basically a vote of the unit holders to sell an asset, and we then aim to give you your dollar back. Now, we'll try and get you $1.15 or $1.20 and give you a good IRR, but capital preservation is critically important to us. Our track record, since we started, we've done 230 million Australian dollars in acquisitions. Currently, we're managing $123 million in equity, providing distributions of 9.44 million. The current weighted average distribution, if someone had invested in everything along the journey with us, they'd be getting 7.5%. I just reflect for a moment, that's down this financial year. Last financial year, 22-23, we delivered 8.5%. We do create a leveraged product, and with higher interest rates, there's been pressure on those distributions. But as I said, if you were in the earlier session, I did reflect that the interest rate cycle in Australia appears to be peaking out, and we're starting to be confident now there won't be further pressure downward on distributions. Across 5 exits since we started, we've seen an average IRR on our projects of 15.1%. So we're delivering cash distributions regularly, but also positive capital gains as well. And one critical point is we always invest. We will not put an investment opportunity forward to our investor base unless we're prepared to put serious hurt money on the table ourselves. Leadership team, myself, Christina is our CFO. She's had a 20-year track record in being involved in the management of major property assets. Peter is in the business, has been for 7 years. He's a former executive with Rio Tinto, one of Australia's or global mining companies, and has the responsibility of dealing with investor relations. And my wife, Lisa, is also director of the company. And myself and Christina hold the actual Australian Financial Services licence. So that's like a licence with that you'd have with the Monetary Authority of Singapore. Our licence is for wholesale investors, or as you call it here, accredited investors. We've got a diverse portfolio of assets. We've got property right around Australia, from far north Queensland to Tasmania, across through Adelaide to WA, with industrial assets in the goldfields at Kalgoorlie, and also an office building in Perth. So there's quite a diversity of assets. We have fuel, convenience retail, neighbourhood shopping centres, large format retail, car showrooms, industrial assets, office properties, and we have also had childcare facilities. Some recent acquisitions, just to give you some examples. The first one on the left, we call it the 18 South Logistics. This is in far north Queensland. This is a major agricultural logistics facility and processing facility for bananas, a very large proportion of the banana crop in far north Queensland. So in other words, a very large proportion of the banana crop in Australia goes through that facility. The anchor tenant is the actual Mackay's company who actually grow bananas and who built the facility. We bought it as sale and lease back. We also have Visy, who are a global packaging company, and that is delivering a 10% distribution to investors right now. We then have 65 Carnegie Street, Kalgoorlie. This is a brand new industrial asset that is in Kalgoorlie. That's the goldfields, but it's also, and we're hearing about forward-facing minerals before and batteries. This is where nickel's being produced. This is a centre for mining exploration for those forward-facing minerals. And we have 2 brand new facilities in Kalgoorlie. This is one of them. So that's delivering 7 3/4. And then on the right, we have one of the office buildings in the Capital City Office Trust. This is just a kilometre outside the Perth CBD, fully tenanted suburban office. The anchor tenant is the Department of Child Safety of Western Australia, and it's fully occupied with some other tenants as well. And that trust has this and another asset in Brisbane and is delivering 7 1/4. Our latest acquisition, this is this one. We've just completed the capital raise for this. We raised $13.4 million. It's an example of what I said earlier on in the panel discussion, in that if you get high quality suburban office buildings, you can actually buy very, very well. We're buying this at a 9.1% cap rate because there are few buyers out there in the market at the current time. Hasn't been particularly well managed. It has a significant vacancy at the moment, but we've got very strong tenant interest, and we're already, even though we haven't settled it, getting on the way to actually fully tenanting that building. And it's paying an 8% distribution from the end of September this year when we settle. Just before I conclude, just a bit of a structure here to illustrate how these assets are held in a beneficial way for Singapore investors. On the right there, you have the property held by an independent custodian. You have the trust itself. As long as it's got 25 plus investors, it has non-recourse debt from a major Australian bank. And you will see the Australian investors coming in there. If Singapore investors then come in either individually or via a collective investment vehicle, at that point it could qualify as a management investment trust on the advice that we have, and it would be the case that Singapore investors would only be levied with a one-off 15% withholding tax because of the tax treaty between Singapore and Australia. So that's the way we're sort of recommending that people look at trying to invest in companies like ours. So thank you very much for your interest. Thank you for coming to Wholesale Investor. It's been great to participate, and please look us up if you're interested in our products in the future.
Now let's move on to our last speaker for the company presentations. Now we have Dr. Ron Tan, the founder of Pathomics Health.
Hi, good evening, everyone. Nice to be here. Thanks for the invitation. Before we start, maybe just a short introduction of ourselves.
At Pathomics Health, we are committed to deliver high-quality, cost-effective genetic testing solutions and clinical diagnostics for your research and improving patient care.
Now, based on the video, our key focus of the company is actually on the area of the precision medicine. Now, I'm sure most of us are aware about the importance and the rising of the precision medicine. And the importance of it is that because in the Asia context, we are looking into a major problem of 11 new diagnostic cases every year. And 75% is going to come from the Southeast Asia, and it's going to be a major catastrophe. Especially so in the developing economy of the Southeast Asia, there's going to be a lot of financial burden that's going to onto these patients themselves. Now, so the precision medicine, by definition, we all know is actually to provide precise diagnostics coupled with the targeted treatments for better health outcomes. And absolutely, definitely is going to lower the healthcare costs in long run. However, precision medicine is now encompasses beyond just the diagnostic space itself. It's now broadly classified under 3 categories. Predictive modeling of diseases with, precise, using the huge data as the form of the to do a predictive of the risk, coupled with what could be the best recommendations, etc., etc., etc. Then followed by the preventive, which is about the stage of the early prevention, early detection, and early intervention of diseases. And of course, what we just mentioned about the personalized diagnostics and the treatments. Now, if you look into the whole Southeast Asia, which is where our focus of the market currently, as of today, they all have already got existing players and the markets in terms of the companies that is already in each of these space that we've seen here. However, we are looking into 2 major gaps that where we see our potential in. Number one is that there are 3 sectors here, but each of them are very fragmented. All right, so if you look at it in the whole entire predict, prevent, personalize, they are all interconnected, but however, they are in a very fragmented space at this juncture. Number 2, the insurance space. All right, we all know in the healthcare sector, other than the government, insurance play a very major role in this particular area. All right, and right now, as the landscape as it is today, the insurance is not playing an active role in here. The insurance market has not been actively been open. And this is where we differentiate ourselves. And so what is our value proposition here? We're creating what we call the PathNext digital platform for the precision medicine. All right, so we have created an ecosystem, an healthcare ecosystem that we have connected all the 3 pillars together, creating a unique value proposition in here. If we look into the predictive model, we have developed our own risk algorithm, our risk profiling, that is able to do a profiling for individuals for all the diseases that we talk about, cancer, diabetes, cardiovascular, etc., allergies, and so on. Now, the add-on to the whole entire proposition here is that our product is the first in the market to be validated by a global reinsurer. Now, the first impression that comes to you guys, your mind will be, hey, if I were to do a genetic testing today, and I present this data to the insurer, does that mean that if there's a high risk, I'll be excluded, or I'll be having a certain loading of policies and so on and so forth? We have changed that dynamics altogether. All right, we have created the first of its kind of an insurance product in the market where we have used genetic testing that is being bundled into an insurance product without any loading, without any exclusion. We will encompass everyone into this policy itself. All right. For example, let me quote an illustration in here. A healthy individual come to us, an insurer, buy this, what we call the critical illness product. They do the genetic testing itself. If they were to do a risk profiling of the diseases that is of the low risk, there will be a certain discount or certain privilege to the whole premium itself. However, if on the other hand, if there is a risk that is being captured, the high risk of a certain diseases for this particular individual, there's no loading, there's no exclusion, but we will have a caveat whereby you make the consumer to come back on a yearly basis to do the preventive studies with us, to do a preventive. In other words, we are creating a customer journey to build with the consumers where they will embark with us on a constant health monitoring process with them. So instead of just a one-time off doing a predictive product with them, we embark on them on the customer journey and building the entire journey with them to monitor their health effectively for them. All right. And so this is where the entire ecosystems have been established. And of course, if the patient is really down with the cancer, eventually we have the diagnostic and the technologies to create the value proposition of working with the pharmaceutical companies to provide the personalized treatment for them. So that effectively chain up the entire precision medicine value proposition in here. The entire value chain has been established. And with this value proposition, we have established our own proprietary IPs, our own product. All right. And we are now embarking on the 10-year government project in Malaysia. All right, and eventually there's another project that's going to come up in Indonesia where we will have a government as project with them to look into this entire value journey in here. So this is the whole network of the ecosystems that we have established, where we have our own partners and to create new insurance product and so on. Currently, the company, we have our major operations in Malaysia, where we are partnering with all the major hospitals and medical centers, clinics, etc. in Malaysia itself. In Singapore, we have our own operation that just started this year, our HQ, all right? So, and we have embarked a couple of the private entities in here to work with us, and we also have our partners and distributors around the region. And on the right, we are also partnering with the various pharmaceutical partners in the space of the personalized treatment, where we will be able to do a diagnostics and couple with them on the drug treatment for the cancer patients itself. All right, and we have also partners, well, just now I mentioned about the insurance products that we have co-created, and this is where we have a couple of the insurance companies with us, marketing this whole product itself. So, sharing with you the current project pipeline and the expansion plans right now. Right now, we have our operations in Singapore and Malaysia. In Malaysia, we have already secured not just one, but already have 2 government contracts that, a 10-year contracts that we are going to embark on in terms of the entire ecosystems, the value chains of, the whole health screening and the genomic testings for the whole populations. And, we are now looking into our expansion plans into Vietnam and Indonesia. So at the end of the day, what we emphasize in here is that we are trying to, while we are building our whole constant revenue channels, our value proposition through our ecosystems, what we want is building a deep data, deep tech infrastructure of leveraging onto the genomics data, where we are able to use the genomics data for drug, all right, for drug design, for drug treatment, where we can partner with the pharmaceutical companies. We can also partner with the healthcare product company for new healthcare product development. And we will also be able to leverage on the use of the genomics data on, all right, the insurance solutions itself. So where we are right now today, as we are doing a fundraising, and we are looking into a very highly sustainable business model with our fully international accredited facilities for us to do this whole entire, company value project development, and as well as the whole entire credibility standing in terms of our international standards in here. So in terms of the entire investment opportunities in here, we are looking into a fundraising of 5 million, all right, where we are using most of the funds is going to deliver the government contracts, the government projects that we are looking here, and we are going to do the market expansion into the rest of the Southeast Asia markets as well. And the rest of the funding is to build new innovations, where we are also developing a new one-of-its-kind genomics product for predictive modeling of cardiovascular diseases. And with that, thank you very much. We're happy to take on any questions.
Now we have reached to our final agenda of the day. We do have a keynote speaker. Thank you to all the audience for staying to this point. So joining us now is Pete Ward, a visionary leader and the co-founder and CEO of Humanity Inc. He will be sharing about his insights on the intriguing topic, Healthspan 2030, forging investments in our shared tomorrow. Furthermore, we will also have the privilege of delving deeper into his company and his remarkable endeavors. Passing my time over to you, Pete.
Thank you so much. Well, if you can hear me in the back in the left corner, you still have time to come in. Thank you, everyone, for making the effort. Those of you standing up at the back, why don't you come in, take a seat, get comfortable. I promise it will make you feel a little bit better afterwards. So why don't we start by just getting everyone to stand up. So if everyone can stand up. Yeah. Trust me, this is good for your health span. All right. Now, yeah, stretch out. Make sure you have a bit of space between each other. Now, I know this sounds really crazy, but I want you to start jogging on the spot. So do this. Come on. Faster, faster, faster. Come on. You know those fast feet? Keep doing it. 10 more seconds. Hold on. 5, 4, 3, 2, 1. Okay, stop. Now take a deep breath. Close your eyes, hold it, and out, and make a noise. Do it one more time. Hold it, and out. Okay, last thing I promise. I want you to turn to the person next to you. I want you to look into the person next to you's eyes for 10 seconds. Okay? This is the awkward bit of the presentation. But honestly, look at each other's eyes. Still a few more seconds. 4, 2, 1. Okay, great. So, why did I do this? I wanted to ground you guys a little bit into some of the modalities of health. So human connection, movement, breath work, and just mindfulness. There's a lot of things that we can do in our day-to-day that affect how we live our lives, how healthy our lives will be. And I think we can all do a little bit of that every single day. So with that, I'm going to introduce myself. So I'm Pete Ward. I'm the co-founder and CEO. You can all sit down. And I'm going to be talking about Humanity, which is my company, but in the context of how we can all make a huge impact in making the world a healthier place so that we can help not just ourselves, but others increase their health span and be around for their grandkids. So to start off, I'm going to show you a video. Volume up, please.
What these guys have built already is incredible. Humanity is transforming people's health, and I cannot wait to see what's coming next.
There are very, very few people who can build awesome products in consumer and health tech. And Pete and Mike are two incredible individuals who can do just that and more. That's why I invested.
Cancer, cardiovascular disease, Alzheimer's, and even diabetes are primarily caused by one thing: aging.
The problem is we rent our health, and then when the repair bill comes due, we wish we had invested in it.
I lost my dad to a severe stroke in his early 60s after he became type 2 diabetic.
I lost a loved one to late-stage cancer. I felt completely helpless, but that's all about to change.
Your genetics is not your destiny. Aging is measurable and reversible.
We aren't helpless. For those of us still lucky enough to be alive, there's a science to longevity. There's so much we can do to live longer, healthier, and happier lives.
Which is why we built Humanity. Humanity takes the cutting-edge science of longevity and places it in the palm of your hand. At its core, it does two things. One, it monitors your rate of aging and biological age. And two, it guides you to slow it down and even reverse it. Under the hood, it uses AI to analyze your movement, heart rate, blood biomarker, and lifestyle patterns captured from your smartphone, wearables, and Humanity app.
It's like the Waze traffic app, but for your health. People have never had a concrete feedback loop to let them know if what they're doing to be healthier is working.
Humanity is that feedback loop.
We are giving that superpower.
Humanity's founders have already scaled their direct-to-consumer platforms to over 1 billion people. I believe Humanity is poised to be even bigger, democratizing access to these insights to the world.
The digital health and AI market is growing at a staggering 20.7% per year and is expected to reach over $1 trillion by the end of this decade. We are witnessing a confluence of cutting-edge research in aging science, AI, and a societal shift towards health and prevention, culminating in the perfect moment, a moment that demands action now.
Our mission is to give 1 billion years of health back to humanity by the end of the decade. To achieve that, we need to be highly collaborative and radically inclusive.
We are no longer helpless.
We're no longer helpless.
We're no longer helpless.
We are no longer helpless.
We are no longer helpless. We have the team, track record, and relentless drive to accomplish our mission.
But we need passionate investors and advocates like you to help us get there.
Join us, and together we can help all humanity live healthier for longer.
So I'm hoping that gave you a sense of why this is an opportunity that we can all be part of. I'll share you a QR code afterwards that you can check it out for yourself. But let me give you a bit of context of why we set this up in the first place, why I think we can all do something about it, and why it's the biggest, frankly, trillion-dollar market opportunity to invest in as well. So as you saw from the video, our entire focus is to help humanity slow down their aging. And our mission is to give 1 billion years of health back to humanity. So by 2030, we want to have a huge health span and longevity dividend that will transform society. And if we were to achieve that, as we heard in the video, apart from being super collaborative and radically inclusive, we need to have the track record and expertise to know how to do that. So my co-founder, Michael, and I have both experienced scaling and exiting consumer tech businesses that reached 1 billion users. In my case, I created a travel social network, which became the largest at the time, which sold to last minute. And I also created a tech community, which has been transformational in creating the next unicorns in Europe. And Mike was on the founding team of Badoo, which became the world's largest dating site, which sold for over 3 billion, and also built Anchorfree out to 900 million users, which sold for 300 million. So we know how to create these platforms that engage, retain, convert, and drive value to consumers. But we wanted to turn our talents and expertise into something much more impactful, which became aging. But we're not scientists. We're not the people like some of the great people here who are doing some work, like Brian Kennedy and Jan, who was at the talk at Mito Health's event yesterday, where Kenneth is kindly here supporting. And you know, there's very few companies yet that are doing these things for the end user, for the consumer. But you need to surround yourself with people like this, people like George Churchill, you saw in the video, Dr. Tam, Kristen Fortney, who's founder of BioAge, who has created essentially the first human trial successful drug for reducing muscle loss, sarcopenia. And it's all based on these longitudinal data sets that the likes of Tonu Escu from Estonia, the Estonian Biobank, enable companies like ourselves to do, which is to access these data sets of biomarkers that have been monitored for years and years. And of course, then using the expertise in genomics, in blood analysis, and cognitive health impairment to understand how we can bring this all together in a way that's easy to access for the end user. But why did we care about this? Well, you heard from the video that I lost my dad. I also lost my mum last year to emphysema. She practically suffocated herself to death. And she had a nervous breakdown when I was 4 and suffered from, bipolar disorder throughout my life. And as I was saying to my good friend Tracy here, it's a tough, debilitating disease that you as this child has to, take over in terms of how you're going to deal with that. And when I was a kid, I didn't really have any tools to give her like humanity or equivalent to help her like move into the right direction. And that feeling of helplessness is something we've all felt, whether it be yourself having a health event or whether it be a loved one that you have who got sick. These things have a funny way of shaping your horizon. There's the famous proverb that says, you can have 1,000 wishes, but if you don't have your health, you have one. And so this is a huge societal problem, and it's something that affects all of us. But if we were to cure just cancer, we'd only actually live another 3.5 years on average, because one of the other 4 horsemen, cardiovascular disease, dementia, diabetes, or equivalent, will get us anyway. So when we were looking at what we can do to have the biggest impact given our skill set, we were thinking, well, we can go after cancer, or we can go after cardiovascular disease, which is how my dad died. But we're not going to actually solve the bigger problem, which is, well, how do we stop people getting sick from something else? And if you look at the number one cause of all diseases, including non-communicable ones like COVID, which affected so many of us, it's aging. And aging is therefore something that, you know, as you heard from George Church, we need to focus on because it's measurable and it's reversible. You know, you can have a chronological age of 35, but you could be biologically 50 or 20. And so to be clear on this and why I'm focusing on Healthspan, because a lot of people kind of get misconstrued with lifespan. You know, do we really want to extend, you know, people who are sick for longer? Now, don't get me wrong. A lot of people in the market are doing great things to keep our loved ones prolonged in their life and reduce the suffering when they're sick. But we don't want to just do this. We don't want to have a lot of really sick people sticking around to 120. What we actually want to do is focus on Healthspan, because if we can make people fully functional for as long as possible, then we compress the sick state, hopefully to, you know, not at all. And then you die gracefully at the end, but you've had a full life and you've not had to deal with the suffering and the burdens that that places upon your family and society. So the real sort of aha moment for us when we were looking at how do we create something that's going to impact 1 billion people, you know, rather than just 100,000 people or 1 million. And in our discovery, we actually came across a company that's based here in Singapore called Giro, who had done some incredible data science and AI modeling on the UK Biobank. And essentially what they did, and what you see here is essentially a graph that shows you the predictive power of using different types of models to predict when people are going to get sick or die. And what we found was that there was actually a way to monitor movement and heart rate that was as predictive as getting your bloods done. Can you imagine that? So rather than just going to your clinic and taking a vial of blood and seeing what your cholesterol levels are and your C-reactive protein and HbA1c and all these good things that the doctor will tell you whether you're healthy or not, we can tell you how healthy you are just by the smartphone in your pocket. And that's much more scalable. So humanity's algorithms are built on these movement patterns, which are based on your smartphone. And if you have it, heart rate from your wearables. And then you can use AI and machine learning to essentially predict your risk of disease and death by us having modeled that data against these longitudinal data sets like the NHANES and the UK Biobank. So our solution to this problem is to create a very simple, simplicity is the art of sophistication, as you heard from Steve Jobs, app that can live on your smartphone that does two things. First, it monitors your rate of aging and biological age, and two, it guides you to slow it down. Like you heard in the video, the idea is to make it like a traffic app. If you think about it, the AI and what works to get us from A to B, we don't even think about whether it works. We just trust it. And then it tells us to turn right, and it will get us there in 17 minutes. Lo and behold, we get there in 17 minutes, and we know that the direction it's taking us is the right one. So we have the power to do this now with data. We can essentially map you to your digital bio twin, look at what made them, or the healthiest portion of people like them, the healthiest they can be, and then guide you to be that person. And so if we're going to make this effective for not just, you know, the biohacker community, but also the tech illiterate, your mum and dad, your kids, we need to make it as easy to understand as ABC. And so we have this lag measure, your biological age and rate of aging, which is your indicator, if you like, it's your compass and your geocoordinates. And then we have guidance, which is a function of all the different modalities in health, like your movement, nutrition, mind and recovery. And then we gamify it. We give you a daily score that is based on all the things you're doing in a given day. So it's not that you have to do high intensity interval training to always get a high score. You can be the person that goes out for a walk with your dog and you're building up, you know, points that shows you there are other ways to get to the same result. There are also other things that you may not be doing that you can try. And here's a great example of one that really resonated with us. So Jane Metcalf, she's the founder of Wired magazine and the kind of the incubator business there. And she literally changed her entire focus on health based on her experiences with humanity. And that's why she's an investor and advisor. She was really into her HIIT training and like high active fitness. And she considered herself an athlete. But then she had this tremor in her arm and she just assumed it was genetic. And then it wasn't until she started to focus more on rest and recovery and mindfulness and the things that associate with those types of behaviors that she realized it was actually because she was straining her nervous system and putting herself in a position that was actually creating this tremor. And it changed her whole focus from being, can I run this marathon, to can I just be healthier, younger, increase my health span. So I was having a great chat with a guy called Peng earlier, who's one of the sort of leading venture capital guys here in Singapore. And we were really talking about macro trends, how we can solve education, health. And he said, people focus too much on LTV CAC, lifetime value and cost per acquisition as a measure of success. And he said, what they really should be focusing on is virality, the K factor, and retention. Because if you can't get people to actually do something, then what's the point? You can give them a complete PDF of 100 things of here's how you can be healthier. But if everyone looks at that and goes, great, and then they just put it in the drawer and then they carry on with their day-to-day lives, it's not going to change anything. And in health, behavior change is the holy grail. So we've already cracked that. We have a huge retention. After 12 weeks, 65% of the premium users are still using it. And of those that are using it, 65% are using it at least once a week and 35% are using it once a day. And 12% are converting to premium, which is basically 10x the industry average. And we're only just getting started. So my background and experience with my co-founder is viral growth. That's how we got to 1 billion users. We're building the viral engine for growth now. And this is about to get to the tens of millions and hundreds of millions. And to give you a sense of the feedback we're getting, so Apple, like off the record, we're talking to them, doing a big strategic partnership. They absolutely love what we're doing. They said, they actually said since this, we didn't know what we were looking for and then we found it in what you guys are doing. And that's because they have 3 focal areas: health, environment, and privacy. And they realized that this was something that's not just for the fitness community, it's something that can help all people get healthier. Ranging to our investors, influencers, and of course the average user who just, finds that it's a game changer app. But this is one of my favorite graphs. This is, I think, showing you why what we're doing really does change things. This is the data on the left of the line is what people are doing normally, the median average movement. And then the right of the line is the 40 days after signing up to Humanity. And what do you notice? You notice a stark increase and sustained increase over the next 40 days, which means something has happened. Something has shifted in their mindset to think, I need to do something about this. And what's really interesting is for those who are have a BMI of over 30, the increase is even higher. It's 18% instead of 15%. So I think what this tells me is that people just didn't have a concrete feedback loop to know whether what they were doing was making them healthier or not. What they need is a way to know, am I getting younger? Am I getting older? What is my actual risk of getting sick so that I can make a change? So the title of the talk was Healthspan 2030, and why 2030? Well, if we can get 1 billion years of health back to the world by the end of this decade, and by the way, to achieve that, we can't just do it ourselves. We need to partner with healthcare systems. We need to partner with diagnostic companies, with the insurance providers, with the practitioners, and every part of the health ecosystem. Then we can have a huge longevity dividend and health span dividend for society. So a couple of guys, you may have heard of David Sinclair, a guy called Andrew J. Scott, Martin Ellison out of the University of Oxford. They put together a paper that was based on economic theory that showed the value back to society if we can just give an extra year of health back to the world. And that calculated to about $47,000. But essentially, we've worked out that if we were to get 1 billion years of health, it would, we could achieve about $50 trillion worth of value back to society. And this is just a good framework to think about if you're either trying to enter this space and you want to do something that's hugely impactful, because, by the way, I'm not saying just we're the only ones who can do this, but really a way to think of it is, what is the impact on health and how many people can we access? So I just want to point out a couple of examples. So, all great companies, but Human Longevity Inc., one of the most well-raised companies in the world. They've raised hundreds of millions. And they offer a full body MOT for $25,000 to very wealthy individuals in the US who want to get their full body MRI, all the diagnostic tests, and then they try and give you personalized recommendations on how to improve that. The problem is the average Joe is not going to be able to afford $25,000 to get these sort of tests. So the impact for that individual might be high, but for society, it's relatively low. And then on the other end, you've got companies like Calm and Fitbit who have hit the mainstream, but they really only focus on one modality like mindfulness, or they focus on fitness, when there is so many other aspects of health like emotional health and cognitive health and what you eat and so on. So really what we need to do is really understand the more holistic picture of what's causing us to be healthy. And that's very much where we make our strategic decisions from. So just so you guys know where we are right now, we're right at the beginning. We've raised about $5 million thus far, but we're sort of pre-seed. We are the #1 longevity app, but we've got a long way to go before we hit our goal. We're currently offering digital premium, and we saw you're getting a 12% conversion to that. We're in the process of doing a few large trials or studies, pilots with some large companies, companies like Apple, Holland & Barrett, and Strava, who are going to really enable this to their customer bases and their employer, their teams. And we're also going to be adding other sort of ways in which we can capture data, not just movement and heart rate, but also blood analysis. And we've got a paper in Nature, sort of the big publication, it's in peer review, where we've actually shown that with only 6 blood analytes, give a predicted biological age, which means that it's much more cost effective and much more scalable, because any blood work you guys have done with your doctors, even if it was for kidney function or for some general illness, can be used to give you a feedback loop to tell you how you're aging. So in conclusion, our vision is to help transform preventative health by extending Healthspan for all. And we want to do that by combining these different areas that have not been combined before, both the actions that people are taking, the biomedical markers, whether that be your blood analytes, your DNA methylation markers, and the digital markers that very few people fail to capture, like your movement and heart rate patterns, as well as the actual aging models themselves, so the different ways of measuring the impact of these biomarkers, so that we can revolutionize preventative healthcare, because we can then use AI to harness the value of what these interconnections mean. And actually, one of the things that we're very passionate about doing is opening this up to the world. So not creating patents around the models, not trying to create these siloed data sets, but actually opening them up to federated learning frameworks so that anyone else, whether it be a private company, a pharmaceutical company, a health system, or a company like ourselves where we benefited from the UK Biobank, can essentially train their models on our data sets. And you can even create synthetic data sets, which is what we're also building in-house, where you can essentially mimic the real personally identifiable information, but never reveal personally identifiable information. So it's better than even anonymized or synonymized data. And in so doing, you can transform the world's system through creating the world's largest biobank and integrated preventative health monitoring system, dwarfing the largest biobank in the world within 3 years. So why I'm here, one of the reasons I'm here, I'm looking to strengthen our sort of support structure with a couple more individual investors. We are launching on the public a crowd raise fund so we can get our customers to get behind us. We've got 75 world-renowned investors already, and we're offering essentially another up to 1.2 million after having already closed 1.8 million on the same terms to people to back us on our mission. The terms are 15% discount on a 30 million cap, and we are essentially offering this to the public in about 30 days' time. So if you guys want to find out more, you can get your phones out now, and this will work. It's not that advanced technology, but it's quite cool. If you actually get your phones out and just click on the link, this will take you to our wefunder.com/humanity page. You can then see the video again, or you can read up about some of our milestones and achievements. And then if you wanted to reserve an allocation before we open up to the public, there's preferential terms to the next 500K that we're raising. So with that, I thank you for your attention, and I'm happy to answer any questions. And have drinks.
Ladies and gentlemen, that concludes Venture and Capital Singapore. Thank you very much for the entire day. We've had a great day. Obviously, now we're going to have some networking drinks for all of us. So from here, as I said, this is probably one of my favorite parts sort of at the event, where everyone sort of relaxes, has a couple drinks, networks with each other. As I said, all the companies are still here. So I said, if you haven't got a chance to speak to everyone yet, make sure you take this opportunity to have a chat with the rest of the companies now. Thank you everyone again for attending. Hope you've had a great day and look forward to seeing you next year. Thank you. Oh, and last one is, I just want to say big thank you to Rhythm, Jackie, and the rest of the team outside. Just so you guys know, what people don't understand is doing events like this is an absolute marketing logistical masterpiece. We've had 28 companies come over from Australia, UK, etc. to be a part of it, and then also all the marketing that goes along with it. And these are the ones, and obviously Esther in our office as well, organizing and putting it all together. And you would have seen them running around all day, sort of organize. That's what makes this entire thing seamless. So thank you to my team for everything that they've done to make this real. Thank you.